Hello everyone, this is CA Jagannathan here. I hope you are all doing good. So let's start the revision of this chapter, fixed income securities. See, before we start the discussion, before we start to revise, I wanted to clarify two or three things here. See, first is this revision is going to be comprehensive in the sense, first we will revise the concept. You can see the learning objectives. Okay, there are these topics. So these are all the topics which we are going to discuss one by one. So first we will have discussion of the concept, then we will do few questions, concept clarifying questions. Like this we are going to discuss the entire chapter. This is going to be the flow for all these revision lectures. Not only this chapter, all the chapters will be revised in this manner. That is first point. Secondly, the module which I am using, the revision module which I am using for revising this chapter, okay, this will be freely available in our website. You can go and download this freely, no issues there. So and we will upload chapter by chapter, not collectively. What we will do, for each chapter we will have separate PDFs uploaded there on the free resources of our website. You can go and download it. For the website we have the link in our description, right? You can download from there. The third point is, okay, this chapter, fixed income securities, comes under security valuation chapter in your ICAI module. So if you take your ICAI module, you can see this chapter under security valuation chapter. Two different securities are discussed, that is equity and bond or fixed income securities. So what we will do, since this chapter warrants separate discussion, we will discuss this separately now, then we will discuss separately equity related topics, equity valuation, right? So let's get started quickly without wasting time. So first topic is introduction to fixed income securities. So this chapter will have a brief introduction, then we will move on to the other topics. See, business is all about raising capital from the investors. Business is all about raising capital from the investors and using the funds, using the capital, you invest those funds into asset. Then from those assets you generate returns, and returns will be returned back to the fund providers or capital providers. This is the cycle of the business, correct? Now what equity holders take is variable returns from the business, and what debt holders take is fixed returns from the business. Debt holders will take fixed returns from the business. The obligation for the company to pay debt holders will be fixed in nature. Whenever you are borrowing, okay, then and there itself it will be fixed at what percentage you have to pay the interest to the debt providers. This will be fixed in nature, irrespective of the profitability of the company. Okay, this year if the company is making 100 crores profit or 200 crores, is irrelevant for paying debt holders. Whatever you pay to debt holders is fixed in nature. That is why these securities, the debt securities, okay, if you take bonds or debentures or these kind of debt securities are called as fixed income securities, are also called as fixed income securities. So equity, debt is there. Equity, you take variable returns from the business. The leftover profits, share in profits, equity holders will take. Now whether it is debt instruments or equity instruments, for trading purposes, okay, so for investors to freely buy or sell these securities, they need liquidity. That's where market comes into picture. So market, in the sense, stock exchanges comes into the picture, the place where these securities are bought and sold. Okay, the market, in the sense, here we are referring to stock exchanges. So you have two segments. If you take equity segment, there equity shares of the company will be traded, and in the debt segment, the bonds and the other debt instruments will be traded. Okay, we need to identify whether the security is undervalued or overvalued. Just like equity shares, okay, we need to find whether the security is undervalued. If it is undervalued, investors will buy the security. If it is overvalued, investors will sell the security. So we need to know whether the security is undervalued or overvalued. See, the price quoted is available freely in the market itself. If you go to any website, you will get the price of any security, bond or equity shares. You will get the price. This is called as quoted market price. But you need to analyze yourself that whether this price is fair price for this instrument. That decision, okay, informed decision, you will be able to make only after knowing all the terminologies related to market as well as the instrument in itself. So all these you need to know and then take informed decision whether to invest in this security or not. So all this chapter is all about, okay, explaining the features of the bond or features of the fixed income securities and the features of the market related to this fixed income security. Now, this fixed income securities are two types of fixed income securities available. One is short-term securities and long-term securities. The short-term fixed income security, these are called as money market instruments. Okay, example, T-bills and other short-term securities. Okay, commercial papers, all these are short-term fixed income securities. And the long-term fixed income security, bonds, debentures, these are all called as long-term fixed income securities. See, so we are only concerned with long-term fixed income security, that is bond valuation in this chapter predominantly. In the institute book, they have also discussed the the money market instruments. What we will do, we will put a separate video for money market instrument. Miscellaneous topics will be covered there. See, before going to further discussion, I'll briefly introduce you to various terminologies associated with the bonds. You need to know various terminologies, few terminologies associated with the bonds. For example, I'll just roughly tell you one or two things here and there, and then we will start with main discussion. See here, we are having coupon. First thing is you need to know what is coupon. See, for example, take a bond which is having a face value of 1,000 rupees. A bond which is having a face value of 1,000 rupees. Then, okay, the redemption value. It is issued at face value, assume. Then redemption value is 1,020. Okay. Okay. Then the coupon rate is assume 5% of this bond, right? So year to maturity. So years in the sense the maturity period. Okay, the maturity period is given as assume 5 years. 5 years is the maturity period. Now see, what do you mean by coupon? Coupon is nothing but the annual interest payment. Just think like interest. For debentures, the company will need to pay interest. Na? The same thing is happening in the bond also. Bond coupon, na? It is a fixed payment which is made by the company to the bond holders annually. It can be annual or semi-annual based on the instrument. Okay. But regular intervals, whatever you are paying, that is called as coupon. It is something similar to interest. Why we are in the entire fixed income security chapter, the interest will be referred to as coupon only. Why we are telling as coupon now? Because see, there are various interest rates associated with this chapter. If you see, YTM is there, yield to maturity, and there is 1 year yield, 2 year yield, 3 year yield. So based on maturity period, different yield will be quoted, different interest rates. Then you take forward rates, that is also an interest rate. So there are so many interest rates available in the market. Okay, you will get confused which interest rate I should take now. That's why they have given the fixed annual coupon payment. The interest payment is there now for the debt holders. That is called as coupon. For the bond holders, it is called as coupon, right? So coupon means nothing but it is interest, something similar, very similar to interest only. It will apply it on face value. So whenever annual payment in rupee terms you are calculating, you have got coupon as 5%. Whenever you calculate in rupee terms, how you will find 1,000 into 5%, which is okay 50. Like this in rupee term, if you want to convert, you have to calculate like this. Okay, that is one thing. There are two things here. For any bond, there will be interest as well as capital gains. See here, for example, I can classify interest and capital gains. The benefit arising from the bond. Okay, these are all basic discussion. I'll discuss in detail further whenever the concept comes, but just to throw some light. See here, a bond is issued, face value, issue price is 1,000. Assume it is issued at par. 1,000 rupees it is issued at 1,000 rupees and redeemed at 1,020, which means the 20 rupees, this is redemption, this is issue price. So 20 rupees is your capital gain. Okay, if the maturity period is 5 years, now it is earned over a period of 5 years time. It is not annual payment. Remember the capital gains portion, just like equity shares. When you sell the shares only, you make the capital gain. Okay, or if you want to compute returns, you will compute. That is different. When you want to sell the shares only, you will get a gain. But it is for entire period. It is not annualized. Same way, this is 120. 1,020 is the redemption value. So 1,000 is the purchase price. So you are gaining 20 rupees. This is capital gain. This is 20 rupees you are making from the bond. One thing. Then there is interest portion. How much is the interest you are gaining? 50 rupees annual interest. Now every year 50 for 5 years you are gaining interest. This is also income from the bond. So income which you will receive from the bond are of two types in nature. Two types. Okay, one is that interest, which is also an income from the bond, and then there is capital gains which you earn over a period of time. Okay, if any capital gains is not a sure income, just see, this interest will be surely given. Capital gains, it depends on what price you purchased, what price you bought, and at what price you sold the security. Okay, if you bought the same security at cheaper price, now you will get a higher capital gain. This is all about it. Okay, you understand this? So interest is there, capital gains is two types of income which you can earn. The third thing I just wanted to clarify is that, see, the bond can be issued at a discounted price as well as on par value, which means the issue price it might be issued for discount and it may be issued for also par value, which means the face value you can issue the bond at face value also, right? And redemption also can happen. Okay, at a discounted price generally will not happen, but there is a possibility, discounted price or the par value and premium value. Okay, which means if the bond is issued at a discounted price, is called as discount bond. Okay, if it is issued at a premium price, now it is called as premium bond. these things just I wanted to clarify. Anything is possible. You always need, for capital gains computation, you always need to be careful at what price you are buying. If you are buying from the market, see, this is when the company is issuing. When you are buying from the market, always possible. Any three is possible. Like if you can buy for a discounted price, face value is 1000, you can buy the bond at 970 also, exactly 1000 also, and 1020 also. Anything is possible. So based on issue and redemption, okay, based on your purchasing cost and your selling cost, the capital gains on that will be computed. This is basic understanding. Let's move on. See, so the bonds are of 4 types in nature. 4 types of bonds are available. One is plain bond. What are plain bonds? Okay, see, what are plain bonds? Plain bonds is a bond which pays coupon for n number of years, and then after the maturity period, during the maturity, it will pay coupon, and at the end of the maturity period, it will redeem your bond. This is plain vanilla bond, normal bond. See, pays coupon for n years and redemption in nth year. How the cash flow will be? Year cash flow. 1 to n, which means, say, if the maturity period is 5 years, so from 1 to 5 years, it will pay the coupon, interest. Coupon is nothing but it's to be understood. Whenever I am using coupon now, you should understand is the annual interest payment from now on. Okay. Next, the nth year. N year na redemption. Okay. After some number of years, say 5 years na, the 5th year, what will do? At the end of 5th year, it will redeem your bond. Okay. Whatever agreed upon price. The price will be agreed upon earlier itself. During the issue itself, in the bond indenture itself, it will be given at what price it is going to be redeemed. Are you understanding? There is no ambiguity. That is why this is called as fixed income security. Okay, the coupons are also fixed, the issue price is also fixed, the redemption also is fixed, which means the cash flow which will arise from this security is fixed in nature, and that hence it is called as fixed income security. See here, annuity bond, second bond. This is plain bond. Now we will move on to annuity bond. What is annuity bond? Annuity bonds is nothing but like an EMI, okay, receipt, EMI receipt, where like every a specified period, say if it is issued for 5 years, every year you will receive some amount, and that will be equal amount for all these years, but that amount will contain principal portion as well as your interest portion. Pays installments each year, which covers coupon as well as principal. Understanding? Coupon means interest as well as principal. Year 1 to n, annuity installment. This will have principal as well as interest portion, right? This is annuity bond. This is rare. Okay, in the regular lecture we discuss in detail about all these things, but in the revision, we are concerned with only these 3 bonds: plain bonds, perpetuity bond, and zero coupon bond. Next, okay, perpetuity bond. What is perpetuity bond? See, perpetuity bond means it will pay only coupon, but till perpetuity, which means it will never redeem its bond. The bond will never get redeemed, but it will pay the coupon. Coupon will be received for bondholders will receive the coupon till perpetuity, but they will not receive the capital. It is something like they have invested. Now, Tirupati Undiyal is something similar to Tirupati Undiyal. If you give the capital will not be redeemed back. Till perpetuity, you will receive the coupon. Are you understanding? Next is zero coupon bond. Zero coupon bond, okay, the bond is very interesting bond. See, zero coupon bond, as the name suggests, there will be no coupon itself. The coupon will not be paid. Okay, when coupon is not paid, if the bond is also issued at par, redeemed at par, there will be no benefit to the bondholders. Like that, you should not think. Okay, see, in the zero coupon bond will always be issued at discount. So, for example, if a bond is having a face value of 100 rupees, the zero coupon bond will be issued at discounted price. Whatever interest they want to offer, say it will be issued at say 98. The difference between face value and the issue price will become the return for the bondholders. Are you understanding? The capital gains will be in case of zero coupon bond, coupon will not form part of the returns. Only the redemption will form, only the capital gains will form part of the returns from the bond. Are you understanding? So what will happen? See here, perpetuity bond, you understanding? Okay, 1 to infinity you will get coupon. Here what is happening? Year n. Okay, which means say if a zero coupon bond is issued for 3 years, which means initially in year zero it will be issued at a discounted price, and at the end of nth year the cash flow will be only redemption, and it will be redeemed at face value. Pays only redemption with no coupon. It is issued at discount and redeemed at par, and difference being time value of money, the compensation, the interest portion will be the returns from this zero coupon bond, right? So all these we discussed all these type of bonds, right? Now we will move on to the valuation point. See here, we discussed the introduction part. Now we are moving to the valuation of a bond. What is value of a bond? See, there are various methods to value any asset. As per the discounted cash flow method, what is the value of a bond? Value of a bond is nothing but present value of the future cash flows discounted at required rate of return of the valuer, required rate of return of the bondholders. Here we are valuing bond, so required rate of return of the bondholders will be taken. So what is this? How to find the value of any asset? See, whatever the asset is going to generate in the future, whatever cash flow the asset is going to generate in the future, we will discount it and bring it to present value terms so that we can find the value of asset as of today. Okay, today what is the value we will find. Why we are concerned with valuation? First you need to understand. See, you need to find value of the asset, real value of the asset or fair value of the asset, because not always the security will be quoted at the fair price in the market. If you go to market, any market, equity share segment, if you see equity shares will be traded, bond segment, the bonds will be traded, but not always the quoted price will not be the real value of the company or value of this instrument. Why? Because okay, valuation you have to do on your own, and then you compare with the quoted price available in the market, then you find under or overvaluation. Correct? For understanding valuation, I'll give you an example. Say if you are traveling from Chennai airport, if you are traveling from Chennai airport to some place, say Nungambakam, okay, you take Nungambakam, and you came from airport and you came out and then asked auto wala and asked what is the price for it. He is quoting 300 rupees price, right? Now the 300 is quoted price, understood? The 300 is quoted price, which is asked by the person, okay, which is asked by the driver. Now you need to analyze on your own and decide whether this is fair value or not. Are you understanding? The 300 may not be, maybe fair price or may not be fair. It all depends on the situation. Now what do you do? If you are prudent enough, what you will do? You will see the timings, okay, whether it is late night or the morning, okay, and you will analyze the traffic and the distance between these two areas, and then we'll decide, okay, this is the fair value. If you decide 200 is the fair value, now you will think, okay, 300 is too much. I need not pay 300. 200 is the fair price. So he will not pay because he feels that investor will feel that this is overvalued. Okay, are you understanding? So the valuation is on relative term. One person for the same security might feel it is overvalued. Another person for the same security, he might feel this is undervalued. Same way in this case also, one person who is localized person, some person coming from Chennai, he is based on Chennai itself, he knows what is the distance, everything he knows, and he is regularly traveling, and he will say 200 is the fair price, not 300. Yeah, you are overpricing me. Correct? The fair price of this service is only 200. I cannot pay you 300. Like this, he will say. Suppose conversely, a person coming from Bombay, what he will think, from Bombay for the same distance, I am paying 1000 rupees. Yeah, here he is only asking 300. For him, the same service might feel undervalued. So it all depends from person to person. That is why the required rate of return is very, very important term, which we will study under portfolio management, CA, PM and all. We will study in detail. Okay, so required rate of return of the valuer. So as per this person, so person to person, valuation will change. Understood? So we have to find our own, you have to use our own method and find a fair value. Then we will compare this with market price and take decision, informed decision. Same way we do it in day-to-day life, we do it in markets also. Are you understanding? So value of the bond is present value of the future benefits of future cash flows in the sense from the bond discounted at required rate of return of the valuer. See, the bond value is a function of two factors, namely. One is that expected future benefits or cash flows and required rate of return or discounting rate. So discount rate is there, okay, and expected future benefits is there. You project the cash flows. First, what you will do for any security, you project the future cash flows. As per discounted valuation method, I'm saying there are various methods like PE ratio and other things, relative valuation method, net assets valuation method, all we will see under equity valuation chapter. Here we are concerned with only discounted cash flow method. For discounted cash flow method, how to value the company, value the instrument? See, you will take expected future cash flows. You will project the future cash flows, and what you will do, you will analyze what is the required rate of return. For me, what is the required rate of return which will satisfy my decision, okay, which will satisfy my investment decision. You will take that required rate of return and then discount this expected cash flow and arrive at fair value. So what is happening? There are two things here. One is that expected cash flows and then required rate of return. This represents the return from the bond. Say here I am taking an example of plain bond. Yeah, here 3 years bond, 1, 2, 3, assume. Okay, here it is giving interest of 5%, face value is assume 100 and 5% is the coupon. Coupon is equal to 5%. So every year you will receive 5, 5, 5. At the end of the, assume it is redeemed at par, and the end of the third year, okay, your 100 rupees will be paid back. So these are all the cash flows of this bond, correct? So I told you fixed income securities, the cash flows will be fixed, right? So there is no ambiguity here. Expected future cash flows, will there be any doubt or no? No. Of course, instrument itself will provide you what are the cash flows. See, only when we value equity instruments, there we need to project, okay, next year what will be the profits, what will the cash flow need to be taken, next 10 years I need to project. Here there is no ambiguity. Yeah, whatever is the cash flow will be written in the bond indenture itself. It will be given in the instrument itself. So we will take the cash flows ready-made, they're available. So these represents a return of the bond. This represents return of the bond, and the required rate of return, that required rate of return represents the risk side of the bond. What is the, why? Because see, how certain are these cash flows for me to realize? This will be captured by the risk angle. Okay, that is why we are using discount rate. For example, I told you this is required rate of return of the bondholders we are discussing now. See, required rate of return will never be same as the interest rate. For example, if you have interest rate of say 8%, but you might not be satisfied with the interest rate coupon rate alone. Are you understanding? Suppose assume here the bond is giving coupon of 5%, but I might require more than 5% for this risk class. So how do you analyze the risk of the bond? Very simple. Okay, just like any other security, you will see how certain is the cash flow to be received. Okay, so for example, if you take a Government of India bond, the certainty of the cash flows is 100%. Nah? Okay, you will receive the cash flows. There is no uncertainty. That's why, okay, the required rate of return will be very less. The required rate of return from the Government of India bonds will be less. And if you take corporate bonds, and that too, if you take suppose one company, Reliance Industries is there, then another company, some XYZ Limited, unknown company is issuing a bond. Okay, which bond will have higher risk? The unknown company will have higher risk because you know already Reliance Industries is a famous company. So you, okay, for this risk class, this is, you need to ask premium. Okay, you need to ask premium. The risk, since the risk is higher compared to the Government of India bond. So if you take Reliance Industries, you see here I am taking three securities. One is Government of India bond, which is less risky than Reliance Industries, RAL, Reliance Industries Limited, then which is okay, less risky than XYZ Limited. So for this you will ask highest premium, then you will require less return from this, and the required rate of return for Government of India bond will be even lesser. This is the order, right? So what I wanted to say is that Government of India bond is riskless, assumed to be risk free. Okay, then if you take Reliance Industries, it is little more risky. Then if you come to XYZ, even risky because of the uncertainty, the cash flows, uncertainty of the cash flows, the performance of the company is uncertain. Okay, you cannot rely upon. Like that, every investor will have their own risk perception. This is very important. See, there is no common risk. Okay, this is just like, why? Because it will depend on person to person. A risk taker may take a higher amount of risk. Okay, so he will require lesser rate of return. So all this we will study later. Now what I wanted to tell is that required rate of return will change from person to person, and that is purely a function based on the risk perception. If you perceive this instrument to be more risky, then you will ask higher required rate of return. Your required rate of return will be more. This is the understanding. So return value relationship. See, when the cash flow from the instrument is more, understood, the expected return will be more and the value of the instrument will be more. See, a bond, two bonds are similar in nature. One bond is offering higher coupon rate. Say for example, one bond is offering 10% coupon rate, the other bond is offering only 5% coupon rate. So a bond having 10% coupon rate will be more risky than the bond obviously having a 5% interest rate, correct? So which will have more return. So the return from the cash flows will be obviously more. Then if the cash flow is less, so it is offering less coupon. The cash flow is lesser. Okay, I'm not talking about capital gains for now. Just for example, if it is offering less coupon, then the expected return will be less, the value of the security will be less. What is the relationship between risk and value? See, higher the risk, this is okay, this is return value relationship. More the return, higher the more the return, higher the value of the security. Okay, Inga, this is inversely proportional. Higher the risk, lesser the value. Lesser the value. Okay, see, when the investors perceive the instrument to be more risky, they will not be willing to pay a higher price. They will be only willing to pay a cheaper price to buy the security. This is obvious, right? This is all about valuation. Rest we will discuss after solving few questions, right? Take question number 1 for discussion. Okay, a rupee 100 par value bond bearing a coupon rate of 11% will mature after 5 years. What is the value of the bond if discount rate is 15%? We are starting from basic question. Okay, once you are good with concept, once you are thorough with the concepts, we will slowly build up the later concepts. See here. See, 100 par value bond. So face value of this bond is 100. So why this is important? Now coupon rate should always be applied on face value, which means 11% is there. Year 1 to 5, this is a 5-year bond. So year 1 to 5, this is a plain bond. So year 1 to 5, what you will receive? Receive cash flow of 11 rupees, that is coupon. Okay, then in the end of 5th year, you will receive 100 rupees, that is your redemption value. Okay, the present value of this comes to 86.57. You discount it using 15%. Why you discount using 15% now? See here, the coupon is only 11%, but you are using 15% discounting rate because after analyzing the risk perception, after analyzing the risk of this bond, I feel even though the bond is offering me 11% coupon, annually it is offering me 11% interest rate, but I am not satisfied with coupon alone. I want some extra capital gains portion also from this bond. Are you understanding? Okay, which means I am not satisfied with coupon income alone. So I want something over and above the coupon rate. 11% is the coupon rate, but I want my required rate is 15%. So what I should do? I should discount using required rate of return or something else, a required rate of return, which means whatever I require, I will discount using that rate. So present value factor at 15%, we will get the value of the bond as 86.57. See, there are two things here, just wanted to clarify. One more thing, the discount rate is there, the 15% which you are using, this is required rate of return, okay. And there is one more return which you will study later, expected rate of return. The expected rate of return is something different from required rate of return. Expected rate of return is mean return, or on an average what I am expecting to get from the security. Are you understanding? A required rate of return is after considering the risk factor, even though the security, suppose in this question the discount rate is 15%, okay. The expected rate of return is, assume in this case, suppose 11% is coupon, so assume the bond is issued at par and redeemed at par. There is no capital gains. If there is no capital gains, the only thing which you will earn from this bond is coupon, 11%, correct? So only thing which you will earn is coupon, which means ideally the expected return should be coupon only, 11%. Bond is trading at par and discounted, it will be redeemed also at par. So in that case, there will be no capital gains. You already know that. So coupon will be only income, right? So the expected return from this bond is 11%. But your required rate is expected rate as something over and above the expected, over and above the expected. So 11% is the instrument is giving 11%, but what I require is something over and above 11%. I require 15%. Okay, this is the difference between expected and required rate of return, which we will learn detail in portfolio management chapter. Now forget about that. Just wanted to clarify. Okay. Always you will get confused with expected rate of return and required rate of return. But for valuing any asset, you should take always required rate of return. Required rate of return. Okay, in case of equity, it is KE, denoted by KE, which is found under CAPM and all. There are various models to find KE. But here, what I am concerned with is that you should not get confused with required rate of return and expected rate of return. Always for valuing, you should take required rate of return for discounting. So, very simple. Here, if the bond is issued at par and redeemed at par, you will not earn any capital gains. But here, if you notice, okay, you are having some capital gains also, because the value is only 86.57. If and only if the bond is quoted in the market for 86.57, which is less than the face value. Face value is 100, see here, 100 par rupee bond. So if it is quoting in the market for less than the face value, then at a discounted price only you will buy. Why? Because you will buy at 86.57 and you will redeem at, the bond will get redeemed at 100. Nothing told in the question, it will be redeemed at par. By default, if nothing is mentioned in the question as such, it is to be understood that the bond will be redeemed at par. Now you see, if you buy the bond for a discounted price of 86.57, and if the company is redeeming you at 100 rupees, then you will make the difference will be capital gains. Okay, then what it means that 11% is gained through the coupon, the interest, and the balance will be gained from the balance 4%, approximately, roughly, because it is not considering the time value of money. I will explain while I explain it in YTM. Okay, now I'm just roughly speaking, the 11% is from the coupon and the balance 4% you are expecting to gain from the capital gains portion, right? That is why you are not willing to buy the bond if it is trading in the market for 100 rupees. Are you understanding? If the bond is trading at par value, you will not be satisfied with this bond. And what you do, you will only buy if it is trading at discounted price of 86.57, because you consider this as fair price. Are you understanding? Valuation, I'm explaining, don't think I'm again and again explaining. If we understand the basics well, thereafter, okay, in so many topics, say equity valuation also, I will use this, portfolio management will study, then we will do options. There also you need to understand all these things. Okay, I'm laying a foundation for, don't mistake. Right, next, notes. I have given the notes also. See here, for the bond of this risk class, the investors require a rate of 15%. For this return, the price he is willing to pay is 86.57, which means he is not willing to pay 100 rupees. Okay, just like I told, he is only willing to pay 86.57. If the bond is trading in the stock market, say for lower price 80 rupees, so he feels that 86.57 is the fair value of the bond. And suppose if the bond is trading in the market for 80 rupees, which means even lesser than what he believes that it is fair price, so it is undervalued and he will buy the security. If the quoted market price, if you see the bond is quoted at 90 or some other price, 90 rupees, he will feel it is overvalued and he will not buy. What will happen if he buys as 80? See, he requires 15% rate of return. If he buys at 86.57, see here, If the bond price is quoted market price, see in this question they have not given quoted market price. Are you understanding? In this question they have not given quoted market price and all. They have asked us to value the bond, fair value of the bond. They have asked us to compute, and we found out fair value of the bond taking 15% required rate of return for this risk class. Okay, bond of this risk class. Now, if the bond is fairly valued at market, what decision we will take, what is happening, we need to see. See, if the bond is trading in the market exactly for 86.57, in that case, what will be the cash flow stream? Okay. The return 15% is nothing but the IRR. IRR computation, you know from intermediate capital budgeting. I'm not going into details of finding IRR. It is very simple. See here, year 0, we had an outflow of 86.57, which means 86.57 today you spend to buy this bond. This is your outflow, year 0. By buying this bond, what will happen? Year 1 to 5, you will receive the coupon. Okay, 11 rupees coupon you will receive every year. Then the fifth year, you will receive 100 rupees. Okay, it will be redeemed at par. So 100 rupees you will receive. If this is the cash flow stream, the IRR of this cash flow will be 15%. Okay, you can go and compute. IRR will be 15%. Okay, next. Bond, if the bond price is 90 rupees, how to compute IRR, we are going to see in the next segment. That is why I don't want to stress that. Okay, IRR computation you already know. Present value, what is IRR? IRR is nothing but the rate, okay, internal rate of return, the rate at which the discounted cash outflow will be equal to discounted cash inflow, which means year 0 you have spent 86.57. This is today's outflow, which means if you discount the 11 rupee and 100 rupee, okay, you got already calculated. This is the discounted cash inflow. Right, 86.57 will become your discounted cash inflow. See, total cash 11 rupees you have paid for 5 years. 11 into 5, 55 plus 100. 155 is the total amount you received. Sorry, not paid. You received. Okay, as an investor, you received 155 rupees in total without considering time value of money. If you discount this 155 rupees to present value terms, it will become 86.57. Correct? Now that is the rate at what rate if you discount this cash flow, you will get 86.57 today. Okay, it is nothing but 15%, which you computed. So next, if the bond price is 90, the IRR will be less than 15, more than 15, less than 15. If you pay a higher price, see I told you, the required rate of return and the bond value will be inversely proportional. So which means inversely related, which means if you pay a higher price to acquire the bond, you will only earn lesser return from the bond. Yeah, this is simple. Understood? So if you pay 90 rupees, year 0 cash flow will be 90, 1 to 5, 11, 100. Okay, fifth year redemption will be for 100 and IRR will be obviously less than 15%. We don't need to compute as such. It will be logically less than 15%. Then if bond price is 80, which means even below our fair valuation, which means you are buying it cheap, then you are getting redemption of 100. So in this case, you are getting, very simple. In this case, you are getting a capital gains of 100 minus 86.57. See, 13.53. 13.43 is the capital gains which you are getting in case 1. Case 2, where bond price is 90 rupees, 100 minus 90, 10 rupees is the capital gains portion, right? When bond price is trading at 80, how much you will get? You will get 20 rupees as capital gains in the third case, which means, which is higher? Case 3, you are getting a higher capital gains, That is why you require 15% rate. At that rate, fair value comes to 86.57. If the price, quoted price is even below the 86.57, you will obviously make a higher return than your required rate of return. IRR will be more than 15%. Okay, some percent I don't want to tell because of the increased capital gain portion. Why this is happening? 11% coupon rate you will earn, and something more than 4% you will earn as the capital gain. Okay, how to find this exactly? We will see under YTM computation. See, YTM, which we are going to discuss, is nothing but exactly same as IRR. How you compute IRR? IRR method only you will use and compute exact YTM. Later we are going to discuss. So here IRR, now you don't get confused, is nothing but YTM here. Okay. Next, the investors can pay maximum 86.59 to earn this required rate of return of 15%. If he pays more, then his return of investment reduces, and if he pays less, then return on investment increases. The bond gives only a return of 11% through coupon. How can investor earn 15%? I just now explained. The return from the bond comes from two sources, coupon as well as capital gain. If he pays 86.9 and buys the bond, okay, and get it redeemed for 100, in addition to 11% coupon, he also earns some capital gains, thus boosting his return from 11 to 15%. All this I have given as note. You can go through the notes and can comprehend from the the concept very well. Are you understanding? So if a bond, why I am discussing through example, this is just like example. Through this example, I am explaining valuation. Okay, don't think I am explaining question this much, because you need to understand the core of valuation very well. So through the example, we are explaining the concept. See, if a bond is trading in the market at par value, then buyer can earn only coupon and no capital gains. Hence IRR will be 11%. So simply I put in a table to summarize this. Very simple. Bond is trading at par. Obviously, we assume that it will also be redeemed at par. Okay, nothing given now, it is redeemed at par. These are all situations when bond will be redeemed at par. So bond is trading at par and redemption also will happen at par. Then what is happening? Earns only coupon. The return which the bondholders will earn, okay, through the life of the bond will only be the coupon. So IRR will be exactly is equal to coupon. This IRR is nothing but YTM. Later I will explain. No issues. YTM will be coupon, which means the yield to maturity which you will earn is nothing but coupon rate. Exactly the coupon rate. Bond is trading at discount. In our case, okay, we found out the value at 86.57. If the bond is trading at discount, what happens? Earns coupon as well as capital gains, which means IRR will be more than the coupon. Okay, YTM will be more than the coupon. The yield, the return which the bondholders earn from this bond will be something more than the coupon, because capital gains portion will be earned. That is right. Will be considered. That's right. Bond trading at premium. If the bond is trading at premium, earns coupon, but that coupon gain, say bond is trading at premium. Assume 100 rupees the bond will get redeemed, but it is trading in the market for 120 rupees. This is okay. Assume the market price and redemption. Purchase price or redemption is happening at 100, which means you purchase the bond at 120, you redeem the bond at 100, you get redeemed the bond at 100, which means you are making a capital loss out of it. Understood? So 11% was your coupon income. There is no ambiguity, that is fixed. But apart from the 11% return, you are making loss in terms of capital gains. Understood? So capital gains loss, what will happen? It will erode your coupon income. So your IRR will be even lesser than the coupon. Are you all understanding the situation 3 I have given here? Okay, next question. Quickly we will discuss. See, bond valuation, non-annual coupons. Non-annual coupon, very simple. Wherever they have given semi-annual coupon, okay, commonly they will give semi-annual only. They will not even reduce the, for example, examination purpose, I'm telling you, okay, quarterly coupon and all will not be given in the examination. Half-yearly coupon will be given. Semi-annual coupon will be given. If they have given, you have to find out this interest is payable semi-annually. See here, a rupee 100 par value bond bears a coupon rate of 12%, will mature after 6 years. Interest is payable semi-annually. Compute the value of the bond if required rate of return is 16%, compounded semi-annually. This is what is given in the question. See, whenever they give semi-annual data, what you have to do? Convert the entire data into periods, which means here the maturity period is 6 years. What we will do if we will convert this into periods. Suppose 6 years will have 12 periods, 12 semi-annual periods. We will change this. Okay, 12 semi-annual period we will change and then compute. Not only that, coupon is 12%, that we will divide it by 2 because semi-annual. So 12% coupon we will convert into 6% interest. So for 12 period, each period we will be paid interest at 6%. Then there is something else which is required rate of return 16, that we will also reduce by half it, which means in case of semi-annual 16% will be taken as 8% interest semi-annual, right? This we will convert and solve. All the other things will remain same. Just convert the data into periods. Wherever they have given semi-annual, you convert all the annual data. 3 data you need to convert. One is that the coupon rate, which you will reduce accordingly. Okay, if it is 12%, I will make it 6%. Then what you will do? You will required rate of return is given. That also you will reduce accordingly. Periods is there, the years to maturity. If it is giving us 6%, you convert into period. So you will get 12 periods for 6 years bond. And solve this question. Period 1 to 12, 6 rupees will be your cash flow. Discounted 8% will be there. So these 3 changes will be applied and the value of the bond, present value of the bond is 84.92. See, I'm not focusing on the computation part here. Are you understanding? I'm not, we are revising the topic, so I'm already running late with the time. So what I'm doing is I'm not computing all these numbers. Okay, you can pause the video and you can cross verify. But we are not concerned with computational aspect, we are only concerned with concepts. Through the example or through the questions, we are trying to get deeper insight of the concept, right? Next question. See, I have given a notes when frequency of the coupon payment non-annual, convert the data into periods and solve the problem. Next, third question, mark it as important. See, value of a bond, different cost of capital. That is also possible. Sometimes the interest rate, a discount rate, okay, will not be same for all the years. See in this question what is happening. What is the value of 5-year 5.8% coupon bond if the appropriate discount rate is like this, given like this, face value is given. Very simple, you have to find present value of the future cash flows discounted at required rate of return of the bondholders. That we already know, right? So if we see here value of the bond, we can find out by discounting the cash flows. That is not an issue. But only issue is what discount rate you will use. Here, okay, we have not used one common rate. Can you use the discount rate of 5 years for all the 5 years? No. I'll tell you why the discount rate differs for all these years. You might ask. Very simple. See, the discount rate represents risk. What I told? Discount rate represents risk. In that case, what is happening? Risk arises from 2 things. One is that, okay, the institutional risk, which means the risk will change from the institution which is issuing the bonds. For example, Government of India bond is less risky than the Reliance Industries bonds, okay, or corporate bonds. Government of India bonds is less risky than the corporate bonds. Why? Because it is assured by the government. So you have less uncertainty regarding those bonds, right? The uncertainty is less, so the risk is also less. This is called as institutional risk. It depends on the institution which is issuing the bond. Okay, then there is term risk. What is term risk? I already explained the time value of money. Okay, you can see that video. I've explained how time value of money. Now, the interest is a compensation for two things. One is risk and then inflation. Now, higher the term of the bond. For example, 1 year maturity bond or 2 year maturity bond will not have same risk. Okay, because if you go to the State Bank or any bank, okay, they will put up the interest rate table. Okay, you can see outside the bank, you can see there what is the quoted interest rate. They will be giving the 1 year interest rate is 7%, 2 year interest rate, okay, is something 8.5%, 3 year interest rate 9%. Like this, the interest rate varies according to the term of the bond. The interest rate will vary according to term of the bond. Same way, FD also, you see now, if you put the money in FD, 1 year FD rate will be same. State Bank only will be offering, or same bank will be offering. In the same bank, if you see, institute is same, but still for varying maturity period, they will offer varying interest rate. Okay, if you see for 1 year deposit rate will be say 7%, 2 year deposit rate will be 7.5%, say 3 year deposit, same person, if you invest for 3 years, you will earn higher interest rate. Like this is called as term structure of the instrument, term structure of fixed deposit. Now fixed deposit will be there. Bond, similarly, bond will also have the similar type of term structure. It is called as term structure. Okay, now why the interest rate is different, you need to understand. It is a compensation because the risk arises now. Okay, the risk arises because of the term of the instrument, which means higher the maturity, higher the risk. Okay, why? Because it is even further far away now. So the uncertainty will increase. I've explained in the time value of money itself. So for example, if you are going to receive the money after 1 year now, it is near. If I say you are going to receive money after 5 years now, obviously you need to compensate for me because it is more uncertain. The more the uncertainty, higher the risk. Higher the risk, higher the discount rate should be used, or higher the required rate of return or interest rate the bank needs to offer to compensate. So we are depositing for 5 years now. We are committing our money for 5 years now. The bank should offer higher interest rate than the 1 year interest rate. Yeah, for 1 year you will get 5.9. For 5 years you are getting 7.3. This is the overall understanding. Now, how to practically solve this question? See here, how to compute the discounting factor. See, very simple. What do you do? Okay, first year cash flow. Year 1 cash flow is there na 5.8. What you will do? Take the calculator and you can see first year cash flow you discount using 5.9%. Correct? Upper 1 divided by 1.059 is equal to, you will get 0.944. Correct? Second year cash flow, you will not, if you do, okay, 1 divided by 1.064. Okay, time value of money, you can go and verify that video. I'm not explaining again and again how to use the calculator and all. I assume you all know that. So 1 divided by 1.064, right, is equal to, if you press 2 times, okay, what you will get is 2 year discounting at the same 6.4%. That we don't need. Okay, what we require is that first year the cash flow should be discounted by 5.9%. Second year cash flow should be discounted by 6.4%. In that case, what you will do? Okay, the second year cash flow is there now. You will discount it using second year discount rate and bring it to first year. Then discount using 5.9, bring it to present value terms. Very simple. I will explain it here. See, it is year 0. This is year 5. Okay, 1, 2, 3, 4 and 5. Now see, the 5.9% was there now. This is the first year discount rate. So what you will do? First year cash flow, you will bring it discount and bring it to present value terms. Then second year cash flow using 5.9%. Second year cash flow, you will bring it to first year using the discount rate of 6.4%. That is given in the question. 6.4% is only given in the question, right? Yes, 6.4%. So you will bring it to present value, first year end. Then from that, again you bring first year end cash flow, discounted cash flow to year 0 using 5.9%. Are you all getting how to do it? Then third year cash flow. What is the third year cash flow here? 6.6%. What do? You bring it to second year by using 6.6%. Then from second year you discount using 6.4% and bring it to first year, and from first year you discount again using 5.9% and bring it to year 0 and find the present value as of today. Right? This is how you will compute. So just for calculation purpose, how to use calculation? Very simple. 1 divided by 1.064. Say we are taking second year cash flow. 1 divided by 1.064. How much is that? 0.939. Now this 0.939 you should multiply to bring the cash flow to present value term. Understood? So from bring it to year 1. From year 1 you bring it to year 0 at what rate? At what rate? 5.9%. The factor for it is 0.944. So what you do? Year 2 present value factor is there now. So 1 divided by 1.064 is there. This is year 2's present value factor. Then you multiply it with year 1 present value factor. 1 divided by 1.059, which you already computed as 0.944, which means 1 divided by 1.064 is 0.939 into 1.059 is equal to into into 1 divided by 1.059 or 0.944 is how much? 0.887. That is how we compute it. Okay, third year now. First, what we know for tell me one last example for third year. How you should do? First, third year discounting rate you should compute 1 divided by 6.6. 1 divided by 1.066 into 1 divided by 1.064. Okay, the third year discounting, second year discounting. Then there is first year discounting. You multiply it 1.059. 5.9% is interest rate. Yes. Now you will get 8.833. This is how you compute the discount rate. So I have given the notes also. Discount rate represents risk, institution risk and term risk. Okay, fourth year cash flow is risky than fifth year cash flow. In this problem, we have multiple discount rates for different years as the institution is same, but the term risk is higher. Term risk is different, right? And it is wrong to compute how you compute. I have given. Go through. Okay, you can easily go through. Now take question number 4 for discussion. This is also marked as important. See, all the questions which I have added in the revision lectures are very important because only if you do these questions alone is also sufficient. All other questions you can solve easily on your own. Right? Next, see. AFM Industries is planning to issue a debenture series on the following terms. Face value is 100. Term of the maturity is 10 years. Yearly coupon rates are as follows. Year 1 to 4, 5 to 8 different coupon, 9 to 10, 14 coupon. See, in the question itself I have given the differing coupon rates. Okay, how to compute value of the bond if the bond is offering differing coupon rates. Okay. Now, the current market rate on the similar debenture is 15% per annum. The company proposes to price the issue in such a manner that it can yield a 16% compounded rate of return to the investors. The company also proposes to redeem the debenture at 5% premium. Okay, redemption they have specifically given. In this question, you should not assume it is redeemed at par. You should take the value as it is. Okay, 5% premium they have given now. That you should take. Determine the issue price of the debentures. This is a question that is being asked. See, in this question, the company is coming with an IPO of bond issue. Okay, they are coming with a new fresh issue of this bond. What they are doing now, 3 things they are doing to attract the investors. See, whenever the company comes with this new issue, 2 things will happen. One is that it needs to make sure that the bonds get fully subscribed, as well as, if the bond is, underpriced, if the bond is kept at a lower price, the bond will get subscription. Okay, so it will get subscription. If you offer a higher return, the bond price will be, which means if you price the bond at a lower price, suppose if the face value of the bond is 100 rupees, if you price the bond at a discounted price of 90 rupees, what will happen? More investors will get attracted to this bond. It is available, discount bond, it is available for a lesser rate. Coupon is also fixed, you will earn ready-made capital. So it is very attractive. But and the more the demand of the bond will be, the more the subscription will be. People will subscribe to the bond. The only issue is that if you offer the bond at a discounted price, subscription will be there. Okay, it will be fully subscribed. But the problem is your cost of capital will be so high. Are you understanding? Which means you are offering a higher return for the bondholders, right? If you are giving a coupon, what is a coupon? Per coupon some rate, assume 10% is a stagnant coupon. Okay, assume. Then you are offering ready-made capital gains also, 10 rupees for a period of 3 years also. Say it is 4%, coming to some roughly 4%. So your ready-made return you are offering, the company is offering 14% of the return from the bond. Okay, this is what they are offering, which means instead of 10% coupon, okay, you are offering 14% now, which means it will increase your cost of capital. That is the problem. But if you don't offer, in such a way that it compensates the required rate of return of the bondholders, what will happen? The bond issue will get undersubscribed. So there are 2 things will happen. So the company needs to balance and take informed decision whether to, it needs to take a call at what price. That's why the issue price is also very important, because the issue should not get undersubscribed, as well as it should not increase the cost of capital too much for the company. Are you understanding? So there should be a balance. That is what this company is doing. So the company are coming up with this issue. 3 things they are using. See here. One is that there is increasing coupon rate from 9%. First 4 years, 9%. Next 5 to 8 years, they are offering higher rate. Correct? Next they are offering 14% bracket. 9 to 10, 2 years, last 2 years, they are offering 14%, which means they are luring the investors so that the investors are locked in for longer period of, not the, if you hold only for 4 years, you will earn only 9% coupon. So they are offering investors a higher coupon rate for the longer period. This is one thing they are doing. So this is step by step they are increasing coupon rate. This is one thing. Second thing they are doing is that market similar interest rate is 15%. In the market, as per the general interest rate, the yield is going at 15% rate. Okay, the yield and market interest rate is different. Okay, are you understanding? I will explain it later. After the entire revision video, okay, you will learn everything. Now, initially, you should give me some time to explain more and more terminologies so that you will get comfortable with the later these things. Okay, the nuances of the bond market, right? So 15% is the market interest rate. Now they are giving the return of 16%, which means even higher than the market interest rate. How to do that? Very simple. Okay, they are redeeming at premium. Okay, they are offering 16% yield. The yield comes from three things. One is that, two things the yield comes from. One is the interest, coupon. And the coupon is increasing coupon. They are offering increasing coupon. Second thing is capital gains also. They are offering, redemption is happening at premium. Okay, issuing at par and redeeming at premium. That also is happening. So the capital 5% premium, 5% premium, 100 rupees, 5% premium is how much? 105. So redemption is happening at 105. See here, cash flow I put it, 105, redemption is happening. They are redeeming at premium. So that is there. So they are offering these two things to increase the return even more than the market interest rate. Market interest rate is only 15%, but they are trying to price the bond. They are trying to issue the bond at such a price that it will yield a higher return, even higher than the market interest rate of 15%. See here. So we will discount the cash flow. So very simple question, only discussion is taking time. If you see, solving question is not the issue. You can directly tell 1 to 4 coupon rate 9%. Discount rate will be same. Unlike the previous question, discount rate is not differing from year to year. It is not different for all the years. The discount rate is same. Okay, so which means here 1 to 4 you take coupon 9 rupees, 10 rupees, 14 rupees. Just apply the coupon rate to face value. You will get the rate. Okay, so finding the discounted cash flow is not difficult. Okay, that is not the main issue. The only thing what you learn from this question is, okay, one is that company can come up with lucrative issues that it can issue it can offer redemption price higher than the issue price and offer the capital gains portion, which will make the return, required rate of return, the return which the bond is offering can be higher than the market interest rate. That is observation number one. Second observation is that, okay, the coupon rate will never be same. The coupon rate need not be same for all the years. It can be different. Okay, varying coupon rates also can be offered by the company. These are the two things which you learn. Notes I have given, please go through. Okay, let's continue with our next topic, yield to maturity, that is YTM. What do you mean by YTM? See, YTM is the return which the bond investor will earn if he invests at current market price and if he holds this bond till maturity, which means, see, for example, I'll explain it like this. See, you can subscribe to the issue of the bond in two ways. One is that you can buy the bond from open market. When the bond is listed in the stock exchanges, you can buy the bond from stock market. That is method one. Okay, we have two methods. Method one is that you buy from stock exchange. Okay. Method two is that you can also buy the bond from the company itself, which means initially they will come up with the IPO. The previous question we saw, a company wants to come up with a public issue. Okay, so you can directly subscribe to the bond from the company itself. Now, in the first case, you should understand here your market price of the bond will be your subscription price. Market price of the bond will be your subscription price. In this case, okay, the issue price will be the subscription price, which means if the company issues 100 face value bond for 90 rupees, so if it issues for 90 rupees, then 90 rupees becomes your subscription price. And if the same bond is trading in the market for 95, that becomes your subscription price. So whether it is listed bond, whether it is listed in stock exchange, or whether it is issued by directly by the company, your purchase price you will consider. Are you understanding? So first thing is that YTM, what does YTM mean? See, is nothing but the yield you will earn from the date of purchase till the maturity. Okay, you purchase the bond from open market or from the company. Okay, in either case you will have some purchase price na. From this price, this is your outflow. Year 0, this amount becomes outflow. Okay, and if you hold the bond till maturity, the IRR of the bond cash flows from today to maturity becomes the yield to maturity. This is called as yield to maturity. If I purchase the bond at current price, either it might be subscription price or from the open market, if I purchase the bond at current price and if I hold the bond till maturity, what return I will earn is called as yield to maturity. Very simple. Okay, now we have two methods to calculate this yield to maturity. YTM is the yield the bondholder earns for the bond at a given price. Okay, if it is quoted in the market, the market price you will take, otherwise the subscription price if you take. Okay, if he holds the bond till maturity, which means the coupons, in between coupons will be considered and the redemption price will be considered, because bond will be redeemed by the company itself. So these cash flows will be calculated. See, yield will be earned from bond through two sources. I already discussed the return from the bond will be earned by two sources. One is that coupon, interest, yearly coupon which you will earn, and then capital gains or loss. It might also be loss. It depends on situation to situation. Either the bond can be issued at discount and redeemed at par. To have a capital gain, either the bond should have been issued at discount and redeemed at par, or issued at par and redeemed at premium, or anything. Okay, any case. Okay, it issued at discount and redeemed at premium, that is also possible. So bumper capital gain, that is also possible. So all these scenarios are possible with regards to capital gains. Capital loss is also possible. How? Because issued at premium and redeemed at par, that is also possible. Of course, we have questions regarding that also. So anything is possible, capital gains or capital loss, which means if you have capital gain, if you have capital loss, it will erode your coupon income. If you are capital gain, then it will add to your coupon income and you will earn a higher return than your coupon. So roughly speaking, the yield the return which you will earn from the bond cash flows is known as YTM. But only condition is that if you have to hold till maturity, then only actually you will get to know at what price it is being redeemed. The redemption will form part of the cash flow only when you hold till maturity. If in between itself you throw the bond in the market, you sell the bond in open market, then you will not get redeemed by the company. You will not get the redemption value. Whatever is the quoted market price on that day when you are selling, that becomes your amount. So yield to maturity you cannot accurately calculate today itself. Are you understanding? So whenever you see the listed bond, okay, you will surely can see the yield to maturity as of today. Why as of today? The market price of the bond will also keep on changing. Okay, it will not be same price. Today it might be some price, tomorrow it might be some other price. So when you are computing yield, okay, if there is any price change, actually the yield will also accordingly adjust. So yield will be given. Why? Because your purchase price will change. This is the thing. Okay, there are two formulas available here. The approximate method, how to compute YTM. YTM is nothing but IR. See, in reality what we are seeing, bond triangle. Okay, the entire chapter if you see the valuation aspect, see here you have YTM on one side, cash flows, okay, expected cash flows from the bond, okay, and then you have the bond price or the fair value. Understood? So what is happening now? This is cash flow from the bond, and you discount the cash flow using YTM. YTM is nothing but discount rate. Okay, I told you what is value of the bond as per the discounted cash flow method, present value of future cash flows discounted at required rate of return of bondholders. The required rate of return of the bondholders is nothing but YTM. So you can also say like this, bond value is nothing but present value of the future cash flows discounted at YTM. Are you understanding? So this is bond value is a function of three things. One is that cash flows will be there. That cash flow, if you discount using YTM, you will arrive at fair price. Understood? Now in the previous segment, when we computed value, when the question is about valuation, they will give you YTM, they will give you discount rate. Remember, question number 1 lab, we have been given the discount rate at 15%. Remembering? Okay, 11% was the coupon rate, and they have asked that you require 15% discount, you require 15% rate of return. What you will do? What is the bond value? They have asked in the first question. If you notice, the YTM they have given 15% is the required rate of return or YTM they have given in the question. Cash flows will be surely given for any question. Yeah, there is no doubt, because cash flows, fixed income securities, the cash flows will be fixed in nature. Coupon percentage will be given, correct? Redemption value will be given, and issue price will be given, or market price will be given. Are you all understanding? The price at which you are buying so the cash flows which you will receive, whatever the yearly coupon and whatever is the redemption, everything will be given there as cash flows. That will be given. So YTM will be given, cash flows will be given, price of fair value you should compute in the valuation question. Now, YTM, when they give question of YTM, ideally they should give the other two data, na? That is what we will get. Okay, cash flows data they will give. Obviously, for every question they will give. Price also they will give. Whether it is quoted market price or issue price, they will surely give the details. Okay, redemption, what price it is going to be get redeemed, and what price the company is issuing the bond. These details will be given, so that you have cash flows and you have price, and you will find IRR from this bond cash flows. Are you understanding? Now to find YTM, YTM is nothing but IRR only. How you found IRR? Okay, IRR is the accurate method to find YTM, but you need to do interpolation and get accurate rate now. Before that, to get approximate rate, see, question in examination question, they might give you two different rates. Suppose if they give you present value factor at 8% and present value factor 10%, now you should obviously understand the YTM falls between these two numbers, and they might give these two numbers, any two present value factors, they might give the data for that. Or if they did not mention anything, first what you do, you have to interpolate. For that you have to take two rates, okay, and between that YTM will fall. So how you will think, na? What you should do, see, first you should apply approximate formula first, then arrive at some approximate rate. Okay, then you will plus or minus 1% here and there you will take and do interpolation. Shall we see that question? See, very simple. First we will learn approximate formula. What is this approximate formula all about? See here, interest plus Rp minus Sp divided by N, the whole divided by Rp plus Sp by 2. Very simple. I'll show you here. Okay, what is happening? Interest, okay, plus amortization divided by the subscription price. Okay, average subscription price. This is how you compute YTM approximately. See, very simple. Interest, annual interest you will gain. Na? What are the returns for any yield return? How you compute? Return divided by capital, correct? Return on capital employed or return on equity, anything. When you compute some ratio, na, return ratios, return divided by the amount, correct? Now here, what is the return you will get from the bond? One is that interest, okay, or coupon. The other thing is amortized portion of the capital gains. Okay, capital gains you will earn, na. But so suppose if you are if your bond is having a face value of 1,000 and it is issued at par, so you bought it at 1,000 and then redeemed at premium 1,020 you have redeemed. So capital gains is 20 rupees, na. This 20 rupees, assume this is 4-year bond. Okay, so this 20 rupees is earned in single year or over a period of 4 years, over a period of 4 years, which means you have to. This is capital gains, agreed, but you have to amortize it for each year. So amortized capital gains only you will consider for yearly return. YTM is a measure for yearly return, na? Yield per annum. What is YTM? See, any yield is given, na? YTM, say YTM is 8%. Now what do you mean? What YTM is 8% per annum. So YTM is nothing but average yield per annum for these many number of years. Are you understanding? 4 years bond is there. YTM of this bond is 8%. What do you mean by that? Okay, how to interpret this? YTM is that nothing but yield earned per annum, 8% yield per annum on an average. So average yield per annum for maturity period, 4 years or 3 years or whatever may be the maturity period. Are you all understanding? So here we have interest portion, amortized capital gains portion, right, divided by subscription price at which you price. That is the base now from which you have to compute return, for which you have to compute return, how much you have gained, right? So this now amortization they have, that is only they have explained here. See here, R redemption value minus subscription value by N. This is amortization. Say 4-year bond you are having. So here 4-year bond, redemption value is 1,020 minus subscription value is 1,000. This capital gain 20 is earned over a period of 4 years, which means 20 by 4 you will get it as 5 now. Okay, so assume the interest rate is 10% and 10 plus 5, 15% is the yield on an average. If your average subscription price is, okay, 10 plus 20 divided by 2, 1,010. Okay, 1,010. Like this you should 15 by 1,010. What is the amount? 15 divided by 1,010. So you will get 1.48% or something. This is the yield. Okay, this is the yield. Now 1,000, okay, 1,010%, 100%. So 115 by 1010. How much is that? 11.38. 11.38% is the approximate rate. Okay, this is how you will compute YTM, right? This just to show you. Okay. Now you know how to compute YTM. See the formula: interest plus amortization. Amortization is only written as RP minus SP. What is RP? Redemption price or redemption value also you can write, minus subscription price, the price at which you bought. See here, whenever you are not buying directly from the company, then what will happen? The subscription price will become market price, the price at which you bought the bond. Okay, then number of years to be taken, amortization, okay? N represents number of years, then RP plus SP by 2, which means simple average you will take as denominator and you will find the approximate YTM using this formula. Now just in question number 1 also we concluded this. Remember, first using this formula calculate approximate yield and then use trial and error method, just IRR method, and do interpolation and compute accurate YTM. See, when I compute YTM and then find that YTM is equal to exactly coupon, now what it means? Bond trading at par, it will earn only coupon, there will be no capital gain, then YTM is equal to coupon. In that example I showed you IRR is equal to coupon. Now you don't need to worry, IRR and YTM is the same. In this bond valuation chapter, you should understand it at IRR, okay, the return which you will earn if you hold the bond till maturity. Only condition is that you should hold the bond till maturity. See, if the bond is trading at par, also consider it is redeemed at par, then YTM is equal to coupon. Why? Because there will be no capital gains, you will only earn coupon. Then bond trading at discount, YTM more than coupon, and bond trading at premium, YTM less than coupon. I already explained this. See, we'll solve a question and then come back to realized YTM. Realized YTM is little bit in-depth concept is involved. First what we do, we will do this question number 5, and this question is a comprehensive question. See, in this question, yes, we have this question, we have realized yield, duration, all these things are there. Okay, so what we will do, first we will calculate YTM. Okay, YTM of the bond alone I will calculate so that I can show you how the YTM is worked out, right? See, in this bond, you will take this example, question number 5. This question number 5 will be solved in different concepts. See, under realized YTM also I will come back and discuss this question. Concept clarifying question, very good question. I have given also May 18 RTP, very, very important question. Okay, realized yield concept will be very well explained here. See, Excel Ispat Limited has made an issue of 14% non-convertible debentures on January 1, 2007. These debentures have face value of 100 and it is currently traded in the market at a price of 90. Interest on these NCDs will be paid through post-dated checks dated June 30 and December 31. Interest payments for first 3 years will be paid in advance through post-dated checks, while for the last 2 years post-dated checks will be issued at the end of third year. The bond is redeemable at par on December 31, 2011. At the end of 5 years. See, the maturity period of this bond is 5 years. To start with, maturity period of the bond is 5 years and 14% coupon paying bond, and if you notice it is semi-annual coupon paying bond. What you should do, if they ask a semi-annual coupon paying bond, what you should do, you should convert the entire question into periods and solve this as per the periods. Okay, number of periods involved, which means number of years, 5 years. Is this question asking about 5 years? Yes, the bond is having maturity of 5 years. Then you convert this into 10 periods, 10 semi-annual period, and then solve all the question. That's how they have also done. See, current yield will come back after current yield, we will discuss it later. Now come back to YTM. Okay, here YTM they have calculated. How to compute YTM? Very simple. If you if you use the approximate formula, I don't want to use here approximate formula because question itself gave you 7.5 and 9%. Okay, in this question I have not added the data, but they have given that 7.5 and 9% assume. So if I solve the question, I get approximate YTM. You can go home and verify. You can verify this. I approximately will get something around 7.6 or 7%. I don't remember, but you will get the approximate rate. What you should do, you will take 7.5% discounting rate and 9% discounting rate and find the present value of this bond or value of this bond and do interpolation in such a way that the discounted cash inflow becomes equals to discounted cash outflow, or your NPV is equal to 0. What is NPV? Is nothing but discounted cash outflow inflow minus discounted cash outflow. Are you understanding? See, they have given period 0, year 0, you will have minus 90. What is minus 90? 90 rupees is the outflow. Why 90 rupees is outflow? Market price of 90. Are you understanding? Which means they are not buying from the company. They are buying from open market. Okay, the market price becomes the subscription price. You are buying this for a price of 90 rupees. You are paying 90 rupees and buying this bond. So what is happening? Year 0, 90 rupees is your outflow. Then year 1 to 5, which means 10 periods. Okay, period 1 to 10 periods. We have 777 coupon. Why 7 coupon? 14% was the yearly interest. You convert the data into period. So 7 is the semi-annual coupon rate. Upper 7% will be the semi-annual coupon rate, right? And the discounting rate also changes. You see here, discounting rate also Okay, we need to find out. When we find out, okay, we need to find out using two different rates, that is 7.5 and 9%. In reality, 7.5, 15 and 18% they have taken. Correct? This is semi-annually. Semi-annually, they have converted the data and put it into 7.5 and 9%. Very simple. Then you find the discounted cash outflow. The total comes to discounted cash inflow. This 6.560 is nothing but minus 90 they have considered. But minus 90 plus all these comes to 6.5. So 6.560 is the discounted cash inflow minus discounted cash outflow. Here also minus 90. Okay, discounted cash inflow is total is total minus 90, you will get minus 2.888. You are getting minus 2.888. Now, what they have done, already this is NPV, but we require NPV of 6.560, 2.888, we require NPV of 0, which means at 7.5% discounting rate, we arrive at the NPV of 6.560. But if we increase the YTM to 9%, we arrive at NPV as 2.88%, which means our NPV, we need NPV of 0. Something which is falling between 6.5 positive 6.56 and minus 2.88, we should do interpolation. See, very simple. I'll put it like this. 7.50. Very simple. See here. If your YTM is 7.50, okay, 7.5%, the NPV is equal to 6.56. What is the number? Yes, 6.56. Now, if your YTM is 9%, the NPV becomes minus 2.88. Correct? Now, how to interpolate? I'm showing you how to interpolation. See here. So, from 7.5, E increase, you see, YTM, NPV. Okay? What you need is that first, if you increase the YTM by 1.5%, are you all understanding? If you increase the YTM by 1.5%, obviously if you increase the YTM, bond price will fall. I explained you in the first segment itself, I explained you that if you increase the YTM, they are inversely related. YTM and price of the bond are inversely related, value or price of the bond. If you increase the YTM, price will decrease. If you decrease the YTM, price or value will be increased. Now see, if YTM is increased to 1.5% in present case, what is happening? Your NPV from 6.56, it drops to 2.88. How much is that drop? See, 6.56 minus 2.88, which means it drops from 6.56 to minus 2.88. You need to add 6.56 plus 2.88, minus plus. So how much is that? 9.44. So, which means if you add 1.5% of YTM, the NPV will reduce to 9.44. We want, what is our target NPV? 0. Are you understanding? Our target NPV should be 0, so that is the NPV at which IRR we will get. Correct? The discounted cash inflow will be equal to discounted cash outflow. Right? So in that case, we want our NPV to be 0. But which means now we have 6.56 now at 7.5%. How much is to be reduced? We should only reduce to the extent of exactly 6.56 to get it to 0. From 6.56 at 7.5%, our NPV was 6.56. We need to reduce it in such a manner that it will become 0. How much then it should be reduced? 6.56. So we need to reduce not 9.44, only 6.56. So for that, how much it should be increased? YTM should not be increased 1.5%, something less than 1.5%. How much is that? Very simple. 1.5 into 6.56. See here, 1.5 into 6.56 divided by 9.44. Divided by 9.44. How much is that? 1.04. One second. 1.5 into 6.56 divided by 9.44. How much is that? 1.04. So 1.042%. Okay. So which means you should increase only 1.042%. Okay. I hope you understood this calculation. Very simple. Earlier we increased 1.5 na. From 1.5 if we increase, we will get 9.44 decrease. We don't require 9.44 decrease in the price. We only require in the NPV. We only require to reduce the NPV by 6.56. So in that case, 1.5 into 6.56 by 9.56. So what does it mean? 1.042% you should add, which means 7.5. So ultimately YTM as per IRR method is nothing but 7.5% plus 1.042%. How much is that? 7.5 plus 1.042 8.542. 8.542% is our IRR. Are you all understanding? See here, they have given now, we do interpolation 8.54%. Okay, this is how they have computed. You can go through simply, right? So this is all about YTM. Okay, approximate method you can try. Approximate method you will do just for arriving at approximate rate for doing interpolation for interpolation. Once you get some approximate number, you will definitely do interpolation, find accurate number. It is always recommended to find IRR, use IRR method and find accurate number. It is not so hard. Okay, approximate formula you can quickly do that. You can show both the presentation in the examination. It will take hardly 2 minutes time. Approximate calculation, it will take formula based calculation. It will take only 2 minutes time. Then you will get realistic two numbers within which you will get the accurate IRR, right? I also showed you how to interpolate the result. Next. Now we will move on to the concept called as realized YTM. We will discuss realized YTM concept, and then we will discuss current yield. Then we will together do this big question. Okay, this is a concept clarifying question. We solved already YTM for this question. We will come back again to the question number 5 and solve realized YTM. But before that, we need to understand what is realized yield to maturity. See, what is realized yield to maturity? What is the difference between yield to maturity and realized yield to maturity? That is what is the core issue here. Yield to maturity is the yield which you will earn. Carefully listen. Okay, yield to maturity or YTM is nothing but the yield or return which you will earn if you hold the bond till maturity from today. Correct? Realized YTM is, see, YTM is what the bond gives. Realized YTM is what the bond ultimately, bondholder what realizes, what he realizes. Which means, what are you saying? The YTM is fixed. Whenever you are buying the security, you will know the YTM. Okay, why? Because you know at what price you are going to buy. If you buy that at that price, you know what is the redemption value and you will know what is YTM. Correct? So, what are you saying? Why realized YTM will be something different than YTM? What is the issue? See, YTM is there, na? It has an underlying assumption that if you want to realize the YTM, which means if you want to earn the YTM, yes, YTM is the yield which will be quoted. Whenever we are going to purchase the bond, YTM will be known. Okay, but in order to actually realize the YTM, now there is some assumption, underlying assumption in the YTM you need to understand. Very simple. If I say that a YTM of a bond is 8%, what is happening? Every year you get coupon from the bond and you will get some redemption. Correct? You will find the present value. If you discount at YTM, you will arrive at the value. Right. Now what I am trying to make you understand is that the YTM, okay, in order to actually earn the YTM or realize the YTM, you should reinvest the YTM, reinvest the intermediate coupon at the same rate of the YTM. Very simple. I'll take example, question number 1 for example. See here, in question number 1, if you don't remember, I'll just again tell you the facts. The investor invested 86.59 or 86.57, any number here, okay, 86.57, and received from the company rupees 11 as coupon every year for 5 years and 100 rupees redemption at the end of 5th year. Correct? The bond has given a yield of 15%. This we computed. This is YTM. Correct? But there is one underlying assumption of the YTM that in order to actually earn the YTM, you should reinvest the intermediate coupon at the same rate of YTM. What are you telling? I don't understand. You are saying very simple. I will explain this with see here. See, you have 5-year bond. What is the life of this bond? 5 years bond. Very simple. If you take a bond having 5-year maturity period, realized YTM. Okay. See here. You are having a bond maturity of 0, 1, 2, 3, 4 and 5. Now carefully observe. You bought the bond by giving 86.57 rupees. Example number 1 I am explaining. Question number 1 I am again revisiting and trying to explain this concept. Are you listening? Okay. See here. 86.57 you have invested the bond. Invested and bought the bond. Correct? Now every year, what are the cash flows you tell me? Every year you are getting 11 coupon, 11 rupees, here 11 rupees, here 11 rupees, here 11 rupees, and at the end of maturity you will get how much? 111, because 11 rupees coupon will also be credited and then the bond will be redeemed at par, 100 rupees. So net you will get total 111 rupees, right? Now you bought it at 86.57. If this is the case, you will earn required rate of return of 15%. That is what they told. Correct? In the first question, they have given the YTM data. 15% is the YTM. They have given the data. Now we need to revisit the question and understand what is happening really. See, the 86.57 is the invested amount. After that, every year you are getting 11 rupees. you will put it in the pocket, you will reinvest that amount. Every year, at the year end, you are getting interest. Coupon is nothing but interest. Every year, for holding the bond, they are giving interest. It's like dividend. If you hold the shares, you will receive dividend. Same way, if you hold the bond, debt security, you will receive some interest. What you will do with the interest? Give it to beggar, put it in pocket, or reinvest. Reinvest. When you reinvest, this is the fundamental assumption of the YTM. In order to realize the YTM ultimately at the end of the 5th year, you need to keep on reinvesting the intermediate coupon at the same rate of YTM, which means 11 rupees I am getting now. You should put it at 15%. For how many years? 4 years. See, at the end of first year only, you are getting this 11%. Balance amount till maturity is 4 years. Are you understanding? So 4 years you will reinvest this 11 rupees at 15%. Same way, year 2 end, you are receiving 11 rupees. That 11 rupees, again what you will do, you will reinvest. For how many years? 3 years this time. 3 years. Okay, for at how much rate? 15%. Then third year 11 rupees coupon you will get. Put it in pocket, give it to beggar, reinvest. At what rate? Okay, 15%. For how many years? 2 years. 11 rupees at the end of 4th year, you will invest for 1 year at 15%. Are you understanding? And net the last year, you will receive some cash flow. That will be the cash flow received at the end of 5th year. How much is that? We will see. See here, I have given you everything. No need to worry. Okay, all this I have given us typed notes. You can go and verify. This is notes I am trying to explain the concept. See here, coupon, first year end coupon you will receive 11 rupees coupon. That is future value factor compounding, time value of money. We already discussed that. 1.15 raised to the power 4. This will give us compounded cash flow, which means this is nothing but cash flow at the end of 5th year for this 11 rupees. Then this second year 11 rupees you are receiving and investing for 3 years 15%. 1.15, 15% raised to the power 3 3 years. For 3 years you are reinvesting. How much is that compounded value? 16.73. That also you take it here. Okay, you go take it to the future value. Then you have 11 rupees coupon of third year, which reinvested for 2 years at 15%. The maturity value will be 14.55. Next to 4th year 11 rupees, which you reinvest for 1 year, 15 rupees, 12.65. Okay, 5th year 111 rupees you will realize on at the end of 5th year. You reinvest no use, because you are going to realize the same year So anything raised to the power 0 is nothing but 1. So 1.15 raised to the power 0 is 1. 111 will be the maturity value of the at the end of year 5. So if you total, very simple, if you total all these 19.24 plus 16.73 plus 14.55 plus 12.65 plus 111, the total maturity value, today you started with investing how much rupees? 86.59 and got the bond, correct? And whenever you receive the intermediate coupon, whenever you receive the in between coupons, before 5 years is the maturity period, and each year end you are receiving some 11 rupees coupon, that you are putting it to use. You are again putting that money to investing in the bank, FD or some instrument which is yielding 15% return. In that case, your maturity value, the ultimate maturity value will be how much? 174.16. Now you started. Now how to find IRR? How to find the compounded rate of return for the cash flow given? See, first year you invested, year 0 you invested 86.59, and year 5 it has grown. After all this reinvesting at same rate, it has grown to 174.16, which means, okay, now your outflow is 86.59 year 0, year 5 inflow is 174.16. How to compute? This is the future value. This is the maturity value or future value, correct? Now, future value is equal to present value is 1 plus r raised to the power n. Using this simple compounding formula, what you will find? You will find rate of return. At what rate it has compounded my money. Okay, you have invested 86.59. Ultimately, you have at the end of 5th year 174.16, which means how to find CAGR. We call it as CAGR. CAGR nothing but compounded annual growth rate. At what rate it has compounded annually. See here, how to find this? Very simple. Future value is equal to present value 1 plus r raised to the power n. Rearrange it, you will get, okay, 1 plus r raised to the power n is equal to future value by present value is nothing but 2.0113, right? And then r is equal to nth root of 2.0113 minus 1, right? How to find nth, here n is 5 years, fifth root of 2.0113. How you will find, you have to use calculator. I have given you how to find is also, that is not relevant. I will come back to calculation later. First I will finish the discussion. See here, by calculating, we will get a final answer of 15%, which means it is same as the YTM. Yeah? Are you understanding? To our surprise, we see that, okay, our ultimately compounded annual growth rate is there. It is exactly same as the YTM, which means what you can infer from this, So in order to realize the yield is quoting in the market at 15%. But in order to actually realize the yield or YTM, I need to reinvest the intermediate cash flow, which is coupon. Coupon is the intermediate cash flow, which means 5 years the maturity period. Every year you are getting coupon. That intermediate cash flow, I need to reinvest at the same rate of the YTM. This is the underlying assumption. Intermediate also, there is a concept called as IRR. IRR, you have something called as modified IRR and modified NPV. That concept will be there, okay, at the end of the capital budgeting chapter, wherein you will see IRR has inherent assumption that the reinvestment will happen also the same rate of IRR. Same way here also, YTM also is having same YTM and IRR is the same thing I told you na. So assumption is that YTM should be reinvested there. If you sit idle na, you will never realize. It is something I will give an example to understand it more diligently. See, you should understand this concept like teaching only. If I teach you, okay, 100% of the concept, and if you revised it properly, if you revised and 100% of the concept properly, then you will score good marks in the examination. But conversely, despite me teaching all the concepts, okay, you only revised 60% of the portion. Are you understanding? Then ultimately in examination, you will not get the required marks, correct? If you don't revise, you will not get marks ideally. So, see, my teaching is like YTM, is where you start with. But that is not enough. You have to, the revision is like reinvestment. Okay, you should not keep the money idle. You have to you are receiving the intermediate coupon, you have to reinvest the coupon at the same rate of YTM. Then only you will ultimately realize the YTM. Are you understanding? This you can remember. Okay, see here, what the bond gives to the investor is the YTM, and what the bondholder ultimately earns is realized YTM. What is happening now? Suppose if you are not reinvesting at the same rate, suppose, see, very simple. The bond see here, the bond gives 15% YTM, and for the bondholder to realize the 15% YTM, he should reinvest the bond cash flows exactly YTM. If he reinvest it at different rate, which means less than 15%, assume the YTM when we purchased the bond at year 0, the YTM was say 8%. And when we try to reinvest after 2 years, the market interest rate, okay, if I go to the bank for reinvestment, they told that you can only invest at 6%. In that case, your reinvestment rate drops to 6% from 8%. Then your realized YTM will be more than 8%, less than 8%, less than 8%. It will never be more than 8%. Why? Because you have not reinvested the coupon at same rate. That is what I have summarized here. The relationship between YTM, realized YTM and reinvestment rate is summarized as follows. See here. So reinvestment rate is king, yeah. Okay, if you get some instrument by which you can reinvest the intermediate coupon in such a way that it can match the YTM, then you will realize fully the YTM. Okay, otherwise you will only earn less than the YTM rate. See here, realized reinvestment rate is more than YTM. Your realized YTM will be more than YTM. In our example, okay, assume I teach you 100% concept, you not only revised which were the portions or concepts which were taught by me, you also take so many foreign authors, you read so many books, okay, you started investing in markets, you gain experience, okay, and then you are appearing examination, you are fully thorough with the concepts, even more than what I taught you. In that case, what will happen? Okay, ultimately realized YTM will be even more than what you initially targeted. For example, if I teach you only 90%, you do even more hard work, then you will get 100% marks. Are you understanding? So that is something like this. When reinvestment rate is more than YTM, what will happen? Very simple. Realized YTM will also be more than YTM. Understand? That is also a possibility. Reinvestment rate is equal to YTM. Reinvestment rate is exactly matching as YTM. Now, realized YTM will also be YTM. That is what we explained. Then reinvestment rate is less than YTM. Then realized YTM will be ultimately less than the YTM. So this is a very beautiful concept of realized YTM. Okay, I will explain this once again through the question which we are going to solve, and I'll tell you what is the issue here. Right. One thing I missed here, calculation purpose, I told you, I will discuss it later. See, very simple, how to find nth root of some number, okay, without using the scientific calculator. You will not be allowed a scientific calculator. So how to find? So fifth root of 2.0113. What you should do? First you type the number which you want to find under root, right? That number you will write. Then press square root 15 times. Square root. Okay, the square root number is there now. 15 times you will press. Then what you will do? You will press -1. C, D now the steps A, B, C, D, E, like that. Without changing the order you should do. First you type 2.0113. Then you press square root 15 times. Then you, without changing any number, -1 you press. Then what you should do? You should divide it by the maturity period. The maturity period, no? The root, nth root you are going to find, the n. Okay, you should divide it by n. 5 is the n in this question, so you will divide it by 5. Then you press +1. Then into is equal to. First you put square root 15 times, na? You are squaring it up. Then you put into is equal to 15 times. You will get the number. Okay, you will really get the number. This is how you should use the calculator and find the nth root of any number, right? That's just a procedural aspect. Conceptually, we are done with realized YTM. Current yield is nothing but, okay, a small concept, just like a dividend yield. Dividend yield is when you invest in a share. Okay, what is the yield it is giving? How you will find dividend yield? Dividend per share divided by market price of the share. Same way here also, the yield, current yield, how will you find? The coupon rate or the coupon amount. If you take the coupon amount, coupon rate will be there. You multiply it with face value, you will get the coupon amount. That coupon amount, instead of finding, see, coupon, if you divide it by face value, you will get coupon percentage, coupon rate. Okay, simple, coupon divided by market price, you will get current yield. It is something very similar to dividend yield. Okay, this is used for finding underpricing or overpricing of the bond in general. Actually, it is not very useful, but it is also used. Dividend yield is used, same way this is also used. So this is nothing but coupon by current market price. CMP current. CMP means what? Current market price. It is similar to dividend yield from the share. It calculates the yield which you get as interest if you invest the bond at current market price. Okay, if you invest the bond at current price, what yield you are getting? What yield you are getting from the coupon alone? Okay, this will, see here, this will not consider capital gains, but this will not consider the returns or loss from the capital appreciation or depreciation of the bond, just like dividend yield does not capture the share price appreciation. Okay, redemption and initial subscription price will not be considered. Obviously, the return is only with respect to the coupon. Okay, what coupon is yielding is only captured by the current yield. This we have done. Right, now coming back to the question number 5. Question number 5. See, the first part we calculated, we calculated YTM. Current yield we will calculate. See, current yield in this question is very straightforward. 14% is per annum. So what we will do, we will convert the data into per period. Up 7 rupees is the interest per period. 7 by 10 into 12 by 6 you will convert and then find annualized current yield. This 15.55 is the annualized current yield. Okay, not semi-annual. We have converted the data. 12 by 6 we used and found out. Okay, 7 by 10 is the, sorry, but the printing mistake, 7 by 90 it should be. Okay, current market price, 7 by 90, make a change there, 7 by 90, right? You will find the current yield, no issues. That is straightforward. Come to realized YTM. This is the important discussion. Realized yield, yes, duration they have computed. I am not discussing duration now because we have not yet covered the concept, so I don't want to get into that concept. Come to a third part where they have asked realized yield. See from question, very important adjustment they have given in the question. So very simple, yield will be given in the question. We have computed the YTM. What was the YTM we computed from this question? Very simple, we have computed the YTM to be 8.54%. Okay, 8.54% per period. Right, 8.54% per period is the yield. Per period, again, you should carefully observe, this is not per annum yield. This is per period yield because we convert the data semi-annually. So the yield will also be per period only. Annually, if you want to convert 8.54 into 2, you can roughly say that 17.08 is annualized YTM. Now you have YTM in hand. Now, for computing realized YTM, you need two things. Bond cash flows will obviously be given. What is the coupon? They have given that. But you need reinvestment rate. Correct? The reinvestment rate, I told you, reinvestment rate is the king. Okay, while computing realized YTM. Because YTM is there obviously. But only when you know at what rate the intermediate cash flows or intermediate coupon is being reinvested. Put at what rate? Okay, reinvested at what rate? That data is important. Then only you can compute realized YTM. So whenever you are calculating realized YTM, whenever you are solving realized YTM question, you need to know what is the rate at which you are reinvesting the coupon. Correct? We will read the question carefully. See, two questions. Okay, duration is pending. We can solve later or you can do it on your own after we discuss duration. Come to third part. Calculate the realized yield. What is realized yield? Realized YTM on the NCD, assuming that intermediate coupons payment are not available for reinvestment. Are you carefully seeing this? Okay, this is the twist here, which means instead of giving the reinvestment rate, they have told you in a simple line, they have put that the intermediate coupons are not available for reinvestment, which means reinvestment rate is equal to 0%. Are you understanding? Your money is not at all reinvestable, or you assume you as an investor, you don't care about yield and all. Okay, you simply put it in the pocket. Whenever you receive coupon, put it in the pocket. You don't go to the bank, you're a lazy fellow, you don't go to the bank to reinvest, you just simply put it in the pocket and expect that you will realize the YTM. Assume the investor doesn't know the concept of realized YTM. In that case, he will put the entire coupon into the pocket every year. So that is what happened in this current question, that intermediate coupon payments are not available for reinvestment, which means here the reinvestment rate is 0. So YTM is 8.54%, the reinvestment rate is 0%. Tell me friends, what will be the realized YTM? Just tell me, it will be less than YTM or more than YTM? Less than YTM, obviously very less than YTM. How much less is what we need to compute? Very simple. In order to compute realized YTM, we need two things. One is that initial cash outlay. 90 is the initial, say, year cash flow, right? Year 0, you had outflow of 90 rupees to buy the bond, correct or not? And at the end of how many years? 5th year, 10th period, right? So period we are computing now. So we'll take period at the end of year, not year. So we'll change this to period. See, period 10. What is happening at the 10th year? Every 10th period, every period you receive 7 rupees coupon. You reinvest this coupon, put it into pocket, na. So 7 rupees was every year coupon. Will it change? Will it earn any return for us? Nothing it will earn. So what is the total coupon? 7 into 10 periods, 70. Plus redemption value will be there, 100 rupees you will realize. Anyway, the redemption values, present value will be 100 only, right? So 7 into 10, how much is that? 70 plus redemption value 100, total 170, na? That is only you will have on the date of maturity. 10th period, at the end of 10th period, you will have cash inflow, total cash inflow of 170 rupees. 90 rupees is the outflow today. After 10 period, 170. So what we will do? 10th root of 170 by 90 CAGR, you will get it as 12.76 annually. We don't need annually because we have done periodically. Now, though we will take 6.38%. Here, I don't want how to solve. I just explained you to use calculator and solve the question. You use your calculator and try solving. This is what is the answer. Answer is also given. 6.3. See, understanding the concept is important in this revision segment. We are not concerned with computational aspect. You are matured enough to compute on your own, right? I showed you how to compute this 10th root of 170 by 90. So 170 by 90, 10th root, you will get 6.38%. Minus 1 inga irukano? Yes. 10th root of 170 by 90 minus 1 should be there. Okay, because 1 plus r raised to the power, that is also a mistake. You can correct. That is 170 by 90, 10th root of 170 by 90 minus 1. You will get 6.38. Now come back to the discussion. See, YTM was, in this question, YTM was how much? 8.54. If we computed in the first segment, remember? Then reinvestment rate, unfortunately, because he doesn't know the realized YTM concept, was 0%. He didn't put any amount to, he did not invest any amount. Okay, in between coupons, he did not reinvest it. So he just kept it idle and he earned 0% return. Then ultimately the maturity reinvestment rate is 0% and realized R YTM. What do you mean by R YTM? Realized YTM is just 6.38%, which is far below the 8.54%. Are you all observing? Why our realized YTM has dropped from 8.54% to 6.38%? Because of the reinvestment rate. I told you, reinvestment rate, if you cannot reinvest the intermediate coupons at the same rate of YTM, you will ultimately earn even lesser than the YTM. That's what happened in this question. See, I have given detailed notes. Okay, in this question, ICAI, see, one more thing is that this is not the formula for computing realized YTM. Yeah? If you have been given the reinvestment rate, which I have done in the next question, I have given this question specifically because this is from our regular lecture module. Okay, from classroom discussion, we have I have picked this question and put it here because this is a concept clarifying question. Because in this institute question, they have not given reinvestment rate as such, but they have given assumption. But if you don't know the concept, underlying concept behind that, you will think realized YTM should be computed like this. No. Okay, realized YTM is even superior than the YTM. But what you should do, if they give reinvestment rate, next question we are going to solve that. Okay, reinvestment rate, if they give some rate, like see, reinvestment rate applicable for the bond is 9%, which means in the next question we will study that. If they have given specifically the reinvestment rate, then what you should do, we computed the example, do you remember? Okay, same way, reinvestment table we formed na? Yep, see here, I will show you. Here, this discussion, okay, here we have reinvestment table. We constructed a reinvestment table and tried to find out what is the total maturity value after reinvesting that coupon for a given rate, at a given rate, right? So reinvestment table you should present and show how much is the maturity value. Then only you will find a CAGR return. Are you understanding? Is this clear? Right. So question number 5 is solved. Okay, duration is pending, that we will solve later. And see here, note is very important. I've given this clearly. Everything is in the material. Okay, when you want to revise the last revision, okay, 1 month before the examination, when you do, if you revise through these notes, it will be very useful. Why? Because I have only put very good quality question. I have not put in all the questions, because it doesn't matter. If you know the concept thoroughly, you can solve any number of questions in the examination. That is not an issue. Understanding concept is the issue. See, in this question, ICAI specifically asked us to compute realized YTM, assuming that the coupons are not available for reinvestment, which means the reinvestment rate is 0%. Since reinvestment rate is 0%, we have simply added all coupons along with the redemption to make total cash flow on the date of maturity to 170. But if some other reinvestment rate is given in the question, then we have to prepare a reinvestment table and find out the total cash flow on the date of maturity, and then find out the CAGR, compounded annual growth rate, which I explained earlier, right? Next, we will solve one more question regarding realized YTM. Why? Because if at all they ask this question in the examination, they ask for 8 marks also. So that's why we need to understand this comprehensively. Also, you need to understand various rates are coming. Now, this is a very good comprehensive question by which all the concepts will be covered. Shall we start this? See, question number 6. A rupee 1000 par value bond carries a coupon rate of 10% payable annually and has a remaining maturity of 4 years. The bond is presently selling for 1020. The reinvestment rate applicable for the future cash flow of the bond is 9% per annum. What will be the realized yield to maturity? Very simple. Okay, small observations I want to make here. By reading the question itself, few things you need to comprehend. First thing is that, okay, the bond is selling at premium price. Okay, and they have not mentioned anywhere what is the redemption value, which means assumed to be redeemed at par. Understood? If you invest or if you purchase the bond at premium and it gets redeemed at par, you are making capital gains or capital loss. You are making capital loss, which means YTM is there. Okay, YTM itself will be less than the coupon rate. This is my first observation. Can you all observe this? Okay, are you all understanding what I am discussing? See here. Yes, it will be less than the, correct, it will be less than the coupon itself. Why? Because capital loss is eating your coupon income also. That is why your YTM will be less than the coupon rate. So first 10% is the rate given. That is coupon rate. You need to find some YTM which will be lesser than the 10%. Correct? Then there is 9%. What is 9%? Reinvestment rate. 3 rates we have found out. Then 4th rate you will find realized YTM. So in this question 4 rates are involved. 4 interest rates are involved. What is these 4 rates? We will get to know. See here, very simple. First you will prepare a reinvestment table. What you will do? You will prepare a reinvestment table. Every year, 4 years now, every year you receive 100 as cash flow. 10 rupees will be applied to face value. 1000 100 you will receive. Then at the end of 4th year you will get 100 as well as redemption value. What do? You reinvest, put it in the pocket. No, you reinvest. Last question, you put it in the pocket, because that person don't know the concept. We know the concept. That's why we are carefully putting in the reinvesting the coupon received. So 100 rupees is the coupon. Okay, at 9% we are reinvesting the coupon. So compounding we will receive at the end of 4th year, we will compound the 100 rupees. For how many years? 3 years. 4 years the maturity period. First coupon you will receive at the end of year 1, which means how many years are remaining? 3 years. How many years are remaining? 3 years to maturity. And 3 years for 3 years you will reinvest, which means future value 100 into 1.09 raised to the power 3, 129.5. Like this, second year coupon 100 rupees you will reinvest for 2 years. Okay, then third year coupon 100 rupees you will reinvest for 1 year. Okay, here 1 year of course. And then 4th year you will receive coupon plus redemption, which cannot be reinvested, so no use, you take as it is. And you add all these, you will get 1457.31. 1457.31. So initially you invested how much? Tell me please. 1020. Year 0. Why? This is premium bond. Okay, this is premium bond. Carefully observe. Initially the bond was issued at 1020, which means by paying 1020 initially you are gaining 1457.31 at the end of year 4. Now you will use the same CAGR method to compute future value is equal to present value 1 plus r raised to the power n. This you will solve and you will get 9.3% as realized YTM. Okay, now you need to compute YTM also. This question, okay, yes, what is the realized yield to maturity? They have not asked us to compute YTM, but you can, for clarification purpose, also compute YTM. I am adding one more section. Okay, why? Because I'll tell you later. I also compute YTM. What we will do? We need to compute YTM. They have given bond cash flows and the subscription price, or the initial price at which we bought the bond, 1020, correct? Upper interest plus amortization. First we will compute using approximate method. Interest plus amortization. Interest is 100. Amortization. Now 100 rupees was your 1000 cc here. 1020 minus 1000. Okay, here 1020 minus 1000. Okay. Yes, sorry, 1000 minus 1020 only. 1000 minus 1000 minus 1020 only. Redemption value is part. So sorry, issue price was 1020. So it will be negative, and the average price becomes 1010. Right? If you solve this, you will get average yield of 9.41. Average yield of 9.41%. Okay, because of course the capital loss you are having now. Say. Then calculation of IRR. How you get IRR? Year 1 to 4 cash flow is 1000. Fourth year you will get 1000. Very simple. We are doing interpolation. We got 9.41 as per approximate method. Now as per IRR method, how to compute this question? How to compute this? What do you say? IRR. How to compute this IRR? See here. We take 10%. We take 10% and 9%. We know that. See. By approximate method, we know that our YTM is coming in between 9 and 10%. So what we do? We take 9%, we take 10% and do the interpolation and find the exact YTM. See here, at 10%, you don't need to do all, at 10%, you don't need to do all the computation. Why? Because 10% is a coupon rate, yeah? Are you understanding? In this question, if you are all awake, if you are all alive, okay, 10% is a coupon rate. Okay, if bond is trading at par, at 10%, the price will be always be 1000 only. Are you understanding? So that is there. Then if bond is now at 9%, you will get 1032. So 10% is 1000. See here, interpolation how to do? 9% rate, 1032 was rate. 10%, 1000 is the interest rate. 1000 is the price. Then how much reduction, price reduction we need? See, we need a reduction of 32.37. If I increase, see here, from 10% it was 1000. If I increase the interest rate 1%, if I increase the interest rate at by 1%, my bond price is falling by 32.37. Okay, my bond price is falling by 32.37. Right? Yes, 1032.37. Then by interpolation, at what rate I will get exactly the same amount, 1020. Correct? You need 1020, na? That is the amount initially what you invested, correct? But you need 32.37 is getting reduced if you add 1% interest rate. How much reduction you need? 1032.37 minus 1020 only, na? Then you want only 12.37 reduction. Apo, how will you do? Okay, 1 into 12.37 divided by 32.37. What is that? 38. Okay, 0.38. This 0.38 you will add 9 plus 0.38 is equal to 9.38. Okay, 9.38%. This is what you get the answer by doing interpolation. Are you all clear with this? Okay, I'm quickly explaining, assuming all this I have already explained. Okay, if you have any issues with the speed, you can revisit the same video again and revisit the concept and get the same answer, right? 9.38 you will get YT. Now we will summarize this as follows. See, in this question, why I wanted to discuss this question, you need to understand. There are 4 different rates. After solving this question, there are 4 different rates, interest rates we will get. Correct? What is 10%? 10% is a coupon, which will be applied to the face value to get a yearly cash flow. Okay, yearly coupon, which is coupon rate. 10% is coupon rate. Then 9.38 is your YTM. Next to 9% is the realized reinvestment rate. 9.33% is the realized YTM. Very simple. To put it simply, 10% is your coupon. Okay, the bond is redeemed at par. Had you been invested the bond at par, you will receive 10% coupon exactly. But since you paid 20 rupees extra and paid 1020 to buy this bond, you are making capital loss. To that extent, okay, that capital loss will reduce some coupon income, which means 10% was your coupon income. Since you made some capital loss, your YTM become 9.38%. Understood? Because you subscribed to the issue at 1020 and got redeemed at 1000. Capital, because of capital loss, there is some reduction in YTM. Apo coupon rate was 10, YTM became 9.38%. Now, in order to realize YTM, I told you, you should reinvest the intermediate coupon at the same rate of YTM. But instead, what you did? You reinvested at 9%, which is less than 9.38%. So there is some more drop. okay, because you got 9.38 as YTM initially, the bond is offering 9.38, but you reinvested at 9.9%, so which means ultimately realized YTM fell below YTM. YTM was 9.38%, realized YTM fell even below the YTM, that is 9.33%. So 4 interest rates are involved. That is why I wanted to discuss this comprehensive concept clarifying question. Are we all fine with this? Next concept, shall we proceed? Okay. Next, duration of a bond. Duration of a bond. This is also called as Macaulay's duration. Macaulay's duration. Okay. Duration of a bond is nothing but weighted duration, where the weights are the proportion of the discounted bond cash flows to the bond price. This is what is given. But you need to understand only through some numbers you will understand, easily understand. Very simple. Okay, I will just theoretically explain these things. Then I will take one problem, then I will explain it thoroughly. Are you all understanding? Duration can be understood in 3 different ways. Okay. One is that this is the average period for which the money is blocked in the bond. Okay, average period for which the money is blocked. See, I will be very clear with this. Duration is something different than a maturity of the bond. You should not think duration is maturity is something different. Maturity is fixed, yeah, 4 years now, maturity will be different. Duration computation is having a separate method. Okay, and it's just a computational concept. It is not really any big concept, but it's just a computational mechanism. Okay, what is the use of the duration? We will find out here. See, 3 ways we can understand the duration. One is that on an average, how much of my money is blocked in the bond? On an average, how much of my money is blocked in the bond? That is the first thing. Time required to recover the invested money back, something similar to discounted payback period or average due date. A concept is there, and discounted payback is there now. In intermediate capital budgeting, you would have studied discounted payback. Okay, on an average, if I invested some amount, initially when you buy the bond, you will buy the bond by paying the market price of the bond, correct? From the market. So when will your market price be recovered? That is what is the discussion. Okay, this average, weighted average duration for which your investor, you will recover the invested money back. This is first thing. I will explain through numbers. Be patient, just explaining the concept here. Next, it is the optimum bond holding period to protect the YTM from interest rate changes. The next coming segment, we are going to see something, a very interesting concept called as bond immunization. It's a strategy, it's a hedging strategy to protect our yield from interest rate changes. To protect our yield, YTM is there now. To protect our yield from interest rate changes, we enter into some strategy. We get into some strategy. It's called as bond immunization strategy. We will discuss it later. Now you understand this is input for bond immunization strategy. You need to know duration is one of the first step to compute bond immunization. We need to calculate bond immunization. For that, it becomes a working note. Optimum bond holding period to YTM. So duration is nothing but optimum bond holding period. Okay, you should not, later in immunization, we are going to study that you should hold the bond not till the maturity period of the bond, only till the duration of the bond. It will be something less than the maturity period. Why? Because coupon is recovering some amount. I will explain all this, just be patient. So it is the optimum bond holding period. If you want to realize the YTM ultimately, okay, you want to hold the bond only till its duration, not till its maturity. Why we are holding till duration, not till maturity, all this we are going to discuss. Third is that it is an input data for modified duration calculation. Okay, it is input data for volatility. Volatility formula is nothing but duration by 1 plus YTM. This is just a crude understanding. Duration is input data for computing volatility. Volatility itself is approximate measure that I will discuss. So these 3 data are there. Come on, repeat. First thing is that it's average period for which my money is blocked in the investment, bond investment, or it is the time period which by which you will recover the amount invested in the bond. This is first point. Second is you can understand duration also like this. It is optimum bond holding period. For bond immunization, for how much time period you hold the bond, okay, this will be decided by the duration of the bond. Okay. Then, okay, so there is a formula of calculating duration too, but table method is more simplistic and easily understandable. Okay, actually there is formula for duration. We are not discussing the formula now. Why? Because the table method is very conceptual and easily you can remember. You don't need to mug up the formula because we believe in conceptual learning, so you don't need to mug up the formula. Sometimes few formulas you always need to mug up, which I will discuss always later. No issue. See, Decision making using duration. Always select the bond having lesser duration because our invested amount will be recovered early from lower duration bond. Understood? That is very straightforward. Whenever they ask me the question to take decision based on duration, you should always select for bond. Two bonds are given. One bond is having duration of 4 years, another bond is having duration of 4.5 years. Now you should select the bond having lesser duration so that you can get back your capital earlier, right? That is the understanding. Now tabular format by which you will compute the duration, nothing but first you will do year, cash flow, present value factor at YTM, discounted cash flow. So valuation up to these four columns are same. Okay, you use these four for valuing bond, na? That is same. There is no change at all, absolutely no change. The fifth column and sixth column is nothing but weight of DCF to value, which means what is the weight you compute, okay, to discounted cash flow you got in the column 4, na? Okay, this by this column number 4 value for each year divided by the net discounted value of the bond. Are you understanding? Discounted cash flow total will be nothing but value of the bond. Yeah, okay. The value of the bond is only the total of the discounted cash inflow. For each year, the fourth column discounted cash flow is there, na? That you will take divided by the total discounted cash flow. That you will get as weight of the discounted cash flow to value. Then last column, this weight you will give, na? This is nothing but weighted average. Some sort of weighted average time period. Okay, this is to be understood as weighted average time period, just like average due date and all, right? So when you find weighted average, weighted average time period, you have to multiply it with time na, ultimately, right? So you have computed in the fifth column, you have computed weights that you multiply with first column, year column. Okay, I put it like sixth column is equal to first column into fifth column. Like this you will multiply and get the total of it. Okay, this column's total is then a summation of all these numbers. Okay, if it is given for 6 years, now you will get 6 years bond, duration of the 6-year bond. Are you understanding? I will solve one question and then we'll make you understand. Okay, see here, we will go back to the previous question. Now one question we see, one question was pending wherein I told you we will discuss the duration later. Na? See this question. Yes, fifth question. Come back to the fifth question. Calculate the duration of the NCD. Very simple. See here, this is how you compute duration. So this is the duration computation. How you compute? Very simple. Till this present value, you will compute value of the bond. Na? The same 4 column you will use. Year, cash flow, present value factor at 8.54, present value factor at 8.5, present value at 8.54. The total of this present value comes to 89.95. This is nothing but value of this bond. What is the value of this bond? 89.95 is the value of the bond. Then what do? You find proportion for each year, which means the first year, the present value is 6.447. Na? So what you will do? How you got 0.0717? 6.447 divided by 89.95. How much is that? 0.0717. Are you all getting this? Same way. 5.943 divided by 89.95. So the proportion of each year's present value you will find, okay, with respect to the total value of the bond, which means total present value of the bond, value of the bond. Whenever I say value of the bond, it's always discounted value of the bond. Okay, you should not consider this amount at all. This will never come to the picture. Value of the bond means this 89.95 will take. So what is the proportion you will compute for each year proportion? Then the second column, 0.0717 into 1, 0.0661 into 2, 0.0608 into 3. Like this you will, okay, multiply the proportion with the year. Okay, then you will find the total of it, total of this, and you will get 7.3654 as the duration. Very simple. See here, if you carefully observe, one conceptual discussion I want to make here. This question they have given, the bond is 5 years, na? But 10 years is the maturity period of this bond. Okay, 10 years is the maturity period of this bond. 5 years is the maturity period. 1 second. Yes, 5 years is the maturity period of this bond. Sorry, 5 years is the maturity period of this bond. Or 10 periods also. If you convert the data into periods, this is non-annual coupon. So 10 periods you can also say it as 10 period bond, right? Now in this 10 period, this 7.3654 is periods. Okay, duration in periods. If you want to convert it into years, they have given the answer itself. Are you all seeing this? Duration is equal to 7.36 half years. Okay, that is 3.683 years. If you want to compute it in years, you will get 3.683 in years. Okay, they have given it. I will highlight. Okay, see this. Now what I want to discuss is that this bond is a 5-year bond. This bond is 5-year bond and the duration is less than 5 years. Duration is only 3.683 years, which means even though the bond is having a maturity period of 5 years, I need not hold the bond till 5 years in order to realize my YTM, in order to get optimum returns. In order to get the optimum return, I only need to hold the bond till 3.683 years, not 5 full years. Are you understanding? See, in the computation side, I want to clarify one more thing. The present value 6.447 is there, na? Okay, divided by total bond value 89.95 you are getting. See, this 89.95 is nothing but value of the bond. Value of the bond is discounted cash of the bond. Very simple. The second column is there. Cash flow you are getting 777. How many? 10, 7 is there, 70. So the total is 170. Na? So the total amount without applying the time value of money, you will get total amount as 170 rupees. But if you discount this using appropriate discount rate, okay, if you remove the interest portion of it, okay, this is the total amount. Out of the total amount, if you remove that interest portion, I told you interest, not this interest, okay, coupon interest, not I'm saying, I'm talking about the interest, which is the compensation for risk and inflation. Time value of money I have already discussed. There I told you time value of money, bank is suppose is paying 8% interest rate, 100 rupees, every 100 rupees bank is suppose offering 8% interest rate, correct? Why is it so that the bank is offering 8% interest rate? Interest rate is nothing but a compensation for two things, because today's money is more valuable than tomorrow's money. I explained you all this. So interest rate is a compensation for risk as well as inflation, which means here, okay, discounting is a technique by which you remove the interest portion. Interest in the sense that that interest, time value of money portion. If you remove the time value of money, compensation for time value of money from the amount, you will get discounted cash flow. If you add the time value of money to the basic amount, principal amount, you will get compounded cash flow, future value, right? Future value of the cash. So 170 rupees is there. This 170 rupees, are you understanding? Not only includes the principal portion, but also includes the interest portion. Out of the 170, the principal portion is 89.95. That is how you should understand. Very simple. You have 170 rupees, na? Out of 170 rupees, you are getting in a single shot, year 0, you are getting this amount. You are getting various years, you are getting through various years at the same number, you are getting through various years. Are you understanding? So 170 includes the compensation for time elapsed. So here say 5 years bond, na? So 5 years time has elapsed, which means it also includes the interest portion or the compensation for the time value of money, which means out of this 170, there are two things. One is 89.95 is the principal amount, and the balance portion is the compensation for time value of money. I write it as time value of money interest, so that you don't get confused. Okay, that interest is something different, this interest is different. Are you understanding? This is the compensation. See, how much is that? 170 minus 89.95. How much you are getting? 80.05. Roughly 80 rupees. Okay, roughly 80 rupees. This is 90 rupees and that is 80 rupees. Right? This 80 rupees or 80.05 is a compensation for time value of money. So if you remove that, you will get the principal portion. Now, duration is nothing but the time taken, average time taken for you to recover your principal portion. Very simple. First year, you are recovering 6.447, that is discounted price, which means out of the 85.99, I will see the place is fully jammed here. I will explain it here. See here, total principal portion. How much is that? 89.95. Out of this, okay, first year, you recover 6.447, right? Like this, every year you will recover, correct? Second year you recover some amount, third year you recover some amount. But tell me children, there is one thing here. You recover 47.187 at the end of 10th year, which means the 10th year recovery is more than first few years. Are you understanding? Because redemption happening, substantial portion of your principal amount, listen carefully, substantial portion of your principal amount is getting redeemed or getting recovered only at the redemption date. Yeah, okay, last installment. That's where you are getting 47.187 because it has a bulk of 107 rupees, which has redemption value in it. So, which means 6.447 of my money is recovered in the first year itself. 5.943 money is recovered in the second year itself, but 47.187 is only recovered in the 10th period. Period, you should understand, period. On an average, my money is getting recovered, okay, at 3.683 years or 7.683 684, 654 half years. Are you all understanding? This you understood. The interpretation you need to understand. Okay, duration is all about principal portion recovery. First year you recover the entire amount? No, I only recovered 6.447. Second year 5.943. But fifth year I recover 47.187. On an average, I recover my money, okay, invested money. Initially, what is the invested amount? 90 rupees, na? That 90 rupees, okay, 89.95 is something similar to 90, na? Okay, it is rounding of error, it should be ideally 90 only. Are you understanding? Quoted market price, na? It should be ideally 90 rupees. So, the 90 rupees you are recovering in first year, second year, 10th year, on an average, you are recovering it by 3.683 years or 7.3654 half years. Are you understanding? This is what I told you here. See, I have put it here. If you read the explanation, you will understand it very well. First, it can be understood as the average period for which money is blocked in the bond, which means 90 rupees is our invested amount, na? That is blocked in the bond. So in order to realize that amount, the time, on average time required to recover the invested money back, something to discount similar to discounted payback period that I just explained. It is the optimum bond holding period. This point you will never understand now. This point we will understand when we discuss bond immunization strategy. Okay, there I will discuss it detailedly, right? No issues. Then the third point, it is input data for calculating modified duration or volatility. Now we will discuss volatility. Now we understood duration, how to compute duration fully, na? Okay, volatility I will discuss together, and then yes, volatility we will discuss, and then convexity also we will discuss, and then we will solve a comprehensive question covering all these, both these concepts as well, duration, volatility and convexity. These are one set of discussion. Okay, I cannot do questions in between. I want to discuss both these concepts because these are interlinked. Thereafter, I will solve comprehensive question. Please be patient, right? Next, volatility. What is volatility? You need to understand. See, volatility is nothing but sensitivity of the bond price with respect to the interest rate changes in the market or YTM change. Very simple. If my YTM changes by some percentage, 1%, what is the change in the bond price? Okay, volatility tries to measure change in the bond price if there is change in YTM, which means sorry, for every 1% of change in YTM, what is the impact of the change in YTM in price, bond price in percentage terms? I already discussed that YTM represents risk. Okay, if you increase the YTM, which means your discounting rate will increase. Discounting rate will increase. If you discount the cash flows using higher discount rate, your value of the bond will obviously reduce because a factor will get reduced. Ultimately, the value will get reduced. Correct? Higher they are inversely proportional. First discussion itself, I told you na. If you increase the discounting rate, the value will even further reduce. This is the inverse relationship between YTM and you will discount using what? YTM. Now, bond you will discount using YTM. So, if you discount using a higher YTM, your value will reduce, bond value will reduce. We know it will reduce, but there should be some mathematical measurement. Na? At what percentage it will measure? For every 1% of increase in YTM, what is the decrease? Percentage decrease in bond price. Or for every decrease, 1% decrease in YTM, what is the increase? What is the percentage increase in the bond price? Okay, or value that is captured by this volatility formula. You have to carefully listen one more thing here. This volatility is just an approximate formula. Accurate formula we will discuss using intrinsic value method. We need to adjust for convexity in the next segment we are going to discuss. Okay, so ideally, if YTM change, very simple, if YTM changes by 1%, the bond price will inversely approximately change by some percentage. That is the volatility. Okay, volatility is always represented in percentage terms. This volatility is also written as modified duration. Okay, if you see the books, they will give Macaulay's duration is the duration, weighted average duration we found out. That is different. This is known as modified duration. Don't get confused. Wherever they have asked modified duration, it should click your mind that they are asking volatility only. There is nothing. They are asking only volatility. That is what you should understand. See, volatility measures the sensitivity of the bond price to changes in YTM. Okay, YTM will change when the market price, general market interest rate changes. Means RBI, okay, bi-monthly, every 2 months, it has, it will conduct an MPC meet. MPC meet, monetary policy meeting. Okay, and monetary policy committee will conduct its meeting and they will come up with some interest rate. If they want to change the interest rate, have you all seen the news or financial news or some Economic Times newspaper? If you see, they will frequently use these wordings. Okay, RBI has kept the interest rate unchanged. RBI has increased the interest rate, decreased interest rate, all these things, economic policy, monetary policy, right? They will describe it. So that is called a market. When market interest rate, when general interest rate of the country changes, okay, it increases or decreases, yield to maturity will also change. Why? Because of the sensitivity. If interest, very simple, if interest rate is changed in the market now, price will get reduced, bond will be trading cheaper. Okay, if interest rate is decreased, okay, price, any asset will, the price of the asset will increase. Always when interest rates are reduced, because ultimately discounting rate, it will reduce, the price will increase. The shares or the bonds will shoot up, the price will go up. Okay, so these are all the things which I wanted to understand, which I wanted to communicate. If the market interest rate changes, YTM will also change. If YTM undergoes a change, the price will also change. That is the relationship. What happens to bond price? See, what happens to bond price if YTM changes by 1%? How much is the bond price change? We can find using volatility. How much is the change in bond price with regards to the change in YTM? This is what volatility captures. What is beta to equity share or delta to option is the volatility to bond. Very simple. Beta we are going to learn in the equity segment, not equity segment, portfolio management. We are going to learn beta, detailed discussion about capital asset pricing model, CAPM, we will discuss there. Okay, we will see something called as beta, concept of beta. So what is beta to the equity share? Which means how beta measures risk and how it changes the value of these assets. Okay, like that. Delta to option. Delta is nothing but change in option divided by change in the spot price or change in the share price. Okay, for every share price, how much is the change in the options price? That we are going to learn anyway in the derivative chapter. So this is volatility, something similar to these things, beta and delta. Okay, after reading you can comprehend. It measures only approximate change, and it should be adjusted with convexity to know the accurate change. Always listen, the duration or the modified duration or the volatility which you are computing, it will only show the approximate change in the bond price with respect to the yield. It will not show accurate change. Why? All these discussions we are going to do in the convexity discussion. See, next, bond price and YTM are inversely related. That is, if YTM goes up, bond price falls and vice versa. What is the formula for YTM? Very simple, duration divided by 1 plus YTM. Duration divided by 1 plus YTM. This gives approximate change in bond price, okay, with respect to the bond yield. Okay, bond yield. Okay. What is the change in bond price? This is over, right? So we discussed volatility. Now we are discussing convexity. What is convexity? Very simple. See, we discussed that volatility captures the price, the change in the bond price if there is any change in yield, YTM. If YTM changes by some percentage, volatility will capture the bond price. Understood? The change in bond price. This is what we discussed. But that is not accurate. We always told that it is approximate. I am yelling now. Why it is approximate? You need to understand. See, this is, I have given you two data here, two figures. One is this. This is, volatility. By considering volatility, okay. This is after convexity. Convexity. See, what is happening in this diagram, you need to comprehend. First thing is that, what is the formula for volatility, you need to understand. It is duration by 1 plus YTM, right? So, which means the formula, in this formula, duration is constant. We have assumed that duration is constant for simplicity purpose. See, I cannot explain, in full lecture we will discuss all these in detail. I cannot explain in detail, but whatever is relevant I am explaining here. See, whenever I told you, whenever the interest rate changes, the yield, whenever the YTM changes, the bond price will undergo the change, correct? Not only bond price, the duration itself will undergo change. Because if you increase the YTM, are you listening? If you increase the YTM, ultimately your bond value will get reduced. And every year the proportion recovered from the bond value will also change. Ideally, the proportion, weighted average proportion of the recovery is only captured by the duration. So, very simple. If YTM changes, duration changes. This you accept? You agree? Yes. So, duration is a working note for calculating volatility. Volatility we computed here. 1 second. Yes. Duration divided by 1 plus YTM. There in the numerator we had duration. That was assumed as constant. If duration is constant, then 1 plus YTM, it will form a linear line, which means, see in this diagram, this is the volatility diagram. See here, this is risk, this is YTM. The x-axis represents YTM, y-axis represents price of the bond. Okay, if you keep on, very simple, I will show you here. If you keep on increasing the YTM, okay, if the YTM goes to the right side, if you keep on increasing the YTM, what happens is the price of the bond falls from here. Okay, it keeps on falling from the top. Are you understanding why? inversely related. Understood? So this is simple understanding. But the fall is linear as per volatility. The fall is linear as per volatility, which means volatility, this fall is there, na? Okay, this is assumed to be, D is assumed to be constant, and if we solve, we will get a linear line. Okay, and 3 point, we have solved any question? No, right? While solving question, I will explain it further. Understand that the fall in the price will be very linear. As per the volatility, the percentage change will be there, na? This will be constant. So for example, 1% change for every 1% change, for 1% increase in the YTM, say bond price is falling 3.5%, pa. Understood? Then if you increase the YTM by 2%, okay, this will fall by 7%, obviously. So if you increase it by 3%, it will be 10.5%. Like this, it will be linear in nature. That's why it is straight line. Okay, this explanation is enough. I think you can comprehend very easily. Next, come to convexity. But in reality, what happens, you need to understand. I just now told you that duration itself undergoes a change. When there is a change in YTM, okay, not only the price changes, price changes there, obviously it will happen. But first duration itself will undergo a change. You have computed volatility, which is duration divided by 1 plus YTM. The numerator also will keep on changing if you change the YTM. If you tinker the YTM, duration also will get changed. That is, if that is the case, this will never be a linear equation. This will always be a curve. Can you see the curve? Okay, see this. The change in the YTM will always be a curve and not the linear line. That's why this curve is, okay, this curve is, the real change in the price with respect to the change in YTM. The linear is just captured by the volatility. So what we do in this convexity, very simple. This amount, the differential amount is there, if you see this is the yellow in between the straight line and the curve. It is captured by the convexity adjustment. So what we have to do, we can either find the volatility and adjust the volatility with the convexity percentage, or you can use intrinsic method and find the accurate change in bond price with respect to the yield change, right? So I have given the notes here, explanation to see volatility only captures the approximate change in bond price due to the change in YTM. This is because the volatility formula, i.e. duration by 1 plus YTM, is derived from duration and assuming it is constant for simplicity purpose. So volatility, the duration will be always constant. It will never change. But in reality, what happens, the duration itself is not constant. As and when the yield changes, duration of the bond also changes, and then it will form a curve in the graph, not a straight line. The difference between the straight line and the curve involved will be captured by the convexity adjustment. This is what is called as convexity adjustment. See, I don't want to just discuss the formula and finish the topic. I want to give you an idea of what is happening. Again, this formula you should by heart. There is no other way. Convexity formula you should by heart. See this. These two formulas you need to remember. Okay, these are very important to understand convexity. So before that, discussing the formula, first I will take an example and conclude it before discussing the formula. See, formula, there is nothing to discuss. Just by heart the formula, replace the formula, replace the numbers, you will get the answer. That is not the issue. But you have to understand. See here. Take this example. Coupon of 10% bond. This is a case of a plain bond which is paying a 10% coupon rate, which is having a YTM of 10%, which means what? Bond is trading at par. Redemption value is also par value. Okay, there is no capital gains involved. Therefore, coupon is exactly matching as YTM. Then term of the bond is 5 years. Then duration is 4.17 years. Why? This is a coupon paying bond. So the duration will be lesser than the maturity. I told you. If you compute, believe me, this is computed. You can cross verify by computing. But believe me, this is not important. Duration, I am not here for computing duration now. So I have given the data itself. I have computed already. Duration is 4.17 years. Now volatility also, I compute duration by 1 plus y. I compute as 3.791%. Now come to the interpretation part. Very, very interesting issue. See here, what I do is, at present my YTM is 10%. Same as coupon rate, right? Bond is trading at par. So the bond actual value is 1000 rupees. Bond value using duration formula, both will give the same answer. Why it is trading at par, the YTM is same as coupon rate, there is no issue, right? There is no interest in. This is the starting point. Now, when we change, okay, the interest rate, when we reduce our, here we are reducing, when our interest rate is reduced by 2%, okay, I will tell you, if interest rate is changed by 2%, tell me, volatility, this is 1%. Volatility will always capture for 1% change in yield. If you make it for 2%, now how much it will be? 3.791 into 2. How much is that? 7.582% is the change in bond price according to the volatility. Now very simple, 8%, 2% you have changed, from 1000 rupees, Okay, if the interest rate is decreased, the price should increase. By how much percent? 7.582. If the price is increased from 1000 to 7.582, na 107.582 percentage. How much is that? 1075.82. Are you all getting? This is okay. Change, increase in the bond price by 7.582%. Are you all understanding? Next step. Okay, come to 6%. Come to 6%. Okay, 6% na the change is again 2% change na 2% interest rate is falling. So okay, how much should the bond price fall? Bond price increase, right? From now the bond price okay is 1075.82, correct? But if I take 6%, what is happening at 6% interest rate? See here, my bond price is increased. One more time you need to increase na 7.582% from where? 1075.82. Up 1075.82 into 107.582%. What is that? 1157.38. Okay, 1157.38. Okay, there is some minor rounding of mistake, pa. Okay, you will get it that same answer you will get, or you can take from 10%. You can take 4% is the drop in interest rate, na. So how much is the increase? You can directly compute. See here, 7.8%. From here the drop is 4%, na. So what you will take? You can take directly the fall as to 4%. The increase will be 3.791 into 4%. Let us check this. 15.16164. This will increase, na, 1000 into 115.164, which is 1151.64. Are you all getting this? Okay. In the example I have attached it directly. You can do it separately also. You will get the same answer ideally. Okay. So if the YTM drops by 4% to 6%, the bond value as per volatility formula, you will get this 1151.64. Now forget this. Okay, I am just rubbing. See clearly. Bond value actual. Now what is the actual bond value? Very simple. You forget about this. You have coupon, you have 10% YTM, you have cash flow, 5 years, coupon is given, redemption value is assumed to be on par, at par, 1000 rupees. So what you will do? Year cash flow, okay, this tabular method is there, na? PVF at what rate? 10%. YTM is 10%, na? Then discounted cash flow. Like this, if you solve. Here, for 8%, na, you take 8%. Then 6%, na, you take 6%. Like that, you change the discount rate and solve this. The total of the discounted cash flow, you will get 1080 for 8%. Okay, then 1168 for 6%, which means actual bond value is something different than the bond value which we arrived by substituting the volatility formula. Can you see the difference? See, 1080 is something more than the 1075.82 which we arrived at the volatility. This change is because of the convexity. So we need to adjust for this convexity and solve the question. Are you all understanding? This is the change. This change will be adjusted through convexity and we will arrive at accurate change. This is called as intrinsic value method, and this is using volatility formula, duration formula, not modified duration formula. Okay, duration formula in the sense modified duration formula. Like this you need to find out. See, formula is very simple. First, you need to find the convexity. What is that? C into change in YTM whole square, YTM the whole square. What is C? Okay, V plus V minus 2V0. What is V plus? Na, value of the bond if YTM is changed by delta Y. If you want to change the interest rate by 2%, what is the value of the bond you need to find? By intrinsic value method, you will find some value, na? Then this is the upper value, V plus, na, the upper interest rate, the value which you will get by discounting using upper interest rate. V minus, na, the value which you will get by using lower discounting rate. Okay, this is if the YTM decreased by this many percentage, na, 2%, na, from 10%, if it is decreased by 2%, so 8% is the discounting rate you will apply, na. By applying the 8% discount rate, what value you will get? That is V minus. V0 is nothing but today's intrinsic value, which is of course 1000 in our case. In this example, we will solve a separate question. May 2023 RTP or some question we will solve. Very good comprehensive question. It was also asked November 20 attempt, I think. Okay, that question, same question we will solve. Next, to change in delta Y. Now, what do you mean by delta Y? Change in YTM. These are all the numbers involved. So first you need to find C value, and then after finding the C value, you substitute in this formula. Okay, C you substitute in this formula. C into change in YTM the whole square into 100. In percentage terms, you will get the convexity adjustment. Are you understanding? Can we proceed? This convexity should be added to the volatility to get accurate change in market price percentage when YTM decreases, and this convexity should be subtracted from the volatility when YTM increases. Okay. This is what we need to do in percentage terms. I'm saying. Okay, this just needs to be remembered. Not an issue. By applying this formula, you will generally get the answer as such. Okay, take question number 7 for discussion. Here they have asked, see this comprehensive question they have covered, I have put it as comprehensive. They got YTM, duration, volatility, convexity. All these 4 concepts are covered, right? Right. So the following data are available for a bond. Face value 10,000 rupees to be redeemed at par on maturity. Coupon rate is 8.5% per annum. Years to maturity is 5 years. Okay, yield to maturity is 10%. You are required to calculate current market price of the bond, Macaulay's duration, volatility of the bond, convexity of the bond, expected market price if there is a decrease in YTM by 200 basis point. Okay, what is basis point? 100 basis point is 1%. Okay, 100 basis is equal to 1%. Okay, this you need to remember. In the Forex chapter also, we will use this interchangeably, right? So 100 basis point is 1%. So 200 basis point, nothing but 2%. They want to find out what is the change in market price if the YTM changes by 2%. Okay, by Macaulay's duration based estimate. What is Macaulay's duration based estimate? Volatility. Okay, by applying the volatility, we need to find out. Then we need to find out using intrinsic value method. Both these methods they are testing, which means this will give you approximate value. This will give you accurate value. Shall we proceed? See, first point, current market price of the bond, very simple. They are asking value of the bond. Here, value of the bond is nothing but discounted present value of the future cash flows discounted at required rate of return of the bondholders. Here, YTM. YTM is nothing but 10%. They have given a yield to maturity, they have given us 10%. So you discount the cash flows using 10% rate. See here, present value annuity factor applied for coupon for 5 years. This can be put it in tabular format also, no need. If you are comfortable with the computation, you can directly do that. Coupon, we use present value annuity factor, just like we discussed in the time value of money. Then 10%, because coupon every year same amount, it is similar to annuity cash flow. So you will use present value annuity factor, 10% for 5 years. What is 10%? 10% is YTM, 5 years, number of years. Then 10,000, it will be redemption value, redeemed at the end of 5th year alone. So we will not use present value annuity factor, it is present value factor, printing mistake. Okay, present value factor at 10% for 5 years. Right, then what you will get is nothing but 9431.5. So what is 9431.5? 9431.5 is nothing but current value of the fair value of the point. It is also called as V0. Okay, we are about to compute now the volatility formula. V0 is used in volatility convexity formula. Remember the C value when we find out V plus V minus 2, V0 is there, correct? There also denominator also 0, V0 will be used. So that is what is 9431.5 is V0 or current market price or fair value of the bond. Assuming the bond is trading at fair price. Okay, market price if it is not given, you assume it has to be trading at the fair price. Okay, it need not be always trading at fair price, because quoted market price, as I told you, it could be something different. Okay, but if nothing given about it now, you assume it to be fair value. Okay, the market quoted price is fair value, right? Next, duration computation. I am not again doing, you can verify. See here, bond value you will get, and then proportion, and then weighted proportion, you will get the duration as 4.252. What is this? 4.252 percentage, years, rupees, years. Okay, duration is always represented in years, and volatility is represented in percentage terms. Okay, duration of the bond is 4.252 years. Volatility of the bond. What is volatility? Duration by 1 plus YTM. Simply substitute the formula, you will get as YTM. Come to the main discussion. In this question, the main discussion is convexity. We need to understand how convexity is computed in this question. Say here, convexity of the bond is nothing but C into change in Y square into 100. First, we need to find C. How to find C? See this table. You can create this table because you already discounted at 10% and found out the value. Correct? Now what do? You discounted it using this. Okay. See here. Sorry, I should have given it 10%, 12%, okay? This is present value factor at 12%. If you discount it 10%, coupon is also 10%, na? Coupon is 10% or 8%, 1 second, 8.5%, okay, so yes, sorry. If you discount using 10%, you will get 9431.5, na? No, you are getting something different. So it is 1 divided by 1.12. How much is that? 892. Yes, it is 12%. Sorry, there's a printing mistake. 12% is the discount rate here. What I will do, I will just cut this off. Okay, this is 12%. Okay, why this is 12%? Why you need to construct this table? I'll tell you. See, this is V plus na. Here they have asked 2%, 200 basis point na change in YTM. So change in YTM we took as 200 basis point, 2%, which means
Here the change is 2% means V minus 8%. Now at present the YTM is how much? 10%. If we decrease the YTM by 2%, we get 8% YTM. At 8% YTM, what is the value? This is V minus. Are you understanding? This is V plus. YTM, if we change by 2%, what we will get? Okay, we will get 12%. Nah? So this is at 12%, if you discount, this is V plus. Are you understanding? This value is V plus. So just substitute the formula. 10,204.5 is nothing but V plus. You are getting here, and plus V minus. Okay, what is that? So V minus, now it is not minus, it is plus only. Okay, plus 8733. V minus in the sense if you increase the interest rate. Okay, right. Then how much is that? You add these two, then you will get minus 2.2 into V0. V0 is 9431.5. Then the whole divided by 2 into V0 into change in YTM square, you will get this number as 9.867. This is the C value. Then you substitute the C value in the convexity adjustment formula. What do you do? Okay, this is adjustment factor. You put it in the convexity formula. Then what you will get? 9.867 into change in YTM square, 0.02. I am putting it in decimal. 2% is written as 0.02 the square. Into 100 in percentage terms, you will get 0.395%. Are you understanding? This you will add to the volatility. What is volatility? Already we got the volatility, 3.865. That you can add. But they have not asked us that. Okay, we need to show separately convexity adjustment alone. They have asked the convexity alone. We have done that. Next, to come to the last part. Expected market price if YTM decreases by 200 basis points. So what is the expected market price if interest rate drops by 2%? Very obvious. Macaulay's duration based estimate, you will take volatility, which means 1% if it is the change. See here, 1% is the change in the interest rate, means, see, 2%, how much will be the change? 3.865 into 2. How much is that? 7.73%. If you, okay, add 7.73%, see, if the YTM decreases by 200 points, if YTM decreases, price will go up. Price will go up. Now, current price is 94, current fair price is 9.9431, 9,431.5. From there, you increase 7.73%. How to find 9431.5 into 107.73%? Okay, how much is that? See here, 9431.5 into 107.73%. You will get it as 10,160.55, right? That is what they have given as answer. Can you all see this? 10,160.55. This is based on volatility formula. See, they have asked Macaulay's duration. Again, Macaulay's duration is nothing but duration based estimate means you should apply volatility, because duration by 1 plus YTM is volatility, so you should replace the volatility formula. That's what they mean by Macaulay's duration method. Intrinsic value method. Intrinsic value method, nothing but fair value of method using old the original method. The tabular method is then a discounted present value of the future cash flows which you will discount. So intrinsic value at 10% is 9431.5. Intrinsic value of 8% is this much. Price increase is this much. Okay, this price increase is this much based on, this is real change. Real change. Okay, this 729 here, 729.5 is the approximate change. Approx change. Understood? The real change should be, okay, should have been 772 actually, but it only changed by 729 using volatility formula. This is the answer for this question. You can go through the question given in the PDF. You can simply download it and go through all the questions. Are you understanding? Concept is clearer, right? Okay, we'll move on to the next concept. So next is perpetual and zero coupon bond. Perpetual and zero coupon bond. See, the first segment itself we discussed that the bonds are of 4 types. One is plain vanilla bond, then there is annuity bond, perpetuity bond, and then a zero coupon bond. Here we computed YTM duration volatility for plain bond, correct? Till now what we discussed, duration, volatility, YTM, all these things we discussed for plain bond, correct? Like that, we should discuss these things for annuity bond, perpetuity bond, and zero coupon bond. All these are different, correct? Now, for annuity bond, I'm not discussing here because it is not of much relevance for the examination, so I'm not discussing here. But what we will do is that perpetual bond and zero coupon bond, we need to understand the nature of transaction is different, so we need to understand these bonds, okay? Right, say, perpetual bonds are those bonds which pays only coupon till perpetuity and capital will never be redeemed. This already we know. The nature of perpetual bond is that, okay, the bonds will be issued and the capital will never be redeemed, which means every year the company which has issued the perpetual bond will keep on paying coupon till perpetuity, till the existence of the company. It is something similar to, what do you say?
perpetual preference shares, na? Okay, irredeemable preference shares. Like that, it is something similar to that, right? Every year coupon will be paid, but it will not be redeemed. So what is the value of this perpetual bond? Value of perpetual bond is nothing but coupon by YTM. Okay, we discussed the time value of money. Remember, discounted cash flow of how to compute discounted cash flow of perpetual cash flow. We discussed there, correct? Perpetual cash flow, how to find present value of the perpetual cash flow? Simple. Discounted cash flow is equal to cash flow divided by R, we discussed in time value. Okay, if you don't remember, please visit there and then get it done. See here, cash flow divided by R. Here, cash flow is nothing but coupon because there will be no redemption. Cash flow from a perpetual bond will be coupon only, na? Then the R is nothing but YTM. In case of bond, the R is YTM, right? Next, what is the YTM of the perpetual bond? YTM of the perpetual bond is nothing but coupon by bond price. I told you, okay. See, a bond price and bond value are interchangeably used, but don't think it is something different. Yes, actually it is different, but sometimes what institute does it, they use it interchangeably. We will assume the bond is trading at fair value. That is the understanding, whereas the price is used for fair value. Are you listening? So very simple, yeah. Value is equal to coupon by YTM. Okay, then what do you mean? See here, what is the YTM then? See, value is equal to coupon by YTM. Now YTM is equal to coupon by value. Correct. Here in this case, current price. When the current price is used, when it is trading at fair value. Okay, that is what is the formula. Coupon by bond price, or it can also be told value. Okay, value. If already value computed, then you will take value. Okay, right. Bond price is also interchangeably called as fair value. Next, duration of a perpetual bond. Duration of a perpetual bond is nothing but 1 plus YTM divided by YTM. Are you listening? This is the duration of perpetual bond. Okay, this you need to remember, no other choice. Okay, this formula you will need to remember. This is important, just you need to remember this. 1 plus YTM divided by Y. Okay, what is the volatility of perpetual bond? Duration by 1 plus YTM. This will remain same. The volatility formula which we studied for, what do you say that, which we studied for the plain bond, plain vanilla bond. Okay, it is same as plain bond. The perpetual bonds volatility formula for the perpetual bond is same as plain bond. Volatility for plain bond. Next, come to zero coupon bond. Zero coupon bond, as the name itself suggests, that it will pay only redemption value. Okay, it will be redeemed, but it will be issued at discount and redeemed at par. Okay, it will never pay any coupon in between. Are you listening? That the name itself suggests zero coupon. Pays only redemption and does not pay any coupon. It is issued at discount and redeemed at par, and this differential amount shall be the return generated by this bond, or this becomes the return to the bond investors. If you are investor, this difference becomes your income return. Okay, next, value of zero coupon bond. Now how to compute value of zero coupon bond? Very simple. This is like present value of single cash flow. Okay, zero coupon bond, what it is happening now? What actually happens? A redemption will take place, but there will be no intermediate coupon. Correct? In that case, whatever is the redemption value, okay, present value of that redemption value today will be your value of the zero coupon bond. See here, PV of redemption amount. Say after 8 years, the zero coupon bond is issued for 8 years, and it has a redemption value of some say 8 lakh rupees. Okay, what is the value? That 8 lakh rupees after 8 years at 10% or whatever the rate, discount rate is given, you will take that rate and discount it using YTM of that bond, and you will get the present value of the bond. That is the value of the bond. See, what is the YTM of zero coupon bond? YTM of zero coupon bond is computed using this compound interest formula. Very simple. Future value is equal to present value 1 plus R raised to the power n. We already know that. So rearrange it. What you will get? 1 plus R raised to the power n is equal to future value by present value. Correct? Appo, the YTM is nothing but R, na? Okay, the YTM is nothing but the rate of return here. So R is equal to, what you will do? Okay, root of future value divided by present value, the nth root of future value divided by present value minus 1. This is what is given. Okay, this is YTM of a zero coupon bond. Come to duration. Duration, if you are alive, please tell me what would be the duration of the zero coupon bond. Duration of zero coupon bond is nothing but its maturity period. Why? Because see, in the duration discussion itself, I told you that what do you mean by duration? How early you are getting your principal portion of the amount. Okay, principal portion of the bond is getting recovered. Correct? So if it is a coupon paying bond, then coupon also, the interest portion will also will actually what happen? It will recover your principal portion. Correct? In case of zero coupon bond, there are no coupons available. Correct? It will not pay any coupon. In that case, your entire bond value or principal portion of this bond, correct, it will get recovered at the end of the period, whatever is the maturity period. Say 8 years zero coupon bond, only on the 8th year only your what do you say, the bond value is getting recovered. So in that case, in between, since there are no cash flows in the form of
coupons, it will never be recovered. Okay, early recovery is not possible. So always remember, duration of a zero coupon bond is nothing but its maturity. Zero coupon bond, okay, duration of ZCB is its maturity, as it does not pay any coupon and investment amount is recovered only at the time of redemption. Okay, next, volatility of zero coupon bond, same formula, no change, duration divided by 1 plus YTM. Understood? Okay, we'll do quickly a question regarding zero coupon bond and then we'll proceed with forward rates. See here, a zero coupon bond of rupees 10,000 has a term to maturity of 8 years and a market yield of 10%. What is this? YTM, market yield of 10%. Now YTM 10%. Term to maturity is 8 years. What is the issue price of the bond? Issue price of the bond is nothing but value of the bond. They are asking value of the bond. Okay, how to compute value of the bond? Very simple. Is see, after 8 years, the bond will be recovered. Now the portion, the 10,000 will be redeemed. In that case, the cash flow is 10,000, which is going to you are going to get this inflow after how many years? 8 years. So in that case, 8 years, 10%. If you use the present value factor and discount it, you will get 4665 as answer. I don't need to specifically discuss. Okay, see here, answer is given, you can go through. Next, YTM of zero coupon bond, if it is trading at 4,000, see they have changed the data. If the price is 4,000, at this price, what is the YTM they are asking? I told you, na, bond triangle, the first segment itself I told you, value of the bond I discussed, na, there I told you that in a bond triangle there are three things. One is the bond price or fair value of the bond. Understood? Then there is YTM, then there is bond cash flows. Here, what they are asking is that they are given the 4,000 or bond price. If you buy the bond at 4,000 by paying 4,000 rupees and the YTM is 10%, they ask plus YTM. Cash flow will be same. Yeah, at the end of 8 years, you are going to get redeemed at 10,000 rupees. Now, the cash flow redemption value will be the only cash flow that will remain same. In that case, what is the YTM of this bond? We need to compute. Very simple. Yeah, YTM of the bond, how to compute? Very simple. IRR of the single cash flow, how we computed there. Okay, rate of return of single cash flow, present value of single cash flow we computed na. There how to compute rate, IRR, okay, we computed. How to compute? Very simple. Future value is equal to compound interest formula. Yeah, same thing. Future value is equal to present value 1 plus R raised to the power n. So R we need to find. R is equal to 8th root of 10,000 divided by 4,000 minus 1 is equal to 12.14. Are you all getting this? Okay, next. As duration of the zero coupon bond they have asked. See here, what is the C part? What they are asking? What is the duration of the bond? We already discussed now. Duration of the bond of a zero coupon bond. This is zero coupon bond. Nah. Zero coupon bond, there is no coupon. So there will be no recovery in the intermediate period, which means all the entire 10,000 rupees, which is the par value of this zero coupon bond, will be getting redeemed at the end of the period, right? So zero coupon bond, what is the duration of zero coupon bond? Is nothing but its maturity. We already discussed this, but I have also showed you the calculation how it becomes zero, how it becomes 8 years the maturity period. See here, duration of zero coupon bond is nothing but its maturity period, since there will be no coupon payments made in the interval period. See here, year 1 to 8 the cash flow will be zero. Why? Zero coupon bond. Yeah, next, present value factor at 10%. Whatever is the present value factor, if you multiply it with 0, you will get only 0. Next, at the end of 8th year, you will be getting the 10,000 as redemption. Then the present value factor at 10% after 10 years. How much is that? For 10 years, how much is the 0.4665? And the discounted cash flow is 4665. Proportion is 1, which means the entire value is getting recovered at the end of 8th year. So hence, it is proved that duration is nothing but its maturity, 0. See here, coupon of a plain bond, I have given as note, you can mark it as important. Okay, coupon of a plain bond recovers some principal portion of the bond, and hence duration of a coupon paying bond will always be less than its maturity. This is very important. Why? Because in one of the bond immunization question, I'm going to again revisit this concept. Okay, just simply try to remember that if a bond is a coupon paying bond, or we discuss a plain bond or like that, which is paying coupon, in that case, the duration, whenever I'm using duration, okay, I mean Macaulay's duration. We discussed now, duration is equal to the formula and the way we use now, formula, tabular manner, I showed you now, formula don't need to remember, I showed you tabular format, how duration is computed, correct? The proportion multiplied by number of years, all this we computed, correct? Now, this duration, whenever I use duration, you should always remember it is Macaulay's duration. See, you should not get confused. The volatility is called as modified duration. Okay, understand this, the volatility is technically called as modified duration, and the duration, simple duration, it is Macaulay's duration. This, I am referring to this duration, Macaulay's duration. Are you all understanding? Say. Now, what I wanted to discuss is that wherever you take a bond, if a bond is a coupon paying bond, its duration will always be less than its maturity period. Why? Because obviously before its maturity, it will pay coupon. Coupon will recover, even though it is very small amount, but it will recover some part of the principal portion, correct? In that case, coupon paying bonds duration will always be less than its maturity. Are you understanding? Next conclusion,
duration of a zero coupon bond will always be same as its maturity. Why? There is no coupon to recover the principal portion. So there will be the duration will always be its maturity. This you remember now. Why this is important? When I discuss this concept of bond immunization, there I will link it. Okay, just remember this. That is why I have given us a note. Less than its maturity, but for zero coupon bond, since there is no coupon paid, the entire portion of the bond value will be recovered by the redemption only. Therefore, the duration of zero coupon bond is maturity period. Next, volatility they have asked, go through duration by YTM, same formula. Okay, and the last segment they asked, see, what will be the percentage change in price of the bond if the yield declines by 0.5 points? See, very simple. 50 basis point, half percentage. Okay, half percentage if it is declined. See, the modified duration, volatility I told you, it always measures the change in price with regards to change in YTM. Correct? That too, change in YTM, if it is 1%, what is the measure it actually captures? Now, we got some, how much percentage is volatility? See, 7.13. Nah? This is, which means if YTM, what is the interpretation? If YTM changes by 1%, if YTM increases by 1%, assume the price, the bond price, okay, declines by 7.13%. Now, what is the question asking? The last segment, I think D portion, E portion. E. What is the percentage change in price of the bond? Correct. If the yield means here YTM declines by 0.5%. Instead of 1%, we only need to calculate 0.5%. In that case, what will happen? See, 1%, this is the change. 0.5% just divided by 2, you will get 3.565%. Inversely, it will change, which means if yield increases by 0.5%, the price will decrease by 3.565%. If yield drops by 0.5%, the price will increase by 3.565%. Everything is clear. Now we will move on to forward rates. Now we will discuss forward rates. Okay. Before understanding forward rates, I'll give you a simple example. Just remember this example. Why this is relevant, I will later explain. Okay. See here, I've coined an example here. 1 second. Okay. See, now we are discussing forward rates for our, see. Okay. Is it visible? Okay. So, now we are discussing forward rates and the different types of bonds we already covered. Now we are moving to forward rates. Very, very important discussion. Why understanding forward rates thoroughly is very important. Later in the interest rate risk management, we are going to study FRA, something called as forward rate agreement. Then there is swap valuation. Okay, interest rate swaps and currency swaps valuation will be there. There also FRA method is used. Okay, there also forward rates are very important. Bond futures pricing, there also it has relevance. So very, very important discussion. You need to understand it thoroughly. Computation alone, some students know how to compute this. Forward rate computation is different thing. Okay, we will learn how to compute that also. But there are so many methods for computing forward rates. We will discuss all those things. But conceptually, you need to understand what is really forward rates. Sarita, see, this is the example just to try to visualize. What happens is, see, I'm running a coaching center. Suppose a coaching center is offering you, okay, there are 3 subjects in group 1, correct? CA Final group 1, there are 3 subjects, assume, for now. Whenever I'm recording this, there are 3 subjects currently, correct? FR, assume this coaching institute is offering FR for 10,000 rupees. FR is offered for 10,000 rupees. Okay, now, see, the average cost will be same. If you buy one subject, FR alone, you have to pay 10,000 and you will get the course. Next, if you buy AFM also with FR, we have seen combo prices and all, na? Okay, everyone does this, right? Correct? So, if you buy AFM and all, what happens is, your cumulative price, you have to pay combo prices, na? The combo price will become 16,000, which means you have to pay 16,000 to get FR as well as AFM subject. 2 subjects you will get for 16,000. In that case, tell me friends, what will be the average cost for you? 8,000. 16,000 divided by 2, which is 8,000. This is the average cost. Agreed? Okay. See, don't think like in revenue standards, don't bring it. Okay, India is 115 revenue standards. I am offering discounts, sir. 10,000, 10,000, 20,000 should be the fees. 16,000 they're asking. So 4,000 is discount. Let me allocate the discount to FR and AFM. No need to all do that. Okay, simple example. Just understand. Okay, whatever is the number given as it is, don't go beyond the numbers. Okay, see. So 10,000 is there, which means you assume if you pay 2 subjects, if you pay 16,000, what will be the price for the AFM subject alone? 6,000 is the price. Okay, forget about discount. Assume that the price of AFM itself is 6,000, but no discount is involved. Are you listening? Now you understood? Okay, what I mean is that 10,000 is the price for FR. Okay, and if you buy AFM also, you will get cumulatively, you will get at 16,000, which means, okay, 6,000, the balance portion, 16 minus 10,000, 6,000 is the cost of AFM lecture. Understood? Agreed? Then, if this is the case, your average cost for the first 2 subjects alone will be 8,000. Agreed? This is the understand. Next, come to third subject.
Okay, this third subject if you add, if you buy 3 subjects, okay, if you buy all the 3 subjects, you will get it as get it at 21,000, which means on an average you have to pay per subject 7,000 rupees if you buy all the 3 subjects, which means what it means na, first subject you paid 10,000, second subject 6,000, 16,000 gone, then balance 5,000 is for audit. This is what is my understanding. Understood? This is what is the basic understanding of understood this example, right? What is the link between this example and our concept, forward rates, everything I'll explain. This if you thoroughly understand, you will never forget forward rates. Now come to forward rates discussion. See here. See. Forward rates is nothing but the yield which is expected for future years today, okay, which is expected for the future years today itself. This is what is forward rates. I'll explain it with a comprehensive question. Okay, in and out we will discuss, in detail we will discuss, don't worry. Just now keep on listening. After some time, okay, after 30 minutes you will get absolute clarity in this regard. Shall we start? See here. Take question number 9 for discussion. See, they have given the following data is for government securities are given. Calculate the forward rates. Now we will just focus on the calculation part. First we will calculate the forward rate. They have given calculate the forward rates and they have given, see, 3 different securities. Why 3 different securities I am given? See, government securities they have given. One security is having a maturity period of 1 year. Another government security, assume it is having a maturity of 2 years. Another government security, Government of India bond, which is having a maturity of 3 years. Like this, if you go to, on a given date, if you go to bond market and see, okay, there are 3 different bonds which are having varying maturity periods trading in the market. Are you all understanding? Okay. Take first security. Now what we will do is that, okay, before computing forward rates, we'll first try to understand YTM. Okay, we'll calculate YTM for all these bonds. Are you all listening? What is the relationship between YTM and forward rates? Everything we'll discuss. Okay, first they have given face value, they have given interest rate. Interest rate is to be understood as coupon rate, and they have given current price. Correct? With the given data, we will first compute YTM. YTM is the missing piece, na? We will compute YTM for varying maturity period. So maturity period, 1 year maturity, we will compute what is the YTM. 2 year maturity, we will compute the YTM. 3 year maturity, we will compute the YTM first. Then I will put it here. I will summarize it, and then we will proceed to the forward rate discussion. Very simple. See here. First, YTM. First 1 year bond YTM. How will you compute YTM? For a 1 year bond, how will you compute? Please tell me. See here. Year 0, you have an outflow of 91,500. Year 1, you have an inflow of 1 lakh rupees. Why? This is 0 coupon bond. As good as 0 coupon bond. Because 0% interest. Coupon is 0%, which means it will never pay interest. Okay, only redemption. Up the bond price, if you buy the bond today at 91,500. See, I am discussing one first year bond. 1 year bond I am discussing. Individually, I need to compute 3 YTMs. Agreed? First 1 year bond I need to compute YTM. Then for 2 year bond I need to compute YTM. Then for a 3 year bond I need to compute YTM. 3 different securities. These 3 different securities are trading in the market now. I will compute 3 different YTMs first. Agreed? This is the stepping stone for computing forward rate. Shall we see here? So for 1 year YTM, this is as good as 0 coupon bond. There is no coupon involved. So if you buy the bond by giving the price 91,500, if you buy the bond by paying 91,500 as price today, and it will get redeemed at face value. Obviously, it will get redeemed at 1 lakh after 1 year. If this is the case, if this is the cash flow, what is the YTM? Very simple. Okay, compound interest formula you will use. Year 0 you will have outflow of 91,500. Year 1 you will have interest redemption of 1 lakh, which means present future value is equal to present value 1 plus r raised to the power n. Same formula you will get rate at 9.29%. I don't want to go deep into calculation. These are all repeatedly I discussed how to compute and all. We are not focusing on the calculation part. Okay. Already you know that is why. Okay, right. So 9.29 we got the YTM of the 1 year bond. I will write it here 9.29% per annum. Okay, in our subject, wherever percentage comes na, interest rate percentage comes na, it is to be by default it is to be understood as per annum interest rate. Unless otherwise specifically told, you should not understand anything. The shorter period time, if you want to compute the interest na, you should take the period interest. You should compute the period interest by taking annualized interest rate as the base. Understood? Next, come to 2 year bond. Here 2 year bond, there is a catch. There is an interest rate given in this bond. Understood? So there is 10% interest rate is given. Now at present you will interest. Year 0, you will invest. You will pay. How much is the price? 98,500 for the bond. And what you will receive at the end of year 1, you will receive 10,000. 10,000 in the sense 10% interest coupon. Coupon will be applied on what? Market price or face value? Face value. So 10% into 1 lakh, 10,000 is the interest at the end of year 1 you will receive. Correct? This is 2 year bond. So first year end you will receive 10,000. Then
in the year 2 also, end of year 2, you will receive interest now. How much is that? Same 10,000. And apart from that, there will be redemption, which will be at face value. Correct? Nothing they have mentioned in the question. It will be redeemed at premium or discounted. Nothing mentioned. Now you always assume to be redeemed at par. Which means what is the face value? 1 lakh. You assume redeemed to be par. So what is the cash flow? Year 1 10,000 you will receive interest. Year 2 10,000 plus 1 lakh of capital portion. Okay, principal portion. 1,10,000 you will receive in the year 2. In that case, what will be my YTM? Okay, first approximate formula. We already discussed how to compute YTM. I'm not going to that. Please go back and see this. Okay, interest plus amortization divided by S3 plus RV by 2. Average amortization cost you will take, and 10.85 is the approximate formula. I told you, if you use this formula, you will only get approximate YTM and not exact YTM. Exact YTM you need to do trial and error and find using IRR method. Correct? That I have also showed you. All these things you can go through. I don't want to discuss the how to compute YTM and all is not our subject matter of discussion. Already it is discussed. See, final YTM what I get is 10.87. Okay, given here how I computed 11%. I took 11% as the base. See, approximate formula 10.85% we will get now. Then, which means ideally the real YTM, exact YTM is in between 10 to 11%. We need to do interpolation. At 11%, YTM 11%. Now, what is the bond price? I have computed 98 to 85. But at 10%, I don't need to compute. Why? If you are all awake, okay, if YTM is 10%, okay, the bond will be trading at par. Yeah. Why? The coupon is also 10%. I already told, remember, whenever the YTM yield is exactly as coupon rate, okay, which means the bond is trading at par. You don't need to compute the bond value. Bond will always be the par value, which means in this case, the 2-year bond par value, okay, the par value is 1 lakh. Because the YTM is also same and the coupon is also same, the bond will always be trading at par, that is 1 lakh. So which means at 10%, my value is 1 lakh. At 11%, my bond value is 98,285. But I want something in between. What is that? See here, bond price is 98,500, which is in between these two values. So I'll do interpolation to get 98,500 as my bond value. What will be my YTM? YTM is 10.87. Computation and all, please go through whenever you get time. See, 10.87 is the 2-year bonds YTM. Understood? That also I will write it. 10.87. 10.87% is the YTM for a 2-year bond. Next to come to 3rd year YTM. 3-year bond YTM. What is the YTM of 3-year bond? Now see, here the 3-year bond is giving 10.5% as coupon, which means every year I'll get 10,500 up a 3-year bond. Now first year I'll get first year end I'll get 10,500, second year end I'll get 10,500, third year end I'll get 10,500 plus 1 lakh as redemption. So I'll get how much? Okay, 1,10,500 as 3rd year cash flow. Correct? And I'll invest 99,000 today, which means how to compute same the formula you will use. Okay, interpolation and all I did, and I got the value as 10.91. Okay, believe me, this is the YTM I am getting, 10.91%. What is the relevance of this? I will discuss now. Okay, 10.91%. Agreed? Okay, now I have computed YTM for varying maturity period. Okay, through the bond market. I go to the bond market and see that there are 3 different securities traded, and these 3 securities give me an idea of what is the yield structure now. This is called as yield structure. This is called as yield structure. YTM of varying. See here, 9.29, 10.87 and 10.91. Just remember this. This is YTM for 1-year maturity period bond. This is YTM for a 2-year maturity period bond. This is YTM for a 3-year maturity bond. Are you understanding? Okay. Now, core discussion starts. See here. What I want to calculate is forward rates. Before going to forward rates, first, what are these rates, sir? You will ask. I'll tell you. Okay, I'll tell you a practical example. When you go to a bank, okay, have you all seen? When you go to the bank, in the outside itself, they will be having some big board. Okay, the villages and all, they will be posting in a big board interest rate. Okay, interest rates. If you deposit for varying deposit maturity period, they will post some interest rates. Have you all seen? See, very simple. If I go to State Bank of India, okay, and I see a board there, and it will have some details. 6 months deposit, the interest rate is some 5% per annum. Okay, all these are per annum. And if 1 year period, if I deposit my money, okay, FD rates will be given. Listening? And senior citizen rates for different people, everything will be given. Are you listening? So I'm just trying to make you understand how this actually works. So the quotation, if you go to this State Bank or any other bank, we see that for 1 year bond, it will have 6% per annum. Okay, then if you deposit for 2 year, it will have some 7% per annum. Okay, then if you deposit for 3-year period, it will have 9% per annum. Assume this is the this is the data given. How to interpret this data? What it really means now? See, these are all quoted by same SBI or same bank. Yeah, same institution is quoting all this.
Here also in our example, all these bonds, different bonds are given. These are all given by the same entity. Government securities. These are all government security. Correct? Institution issuing these securities are same or different? Same. Like this, here also I say, suppose this is SBI. State Bank of India is issuing these details. They are giving all these details. Now tell me, okay, what is the understanding? See, you have 1 lakh rupees money in your hand. If you deposit for only 6 months, you will get 5% per annum interest. 5% per annum, 2.5% per 6 months. Like that you can understand. Like that, if you deposit for 1 year period, what is the interpretation? If you deposit the amount for 1 year, you will get 6% per annum. If you deposit for 2%, 2 year, you will get 7% per annum. Now sir, how the interest rate is changing by varying maturity period? I discussed, remember? Okay, in the time value of money itself I discussed that if the interest is nothing but a compensation for time also. So which means more the maturity period, more the uncertainty of the cash flows and more the risk. Correct? For compensating the risk, the bank will pay you extra interest. Okay, because you are locking your hard-earned money for 2 years instead of 1 year. If you are locking your money for 2 years, bank can transact for 2 years. They can lock they will have their money, understood? They don't need to repay your money for 2 years. Correct? So they will offer a higher interest rate to compensate you. Same way, 1 year, that is why this is called as term structure or yield structure, which means, see, 1 year if I deposit, I'll get 6% per annum. 2 year if I deposit 7%. If you deposit for full 3 years, you will get 9% per annum. Like this, okay, and a senior citizen, they will give some other rate because older person, they will value their money more. So they will offer a higher interest rate. See, all these things are available. This is called as term structure or yield structure of a bond. Okay, I explained you with fixed deposit, bank fixed deposit and all, but the reality is same, fixed income security. It is something similar. Bond also you can visualize like this. Okay, now what is the understanding? You need to carefully observe what it really means. See, what this really means, 1 year, take 1 to 6 months, you forget about it. I don't want to confuse you. Take 1 year, 2 year, 3 year. Okay, so 1 year, what is the understanding? If you deposit your money for 1 year, you will get 6% per annum. That is very important. If you deposit your money for 2 year period, you will get 7% per annum. Correct? Now, is it really that every year you will get 7%? No, it is average yield. YTM is always average yield, which means annualized yield only, but on an average, what you earn over a period of time only captures, yield to maturity captures what you earn over a period of time, which means the name itself suggests yield to maturity. If you buy the bond at current price and hold till its maturity, what is the yield you will earn? Correct? In that case, the maturity period may not be always 1 year, 2 year, 3 year, 4 year. It will be earned over a period of time. It will not be earned in a single period. Correct? Now, what is the understanding? 2 year 7% per annum. See, 1 year bond is 6% per annum, 2 year bond is 7% per annum, means on an average, I will earn 7% per annum for a period of 2 years. 3 year bond, on an average, I will earn 9% per annum for a period of 3 years. Really, it doesn't mean that in the second year you will earn 7%, exactly 7% in the first year, exactly 7% in the second, not necessary. Understood what I'm trying to say? Third year also, 9% per annum is what? Over a period of 3 years, on an average, you are earning 9% per annum. This is YTM. This is very, very important. Now you link it to the subject I told you. Remember, now if I will get back to that. See here, if I tell you that 7,000 is the fees for the entire group, you tell me, is the fee structure like FR 7,000, AFM 7,000 and audit 7,000? It is something different. It might be different. Understood? FR is costing 10,000, AFM is costing 6,000, audit is costing 5,000, but on an average, all these things together, okay, costing me 7,000 per subject. This is something similar to this average cost is something similar to YTM that you need to keep in mind, which means on an average, I will have to pay 7,000 per subject if I buy all the 3 subjects. Like this, in the maturity case, what is happening? YTM is 9%. In this case, I'll come back to the original discussion itself. See, forget about fixed deposit. Come to this bond question itself. In 3 year bond, I am earning 10.91% as YTM. What is the understanding? On an average, okay, I am earning 10.91% per annum for this 3 year maturity period, which means you tell me first year 10.91, second year also 10.91, third year also 10.91. No. Okay, first year I earn 9.29%. 2 years average I earn 10.87%. Then what is the rate of the second year? This is the forward rate. Are you all listening? Are you all understanding? What is the rate used for the second year, expected for the second year? What is the rate which is expected for second year? This is called as expectation theory. I try to predict the forward rate using spot. Different YTMs are given spot yield structure. Using the spot yield structure,
I am trying to visualize what the market is trying to offer me. Are you understanding? I see that on any given day, today, 1 year bond is trading, 2 year bond is trading, 3 year bond is trading, and the yield structure of these three bonds are these numbers. Using these numbers, I see that 1 year bond is trading at 9.29%, which means there is no forward rate involved, which means for 1 year, 9.29 is the rate, market interest rate, assume. Then a 2 year bond is trading at 10.8, giving a YTM of 10.87% per annum means, okay, first year I'm earning 9.29. On an average, 2 years I'm earning 10.87, which means what is the rate for the second year? What is the expected rate for the second year? Through numbers we will compute. Are you all understanding the first interpretation part? What is really forward rates? Okay, forward rate is a rate which is for a given future date. Okay, for a period of some FRA, we will study that. I will discuss it detailedly. Now you are trying to predict the second year's rate using spot yield structure. This is the forward rate, and how to arrive at forward rate I will discuss. See here, we will compute forward rates now, and I will again link it back here. See here, calculation of forward rate for year 2. Year 1 there is no need to compute forward rate. Spot 1 year rate is given now. So individually computing 1 year rate is the forward rate. Very simple. I'll go back to the discussion. See here, this is nothing but forward rates. 10,000 rupees is the FR rate. If two subjects on an average is giving me 8,000, okay, or I need to pay 8,000, which means for the second subject what I need to pay, that is 6,000. For the second year, what is the rate which I am forecasting? Are you all listening? Okay, and if 3 years rate is 7,000 on an average, okay, and first year rate, first subject is 10,000, second subject is 6,000. What is the third subject? 7,000 into 3 you will do 21,000, minus 10,000 minus 6,000, you will get balancing number of 5,000. Are you all listening? Now can you can you interlink the forward rates? See, now we'll compute the forward rate. Now we will come back how to compute forward rate. Conceptually understood what is the forward rate and all. Now we will quickly try to compute the forward rate and do 1 or 2 questions quickly, and we will see one different coupon paying bond, how to arrive at yield structure, how to find yield structure of a zero coupon bond. All this I will, okay, how to compute forward rates quickly in a shortcut method for a zero coupon bond I will discuss, and then move on to the next topic. See here, calculation of forward rate, how to compute is, you have to, very simple, I'll one second, I'll show you here, cash flow, present value factor at some percentage, okay, then you have discounted cash flow, correct? This is how it will be. Now we are computing for year 2 forward dates, correct? Now what we should do, 2 year bond you take, the formula and all you forget, I will explain you again, don't worry. See, year 1, year 2 is there. Now this is a 2 year bond, first write the cash flow. 10% is a coupon rate, correct? Upper first year cash flow you will receive 10,000, already discussed. Second year 10,000 you will receive as interest coupon plus redemption will be there, and cumulatively I am rating 1,10,000. 10,000 is interest portion, 1 lakh is redemption portion. Now present value factor, okay, first year present value factor you already know, correct? What is that? You tell me 9.29%. You will apply 9.29%. I don't want to compute some number here. Okay, 9.29%. If you compute the first year present value factor, you will get it, and discount factor, discounted cash flow, you will get some number. Are you listening? Next, second year redemption value. Okay, YTM is the see here. 1 second. You need to compute at what rate you need to discount the second year cash flow. That is a forward rate. See, very simple. 2 years cash flows are there. First year cash flow, you will use first year discounting rate, which is obviously given 9.29%. Correct? Second year cash flow, you need to discount using second year rate. For that, you need to compute forward rate. That you can use the bond valuation method to compute forward rate as well. This is same, if you see, notice 10,000 is the first year cash flow. Cash flow 1 divided by first year discounting rate. Correct? Value of the bond, price of the bond is 98,800. You just need to equate it. 98,500 is equal to 10,000 by 1.0929 plus 1,10,000 by 1 plus R2. R2 is nothing but year 2's rate, that is which is forward rate, correct? Which is not known. That is why I simply put it as R2, 1 plus R2 into, if you discount the second year cash flow to first, using second year rate, you will bring the second year cash flow to first year end. Then again, if you apply 9.29%, then you will bring it to year 0. 98,500 will be the value. Now if you see, the total discounted cash flow will be 98,500. You need to bring the value to 98,500. But you don't know what is the discount rate to be used to bring the second year cash flow to first year. Are you listening? So balancing figure, I can find it out. How to find? Very simple. The same formula. First year cash flow you discount using first year rate. Second year rate is nothing but second year cash flow you need to discount using second year rate into first year rate. How this is computed? Very simple. I already discussed. 1 plus, if you are discounting at 10% for 2 year period, see 1 plus R raised to the power n. First year cash flow raised to the power n, it will be 1. Okay, next year cash flow will be discounted using, see, some cash flow is there, into 1 divided by 1 plus R raised to the power 2. Third year cash flow will be discounted using 1 divided by 1 plus
r raised to the power 3. Like this you will discount using respective rates, correct? But only catches if R1, R2, R3 is all same, na, this we can do. Agreed? If R1, R2, R3 everything is same, na, you use, or you can directly use YTM. YTM is nothing but average rate. In this case also, okay, I have given this solution, you will compute R2, okay, see here, if you equate it, you will get it, very simple part, 10,000 divided by 1.0209, 10,000 divided by 1.0929, you will get how much? You will get how much? 9149.9. Okay, assume 9150, you can round it off, 98,500 minus 9150, you will get 89,350, correct? This you will equate to this portion, you will get R2. Okay, you already know how to compute. I don't want to discuss further. Okay, same thing. R2 we computed. Same way you compute for R3. Before going to R3, I'll also prove that it can also be solved in some other way. See, very simple. I'll show you. We can use, see, anyway, YTM is average rate for 2 years, na? Okay, 2 years cash flow, second year cash flow, you can use by second year rate also. Remember, first year cash flow also you can use average first year rate, average rate of 2 years. Second year cash flow also you can use YTM rate, correct? Appo YTM if you discount, you will get the same value. Remember, appo I can also write, see, 98,500 is equal to 10,000 divided by, okay, or why I am putting divided by now, or you can write 10,000 into 1 by 1 plus r raised to the power n. Into 1 by 1 plus r raised to the power n is same as divided by 1 plus r raised to the power n. Here 1 plus r, now I take YTM. YTM is 10.2 years YTM I will take. 2 years YTM, how much is 2 years YTM? 10.87. Can you all see this? 10.87. Okay, now what I will do is that 10.87, now how I should take, I told you na, in the calculator we should use 10% now 1.1. Now how we should use 1 divided by 1.1087. Are you all listening? This is how you will write for discount using 10.87%. Okay, 1.1087. In this case, 10,000 divided by 1.1087. Now how much you are getting? Please tell me. 1 second. Okay. 10,000 divided by 1.1087. You are getting 90. See this value as 9019.5. Next year plus the second year cash flow will take now 1,10,000. I will take here. But what I will do is that instead of 1 plus R2 and instead of bringing second year cash flow to first year using second year discount rate and then again using first year discount rate to bring it to present value terms, rather than that, what I will do is that I will use YTM for a 2 year period. YTM is given now 10.87%. I will directly discount 2 times. 10.27% per annum, that you should remember. Up 10.87%, I will discount using the same rate 2 times and then bring it to year 0. Correct? That also is possible. In that case, what will happen? Okay, divided by 1.1087, okay, into 1 divided by 1.1087. This is nothing but 1.1087 the whole square. You can also use like this, 1.1087 the whole square. Please tell me, first you do 1.1087 into is equal to the whole square, 1.229. Okay, now 1,10,000 divided by 1.229. How much is that? This is coming to 89,504, rounding up, 89,504. Now you add these two cash flows, how much you are getting? Plus 9019.5. How much I am getting? 98,523. Okay, 98,523. Are you all getting? And the 523 give it to 23 rupees give it to beggar. Yeah, that is rounding off difference. Don't worry. This is exactly will matches 98,500. Are you all listening? So what I wanted to say is that now you understood conceptually YTM is average rate per annum for given maturity period. But forward rates is for that particular year which you are expecting today. But why it is called as forward rate really? Because it is not spot rate. This rate is implicit rate. Okay, this rate is implied by the yield structure given in the market, and it is not given as such. It is not explicit rate given. Second year rate is this much not given. Are you listening? Okay, this is the importance of the bond pricing. I don't want to go deep. Third year also the computation remains same, which means very simple. Here 3 year bond, you remember 10.5 is the coupon, so I take interest first year 10,500 using first year discount rate. I discount, then second year cash flow 10,500 interest. I discount, here I found out now second year rate 12.65. I put 12.65 here and then bring it to first year terms. Then first year interest rate I put it and bring it to year 0. Listening, present value. So both these are present value. Now last also I need to bring it to present value. Correct? See here, year 1, 2, 3. Cash flows are given part 10.5k, 10.5k and 110.5k. Now what I need to do is that I need to pull all these to present value. Correct? I need to find present value, which I will equate to the price of the bond, which is respective bond 99,000. I will equate. If you equate to current price, you will get the rate. Only simple thing here. You just need to find out the respective rate for the year. Okay, respective rates, year's rate. Okay, see here, 1,10,500 divided by 1 plus R3. Okay, I don't know what is the rate. I will anyway equate and find it out. But other two rates I know now. Now I will substitute 1.1265 now, 12.65. Then again multiply with, see here multiplication is as good as, see into 1 by 1.1265 into 1 by 1.0929. Here also 1 plus R3. Are you listening? This if you solve, you will get R3 as 11%, which means, see, very simple. I'll summarize this. Okay, I'll summarize this, all the discussion. Please listen. See, I have YTM yield structure given like this. I have been given the yield structure. I actually found out sometimes the question will give you the yield structure directly. So you don't need to actually compute. Sometimes yield structure will be directly given. Here, I have been asked to compute, so I computed. Right? So come back to the discussion. See here. To summarize, this is the YTM of 1 year bond is 9.29%. This is a 10.87 for a 2 year bond. For a 3 year bond, 10.91%. See, very simple. What is the understanding now? On an average, I will earn 10.87% per annum for a 2 year bond, which is as good as earning 9.29% per annum for the first year and 12.65% for the second year. Are you understanding? And 10.91% is also there na. That is, okay, earning 10.91% yield on an average for a period of 3 years is as good as earning 11%. Forward rate for third year is 11% na. So earning 11% for third year, earning 12.65% for second year, and earning 9.29% for a first year. This is what it will be the same. All these things will be same. It's as good as earning individually these rates. This is what we understand. Now, this 12.65% and 11% are not quoted today. These are all forward rates. That's why these are called as forward rates and not spot rate. In the spot, you have been given the YTM for varying maturity period and you have given the 1 year rate. Using this term structure, you are trying to predict the future. You are trying to predict how the interest rate markets is going to be in the next coming years. This is based on expectation theory. We call this as expectation theory. Okay, and I have discussed I've discussed this question. I've given notes also. See, go through. 1 year bond is 9.21, 2 years bond, 3 year bond. In the above table, we can see that the 3 year bonds, even though from the same institution, are trading at different yield. Okay. See, the risk of why this is giving different yield for different years. Now I told you because institution risk is there. No, because same institution is issuing. Take RBI or take SBI or any other bank. Same bank will offer different interest rate for different maturity period. Bond is also. But what is the issue? What is the reason for which they are using different rates, giving different rates? Now because of the term risk, which means 1 year maturity period. Now the risk uncertainty will be lesser. Na? Okay, the more and more the maturity period is far away. Now what happens? Okay, the uncertainty is more, so you need to compensate for the risk. Time value of money is simple thing. Okay, they need to compensate. So more compensation, more interest rate will be given to you. The public expects a yield for 9.29% for 1 year bond, 10.87 yield from a 2 year bond, and from this we can expect how much they are we can understand how much they are expecting for the second year. This is based on expectation theory. This is called as forward rates. From the calculation, the above problem, we can conclude that the public expect return of 9.29 for first year, 12.65 for second year, and 11% for the third year. Discounting the 2 year bond cash flows at an average yield of 10.87% per annum for 2 years is same as discounting the second year cash flow at 12.65 and first year cash flow at 9.29. If you remember, we discussed in the third question, bond valuation segment in the same division. Okay, remember one question we did different discounting rate for different years. We took and solved one valuation question. Okay, the purpose is same. Okay, the forward rates are generally used for the following purpose: pricing bond futures pricing. It is very much useful. And if you want to issue a 1 year bond today, we can issue at spot yield of 9.29. But if you want to issue a 1 year bond after 1 year, something similar to FRA. We are going to anyway study. Okay, FRA when we study, okay, we will say that if you want to borrow or if you want to lend money after 1 year for a period of 1 year or 2 years, whatever is that. Okay, which means not today. You are going to enter into transaction today or tomorrow, not today. For that, based on this expectation theory, you are trying to lock in with some interest rate. That is where forward rate will be very helpful, so that you can remove the uncertainty and your cash flows. You can hedge your cash flows and remove the interest rate risk. That is why we will discuss all this in interest rate risk management. Okay, suppose we want to issue a 1 year bond after 1 year, we can freeze the yield today at forward rates. Okay, forward rates are used for pricing interest rate derivatives like FRA, interest rate swaps, everything we will discuss in detail there. Now I don't want to confuse you, right? Where the term structure is given for a zero coupon bond, their YTMs are called as zero rates. In such a case, okay, forward rates, where for zero coupon bond, forward rates can be computed by simple method called as bootstrap method, which I will discuss. Okay, now I will discuss the bootstrap method. With this, you will clearly understand what this is all about. Okay, so take question number 10 for discussion.
Okay. The following is the yield structure of AAA rated debenture. Period is given, yield is given. Now see, in this question, unlike the previous question, they have not given the coupon rate. Any data given about coupon? Nothing is given. So which means it is assumed that it is zero coupon bond. See here, based on the expectation theory, calculate the implicit 1 year forward rates in year 2 and year 3. Assume that the bond's fair value is 1000 rupees. See, I already explained you two methods. There are in total three methods, various methods for computing forward rates, calculating forward rates. Now what we do is that, see, first two methods now, we will do using first two methods. Then I will explain the bootstrap method, third method, which is even more simpler. But it can be only applied, the bootstrap method only can be applied in the zero coupon bond and not on the coupon paying bond. You cannot do calculate forward rates using a bootstrap method in the coupon paying bond. That you need to understand. See here in this question, see, we will do first what we will do, the face value is given and we need to compute the price of this zero coupon bond first. Okay, so what we will do, year 1, year 2, year 3 bonds, now we will take YTM. Anyway, YTM is given, all these are yield na YTM. Okay, I told you YTM is like average yield, which means here in this case, forget about 3 months, 6 months and all, not at all relevant. 1 year, 2 year, 3 year YTM. 1 year YTM is 10.5%, 2 year YTM is 11.5% per annum, 3 year YTM is 12% per annum. In this case, what we will do is that we have YTM and we have face value, which means redemption value. Okay, because this zero coupon bond and redeemed at par, issued at discount and redeemed at par. So we have only one cash flow, that is redemption, which is happening on the face happening at the face value. See here, year 1 bond, 1000 rupees is the cash flow, into 1 divided by 1.105. Why it is so? 1 year YTM is 10.5%. So we calculate price using this method. We already know that. Now what we will do, using the respective prices, we try to equate and find out the second year forward rate and third year forward rates. Correct? Previous question we did the same thing. Remember, see here the price is 807.98. Equate it is equal to, what do you do? 1000 is the cash flow divided by, okay, 1 plus R2. If you do 1 plus R2, which means discount it using second year forward rate. R2 means I don't know the rate now. I need to find that only. So I will put it as R2. That will bring the 1000 cash flow. That will bring the cash flow to first year end. Then what we do is that again I discount it by using first year rate, that is 10.5% of YTM up 1.105. Okay, I discount it again and bring it to year 0. Okay, now if I equate, I'll get R2 as 12%. Are you all getting? Next, okay, there is another alternative. This also I already explained, which is nothing but YTM. Yeah, see here is, see, 1000 rupees discounted using second year rate and then using the first year rate to bring it to year 0. See, 1000 rupees is the redemption value. If you discount this cash flow using second year rate, you bring it to first year end. Then you discount again first year YTM and bring it to year 0. Correct? Either this way you can do, or you can straight away, I told you, average rate na YTM. Average YTM for 2 years is what? Is nothing but 11.25%. Correct? If you see the question, okay, average YTM rate for 2 year, see here, 2 years YTM is 11.25% per annum. What is the understanding? If you discount this 1000 rupees at 11.25% per annum, which means 1000 divided by 1.1125 the whole square. Are you all seeing this? If you discount it 2 times, you will straight away get this 807.98, which means, okay, how to get, we discounted and equated, but how to get this R2? Same thing. Okay, this thing you can equate it to this number now. Are you all seeing? See, very simple. 1 plus R2, this is the year 2 discounting, correct? Into 1 plus R1, that is 1.105. Okay, 1 plus you remove it because 1.105 is as good as 1 plus 10.5%, 0.105% is equal to 1.1125 the whole square. Are you all getting this? If you solve this, okay, you will get again the same answer, 12%. This also I explained you, remember? So this is one of the alternatives, second alternative. Now come to the main discussion. In case of zero coupon bond, all these hassles can be avoided. What you can simply do now, observe the question carefully. If it is a coupon paying bond, you cannot apply bootstrap method. How to apply bootstrap method, I'll let you know. See, very simple. Here, 11.25% and all you forget. Now see, carefully observe what I'm doing. Okay. Now 2 year average rate is how much? 11.25%. What I will do is that 11.25 into 2. This is 2 year rate. Agreed? Minus, okay, from this is rate for cumulative rate for 2 year. Correct? I will multiply it by 2 and then I'll reduce the first year rate, which is 10.5%. The subject example I did, remember? Okay, an average rate was 8,000 multiplied by 2. You will get for 2 subjects, you will get 16,000. correct? From the 16,000, you reduce the first subject price and then you will get the second subject price. Are you listening? Like that, here also 11.25 into 2, how much is that? Please calculate and tell me. 11.25 into 2, how much is that? 22.5 minus 10.5, how much is that? 12 divided by 2 minus 1, second year na. Okay, 2 years rate, this is for 2 years rate and this is first year rate. Upon numerator you took 11.25 into 2, correct? Minus, reduce the first year rate and you will get the rate for the second year, exclusively for the second year. This is bootstrap method, very simple method. Are you all getting? Now, the 12%, you got the forward rate for second year as 12%. Straight away I can get the solution. Next, 3 years and above, so come to third year rate. How to compute third year rate? Very simple. You have 12%. Correct? 12% into 3, which is 36, minus what you will do? 11.25 into 2. 11.25 into 2, how much is that? 22.5. Correct? Minus 3 by 2 is equal to 36 minus 22.5. How much is that? 13.5%. This is exclusively forward rate for third year. Is nothing but 13.5. Again, this is simple method, but only you can use, remember, only you can use in zero coupon bond and not all the other bonds. Can you see this bootstrap method? Okay, 13.5. All the things I have given here, and YTM for 2 years you can compute, equate it and find the R3 by other two methods. I'm not discussing, I'm moving. Okay, same question again given, and here explicitly given that is zero coupon bond. I told you some question will not give it explicitly. You have to understand, okay, whether they have given the coupon or not, whether it is zero coupon bond or not. They might mention, but they might not mention also. Okay, you can understand through the facts of the question. Shall I proceed? This is the same question, you can go through simply. Okay, the same question, but bootstrap method. Simply I can see zero coupon bond. Now you forget about everything. They have calculated, they have asked us to complete implied 1 year forward rates for second and third year. How to do you bootstrap method? One more time I will explain. 11% now, 2 years average YTM. YTM is 11%. They have given YTM na. YTM na 11 into 2 minus first year rate 10. Correct? How much is that? 11 into 2, 22 minus 10, 12. 2 minus 1, obvious. So 12% is the rate. Second year forward rate, this is, okay, forward rate is how much? Second year forward rate is 12%. Third year forward rate is how much? 12 into 3, which is 36, minus 11 into 2, how much? 22, which is 14%. Correct? Upon third year rate is 14%. I can quickly compute without considering anything. But one more thing is asked in this question, I think. Yes, expected yield to maturity and prices of, yes. One more thing I wanted to discuss in this question. See here. First we computed using bootstrap method, we computed the forward rates for year 2 and 3. That is clear. But next what they are asking, expected yield to maturity and prices for 1 year and 2 year zero coupon bonds at the end of first year. See, what they are doing is that, what they are asking is that after 1 year, they are again asking us to compute 1 year forward rate as well as 2 year forward rate. Understood what I am trying to say? See, 1 year prices of 1 year and 2 year zero coupon bonds at the end of first year. Expected yield to maturity. Two things you have to find. One is that expected YTM for 1 year YTM, 2 year YTM after 1 year. Okay, total 3 years. See here, the bond was originally for 3 years. 0, 3, 1, 2 and 3. Understood? We computed the forward rates for, see, this period and then this period. We computed the forward rates for these two periods. Now what they are asking, you are not standing today, 1 year finished. Now after 1 year, this 1 year YTM, okay, they are asking, and then they are asking 2 year YTM. Understanding? Balance 2 years there, 2 year YTM they are asking. Then price at the end of 1 year, again, prices of 1 year bond and 2 year bond. After 1 year, okay, first year you remove it. After 1 year, okay, what they want to ask is that 1 year YTM and 2 year, 1 year YTM, 2 year YTM, and then 1 year price of the bond and 2 year price of the bond. Are you all understanding? Okay, how to compute it? Very simple. Forward rate I already discussed. This is there. Expected prices and YTM. How to find? Very simple. You already know the forward rate, which means second year forward rate 12%. Face value is there. Then what do you do? Okay, simply use the compounded annual compound interest formula and then find YTM. That will be same. Okay, 12% will be the solution. Next, third year is only which I wanted to discuss. See here, what they have given in the third year. Now we already computed forward rates, correct? The forward rates means exclusively the rate for the third year, which means we have exclusive rate for third year. In the sense, after 1 year, the forward rate for 2 year forward rate will be 14%. That will be same. Understood?
and 1 year forward rate will be 12%. They have asked what is the cumulative rate, which means the YTM, average rate, which means simple pa. Again, bootstrap method you can apply because this is zero coupon bond. Upper 12 plus 14%, 26 na, divided by 2. Simple 13% you will get a solution. And you can also equate it to price and find it out, which I already discussed. Okay, I don't want to waste further time in this segment. Are you all listening? 13% how I got na? They are asking YTM in this segment. Remember, they have give first step we calculated forward rate. Second step what they are asking is a YTM. So reverse working you need to do and then find. Okay, 1 year forward rate after 1 year, originally it was 3 years. After 1 year, okay, 1 year forward rate is still 12%, and the third year rate, which means after second year forward after 1 year is 14%. Upper 12% individual rate is there, 14% is there individual rate for second year. If you find if you cumulatively club this and find it out, the YTM, you will get the average YTM as 13%. Are we clear with this? Shall I proceed? Next, bond immunization. Very, very important concept which I wanted to discuss here. Observe here. See, what is this? I will explain initially. You will get absolute clarity after say 20-30 minutes when I elaborately discuss a concept clarifying question in this regard. Question in the sense we will do a comparative study and 2 data we will take and study. Then we will understand what is this really. Okay, fully we will understand. But till that time you have to just listen and believe me. Okay, see here. What is this immunization is all about? Okay, immunization is a concept of protecting the yield of our investment in bonds, okay, due to the interest rate changes. We already discussed that. If market interest rate changes, see every 2 months, RBI comes up with bi-monthly MPC, monetary policy meeting. Correct? In that meeting, they will decide how much interest rate is to be kept for the next 2 months, like that. Okay, next quarter or whatever they decide. Understood? So in that case, interest rate will be frequently changing. Correct? It depends upon the monetary policy of the central banks. So what is happening? When they change interest rate, I already told you, when the interest rate changes, YTM will also change. Correct? YTM changes because the price will get affected. When interest rate changes, okay, when the yield changes, the price will get inversely affected. In the sense, suppose the yield is increasing. If the interest rate is increasing, the price will get reduced. Conversely, if the interest rate is getting reduced, market interest rate is getting reduced, then the price of the bond will increase in the market. Correct? They are inversely related. I already discussed. Now the point is, you have bought a bond today. Correct? You go to the market and you have bought a bond. Assume you have bought a bond X. Now what is the issue now? Tomorrow, if RBI, okay, increases the interest rate, just to remember, okay, your bond price will reduce, the market price of the bond will get reduced, correct? So your investment, value of your investment will drop, so you have price risk. This is called as price risk due to interest rate changes. So you have 2 risks arising from the bond. Okay, see, bond immunization is a risk management strategy, but what the risk is here, I am explaining. Carefully observe, when market interest rate changes, you have number 1, price risk. Price risk in the sense, if interest rate goes up, the price of the bond get reduced, correct? You bought the share 1 year back and at that time interest rate was 10%. Then RBI came up with a interest rate hike. What happened? Market interest rate changes to 12%. Then in that case, what happened? Your bond price, today's market price of the bond drops. In that case, you will lose the market value, correct? Your investments value, market value of your investments got reduced. In that case, this is called as price risk. This is price risk. There is a risk or not? Yes. And there is another risk, which is, of course, reinvestment risk. What the problem is, I'll tell you. Okay, YTM, this also we already discussed. That is why, see, in our subject, there will be, it is a cogent discussion. You cannot take it separately. Okay, you cannot take topic by topic. Okay, everything has relation. Understood? See, already we discussed in the realized YTM segment, if you remember, there I told you, okay, YTM assumes, in order to realize the YTM actually, YTM assumes that the intermediate cash flows, which is coupon in this case, are reinvested back at same YTM rate. Remember, okay, in order to actually realize the YTM, the yield which you get if you hold the bond till maturity from today, correct? Yes, that is correct. But I should not only hold the bond till the maturity, but also the intermediate period I am receiving some coupon, correct, interest, that I need to keep on reinvesting at the same rate of YTM. This is the underlying assumption of YTM that I detailedly discussed there. Now what I wanted to clarify is that, now see, when I bought the bond last year, the YTM was 10%, correct? That now, due to the market interest rate changes, YTM also changed, correct? Now, the YTM have become 12%, correct?
At that time, it was 10%. In order to realize the same YTM, I need to invest 10%. I need to invest at 10%. Now the problem is market interest rate changes. Okay, this is reinvestment. I will have some reinvestment. I have to reinvest at the same rate. The reinvestment rate will be different. Rate will be different. Are you understanding? The reinvestment rate will change due to the market interest rate. You can only reinvest at the prevailing interest rate. See, I have bought a 5-year bond, coupon paying bond. Every year, each year end, I am receiving some coupon. But when I want to reinvest, at that time, I can only invest at the prevailing interest rate, not at the original interest rate which was there before 2 or 3 years back, correct? So in that case, due to market interest rate change, I have one more risk, which is reinvestment risk. That is, okay, directly related, which means not inversely related. It is directly related in the sense, if market interest rate goes up, I can reinvest at a better return, higher return, correct? If market interest goes down, I need to reinvest at a lower return. But there is a risk or not? This is called as reinvestment risk. Are you understanding? Say, now I need to balance these two risks. Agreed? If one risk is higher than the other risk, what will happen? Ultimately, what I will realize is not YTM. I told you, in order to your realized YTM to be same as exactly YTM, you have to reinvestment at the same rate of YTM. But in this case, there are two issues here. One, when market interest rate changes, my bond price will also change. Correct? Seri. In that case, if price changes, what is the impact? I'll let you know in the example. First, you need to understand this risk understood. There are two types of risk. Correct? To tackle this risk, we need to manage this risk. This is why the bond immunization concept comes. What it actually means, okay, what is the strategy? I'll tell you. Okay, efficiency of the strategy we will test later. What is the strategy? You have to invest the bond in such a manner that your investment horizon matches the duration of the bond. Very simple here. You have assumed after 5 years you are going to retire. After 5 years you are going to retire. You are going to get some amount after 5 years. In that case, you are going to get some 10 lakh rupees. Correct? You need to have, assume you need to have in hand 10 lakh rupees after 5 years. You want to have 10 lakh rupees. In that case, today you want to invest for how many years? 5 years. Today you are 55 and at 60 you will retire. Assume after 5 years you need 10 lakhs. In that case, for 5 years you need to invest. You are trying to invest some amount. Present value of the 10 lakh you will invest, whatever is the interest rate. Correct? Now what you will do is that when I try to invest, this is my investment horizon. Okay, 5 years, 3 years, whatever I decide upon, it is my investment horizon. The time period for which I am entering into this bond market to invest in bond. Just like shares, I invest in bond. Okay, I will decide earlier itself that for how much time I should invest in this bond. Correct? Now, the problem is, this investment horizon of yours should exactly match the duration of the bond. I am again telling, okay, it is duration of the bond and not maturity of the bond. See, I'll go to the market, duration in the sense, Macaulay's duration. Remember, that is why I told you while discussing duration itself. Okay, duration is one more usage of duration. It is an optimum holding period. Okay, and I also told there that during bond immunization strategy, you will understand duration in a better way. Correct? See, so what the theory says, bond immunization strategy says is that invest in the bond, okay, in such a way that it matches the duration of the bond matches your investment horizon, not the maturity of the bond. See, after 5 years, I need the sum, correct? But assume there are two bonds in the market. One, there is 6-year duration bond, maturity of 6 years, but duration of 5 years. And another bond which is having a maturity of 5 years. Now, which bond you should invest? I should invest in a bond which is having Macaulay's duration of 5 years and not maturity period of 5 years. Okay. All these things we will discuss through an example. This you understood? If I invest exactly till the duration period, what will happen is both the risk will get protected and my bond yield will get protected. This is a strategy to protect my yield. Just like vaccine, if you put, you will be protected from the virus. Same way, this strategy helps you to, okay, get protected from the different risk arising from the interest rate changes in the market. Now, with the help of example, I'll let you know. See here, I have explained here interest rate. If interest rate increases, okay, reinvestment income also increases. If interest rate increases, bond price will get decreased. So price risk you will expose to, and these two risks you will get exposed to. And interest rate decreases means reinvestment income will get decreased, and market interest rate gets decreased means bond price will increase, as they are inversely proportional. Investment in bond has two types of risk: reinvestment risk and price risk. Agreed? Next, the relationship between all these things, reinvestment income, bond prices, are as follows. So interest rate increases, reinvestment income also increases, bond price will decrease. If interest rate decreases, reinvestment income also decreases because they are directly related, and bond price inversely related, it will increase. Okay, it can be seen that the above two risks are negatively correlated. Each two risk will get exactly opposite.
if the bond is held till duration. So see here, two risks you are exposed to and they will exactly get offset, and you will not be exposed to any risk if and only if, okay, your investment horizon exactly matches its duration, matches the duration of the bond. So the conclusion, if the bond is held till duration, the cash flow to the left exactly balances the cash flow to the right. To conclude, do not hold the bond till its maturity, okay, which means your time horizon is 5 years. Now, you don't invest in a 5-year bond, 5 years maturity bond. You should invest in bond which is having 5 years Macaulay's duration. Are you understanding? The duration of the bond should match your time horizon. Where there are no individual bonds having duration of your investment horizon, which means assume in the market, I need money after 5 years, correct? My investment horizon is exactly 5 years. I go to the market and see that there are various securities which is not at all matching my investment horizon. See, one bond is trading for 6 years, one bond is having 6-year duration, not maturity. Okay, another bond is having a duration of 3 years. In that case, what I will do? Confusion arises, na? In that case, you will build a bond portfolio in such a manner, in such a proportion, you put your money in the different bonds that your weighted duration is exactly equal to your investment horizon. This is the trick. Okay, see, in revision batch, I try to skip through few things here and there. In the regular batch, I usually discuss this in very detail to get absolute clarity, and it is very hard to bring things in a very condensed manner. Okay, that is why I'm having some difficulty. You need to adjust few things. If you think the speed is high, you can again revisit and re-listen. Okay, again listen to same lecture, or if you feel that it is elaborate, then you can use 1.5x, 2x to fast forward and listen it quickly. Are you understanding? Person to person it will differ. The speed will differ. Say, when there are no individual bonds, what I told you, you need to create a portfolio of bonds such that, okay, the weighted duration of the bonds, the portfolio of bonds which you created is exactly matching your time horizon, your investment horizon, correct? See here, then create a portfolio of bonds where weighted duration of the portfolio should be equal to your investment time horizon, okay, which makes the portfolio immunized. Zero coupon bond should be held till maturity, because zero coupon bond maturity is nothing but its duration. Understood? This I already let you know, correct? If market zero coupon bond is available, either you need to build a portfolio using zero coupon bond, we have a question in this regard, or if you want to buy the zero coupon bond on a standalone basis, then obviously, we can directly buy a maturity, a zero coupon bond having maturity as your time horizon, because obviously the duration will be same as its maturity, which I already explained. Now the main thing is that, sir, you told that because of this strategy, which means if I invest, either individually if I invest in a bond which is having exact duration as my time horizon, or I can build a portfolio of bonds which is having a weighted duration of my time horizon. Either way, you told that you should always invest, your investment horizon should match the duration of the bond, then you are protected from these two type of risk. How it is possible? That is a question, correct? For this only we have a detailed example. Please carefully listen, one by one I will explain. Okay, see, X wants to invest ₹1,000 for a period of 4 years and wants a YTM of 12.6%. Wants a YTM, now what it means really? Ultimately, he wants to realize a YTM of 12.6. At present, when he invests, the YTM is 12.6. But ultimately, when he realizes, the realized YTM should be 12.6. This is the understanding. Next, he is considering two bonds for this purpose. Bond A is there, bond B is there. See, carefully observe, the market price of both these bonds are same, ₹1,000. Par value, face value is also same. YTM is also same to our surprise, correct? Coupon is also same, 12.6%, 12.6. Then what is the difference? Difference is the term of the bond. Term in the sense, life of the bond. I will say, this is like maturity of the bond, not the duration. Carefully observe. This is because duration I have given it separately. So this is term of the bond, life of the bond. Bond A is having a 4 years life, bond B is having 5 years life. Okay, next to come to duration. Duration, I am having bond A less than 4 years. Believe me, it is less than 4 years. We don't need to calculate exactly. That is not relevant. Why less than 4 years? Can you understand this conceptually? Very simple. Yeah, this is coupon paying bond. This is not zero coupon bond. In case of coupon paying bond, always the duration will be less than maturity. Yeah. Okay, because some portion of the principal amount or bond value will get recovered in the earlier years. In that case, okay, it is always be less than 4 years. We don't need to calculate exactly. No need to calculate. Just remember, this is just for understanding the immunization concept. We don't need the exact number. Okay, come to bond B. Bond B, okay, yes, the term of the bond is 5 years. which is not matching our investment horizon. In the question I told you, okay, our investment horizon is 4-year period. Remember, he wants to invest for how many years? 4 years. Your investment horizon is how much? 4 years. And if you go to the market, you have a life of 4-year bond. You have a bond which is having a life or term of 4 years, and that is bond A. And you have a bond B which is having a life of more than 4 years, but which is having exactly life of duration of 4 years. Now you understood what is the question really. Okay, we are comparing, one bond is having life of exactly which is matching our investment horizon, another bond is having the duration which is exactly matching our investment horizon. In this case, which bond we should select? That is the conclusion we'll get at the end of the discussion. See here. Okay, how to see what the question is asking. They are asking first to state the factors that will affect from the yield of a bond. I told you the risk and all, you explained it. Next, which bond should you invest to immunize yourself, okay, from the yield change? Ideally, I should invest which bond? Bond B. Why? It should match. Duration is exactly 4 years. The answer is bond B, but how I select bond B is the subject matter of discussion. Okay, if the market yield of the bonds of the risk classes drops to 10%, show how your bond selection helps the investor to immunize yourself from the yield change. This is a question that has been given. See, understanding the facts. Slowly we will move on to the facts and understand. I'll slow it down for now because you need to understand this clearly. Okay, once we are through with this, we can quickly rush through the portion. See, the investor's time horizon is 4 years as given in the first line of the question. That we understood. Second, the bond are available in the market that gives yield 12.56% required by the investor. Correct. Realized yield is 12.56. YTM is 12.56. Next, in this problem, coupon is equal to YTM. Why? Bond is trading at par, yeah. You see, YTM is 12.6%. Coupon is also 12.6%. First segment also itself I told you, whenever your yield YTM is same as coupon, it means that the bond is trading in the market at par. Or conversely, assume they have not given YTM, but they have given coupon and they have told that the bond is trading at par value in the market, which means the yield is exactly the coupon, yeah. Understood? This I already explained. So, say, now, which means the coupon of these two bonds are same, YTM of these two bonds are same, everything is same, okay, except the life of the bond and duration of the bond. That is the only catch. See, bond A has duration of less than 4 years because it is a coupon paying bond having maturity of 4 years. So coupon paying bond, maturity of 4 years, now duration will be less than its maturity period because some portion will be getting recovered earlier. Bond B has a duration of 4 years which is calculated as follows. 4 years, already I told you, I don't need to show the calculation, but still I showed you. You can refer this, okay, don't worry. Believe me, this is 4 years. We don't need here calculation of duration is not our subject matter of discussion. Understood? So next, come to the core discussion. First step, what we will do is that we will compute first realized YTM of these two bonds. Are you understanding? We will compute realized YTM of these two bonds. Realized YTM already we know. Remember, okay, using the YTM reinvestment rate, we will assume reinvestment rate as same as YTM, and then we will find out how realized YTM is computed. Understood? See here. Cash flow A, here 12.6, face value is 1000 rupees. 1000 rupees will 12.6 if you apply. 126 will be the bond cash flow for all the 4 years. Okay, the cash flow will be same. Understood? 1126, the cash flow will be same. And future value factor, which means you reinvest by coupon. First year coupon, you reinvest for 3 years. 1.126 raised to the power 3. Why? For 3 years you will invest. Next, second year cash flow 126 rupees is there. You reinvest for baki 2 years, remaining 2 years. Then third year cash flow is 126. Again you will reinvest for 1 year, and fourth year you will get coupon 126 plus 1000, and there is no need to reinvest. You cannot reinvest because at the end of fourth year only you are receiving. So the value will be same. The factor will be 1 and the value will be same. So if you total, I get the maturity value as exactly same. Yeah, remember 1607.51 and 1607.51. In both the cases, the maturity value will be same. Agreed? Now what is happening? Now I compute realized YTM. Present value, future value is equal to present value 1 plus r raised to the power n. Same compound interest formula I will apply. Okay, realized YTM I computed as 12.6. I don't want to again show all the calculations. Remember, okay, 12.6, you can check it here. 12.6, I'll get realized YTM. Now, next step, we need to understand how the cash flow really works. See here. Now, both these bond I hold till only 4 years. Now, the question arises, see, the maturity of the bond B is 5 years. Correct? But you are holding only till duration of 4 years. I understand that first bond. I come back to the same discussion here. Question I'll come back and explain. See here. The bond A is having term of 4 years, which means I'll get the redemption from the company itself, correct, at the end of 4th year. Understood? So bond cash flow, I can say that these cash flows are certain. That year 1 12.6, 126, 126, 126, 1126. Correct? 126 plus 1000. These 4 cash flows are certain, which I am going to receive from the company. Correct? I am going to receive from the company because it is having 4 years maturity period. Redemption will be paid by the company itself. Agreed. In case of bond B, I have an issue because I need to hold only for 4 years. Correct? But the duration of term of the bond is 5 years, which means if you want the company to redeem you the last face value, 1000 rupees, you need to hold till 5th year. You need to hold till the 5 years. Yeah, understood? Then only they will redeem. At the end of 4th year, tell me, will they redeem the capital? Will they redeem the capital? They will not redeem the capital. In that case, what you need to do? You need to depend on the open market. Okay, you need to sell in the open market to realize the cash. Are you understanding? At the end of 4th year, what you will do? You will receive the coupon 126, 126, 126 3 times. Okay, 4 times. 4th year coupon also you will receive. But you will not receive the coupon of the 5th year and you will not receive the coupon of the redemption value of at the end of 5th year. Are you listening? Why? Because you will sell at the end of, you will sell your bond in the open market at the end of 4th year and move away. Correct? Because we only need to hold till duration. Duration is 4 years. Why you need to hold till 5 years? For 5 years, correct? Appo, sir, you have understood. I understood that bond A cash flow are certain and this is the cash flow. Correct. But bond B 1126, how can I realize at the end of 4th year? Question arises, na? Only when I realize 1126, I get this realized YTM is 12.6%. Correct? In that case, my yield will get affected. If that get increased or decreased, that is the subject matter of discussion. See here, what happens really? If we invest in bond A, all the cash flows are received from the company, coupon as well as redemption. However, if we invest in bond B, and if we hold only till 4 years, a 5-year bond, we receive 4 years coupon from the company. Okay, and sell the bond in the open market at P4. P4 price at the end of 4th year. P4 means what? P4 I denote, right? Okay, I write it like this. P4 what it means really? Price, market price at the end of year 4. Okay, I will sell in the open market because I will not get redeemed by the company. Next, P4 is nothing but what is P4? It is the price at the end of year 4. What is the value of the asset? Very simple. Present value of future cash flows discounted at YTM, prevailing YTM. Correct? Now what happens? P4 is nothing but PV of the cash flow from the bond after 4 years. Appo, 5th year cash flow you are receiving. 5th year what you will receive from the company? See, 126 is the cash flow received from the company and 1000 rupees. Correct? Appo, total 1126 you will receive at the end of 5th year. Correct? Now, this is the cash flow at the end of year 5. You need to discount and bring it to present value terms. How will you bring it to present value terms? Rate prevailing at the end of 4th year. Because we are finding P4, not P0. P0 you need to bring everything into present value 0 term, year 0 term, today's term. But what we are computing is the price at which you are going to sell at the end of year 4, which means present value of the future cash flows at the end of 4th year. What will be the future cash flows? Cash flow 5, the 5th year cash flow, which means the coupon at the end of year 5 and redemption value, which is 1126. This is the 5th year cash flow. Okay, divided by discount, I discount it and bring it to 4th year end. What rate I will use? Prevailing yield at the end of year 4. 12.6%. Okay, 12.6% I'll use 1.126 12.6% and I'll get 1000 again. Are you understanding? This 1000 only I am adding the 4th year. 4th coupon 4th year and coupon you will receive 126 coupon. This is 4th coupon. Then plus 1000. But this 1000 is not redemption value. That is the difference. Okay, between bond A and bond B. This 1000 is nothing but P4. I mean, if to simplify, if at the end of year 4 the yield is 12.6 in the market, the bond will be trading at par, 1000 rupees. Are you listening? That 1000 rupees is the market price. Up you will receive coupon and you will sell the bond at the year 4. You will receive the market price 1000, total 1126. Still this 1126 will be same as the bond A cash flow. Are you listening? Now what is happening? See here. Okay. Now what is happening? Yes. Come back to this. 1000 rupees you will invest. Correct? It should be understood that bond A cash flows are certain while bond B cash flows is uncertain. Why uncertain? It depends on, see, I assumed that the market interest rate on that date will be 12.6. If 12.6 yield changes on that date, market interest rate, then entire discussion will be different. Which means I will not realize the market price of the bond will not be 1000 at that date. It will be something different. It might be higher, it might be lesser. Correct? Depending on the prevailing interest rate. This is where my cash flows will become uncertain. Are you listening? My cash flows will become uncertain and I am exposed to the price risk. Are you listening? Okay. Prevailing interest rate, the yield of 4th year. Both the bonds give the investor a realized yield of 12.6 because the cash flows are reinvested at 12.6. Okay. The bond holder is said to have effectively realized 12.6 if the cash flow is in the hand at the end of year 4 is this much. Okay. But the question is, you invested the bond which is having a duration of 4 years, your yield will be protected, you told how our yield is protected is a discussion to be made here. See here, if tomorrow I invested in bond B, assume I invested in bond B, correct? Now everything is over. I showed you for realized yield, I showed you all these discussions, how P4 happening, how the future cash flows are discounted, all these things I showed. Now what we did really, we invested in bond B, bond A, bond B, correct? Which is having a duration of 4 years. Now we need to prove if on that day market interest rate at the end of year 4 changes, okay, still my realized yield of 12.6 will be protected. This I need to prove now. How will I prove? See this discussion. Now what happened? That last step they have asked in question also now. See here. Where is the question? Very comprehensive question. In the regular batch, I take for 2 hours I discussed. That is why I'm quickly trying to summarize this and discuss. Okay, please try to cooperate. See here. Where it is? Where the question is? Yes, the question clear. Below this, see here. This is the important sentence. See, if the market yield of the bond of this risk class drops 10%, which means at the end of last year, if assume year 2, yes, year 2, okay, any time, see, I also told you if you invest till duration, in between these 4 years, at the end of first year or maybe at the end of first year, second year, third year, interest rate changes, no issues, okay, interest rate change will never affect. At the end of first year, I don't mind. At the end of second year, I don't care. At the end of third year also, I don't care. Understood? This will protect my yield throughout the holding period. Are you all listening? Okay, that I mean to clarify. Here what they're asking in this question specifically is that if the market yield of the bond of this risk class drops to 10% in year 2, okay, show how your bond selection helps the investors to immunize against. So the question is asking, now while you invest the YTM is 12.6%, if the market interest drops to 10%, YTM drops to 10%, okay, what will be the realized YTM ultimately? You told if you invest in bond B which is having a duration of 4 years, your yield will be protected. You will be immunized. Let us check what is the position of this. Vaccine is working or not. Let us try to see. Last discussion. Okay. See. Calculation of realized YTM. Okay. Of both the bonds when the general interest rate drops to 10%. Which means very simple. My interest rate drops to 10% in year 1. Year 2, at the end of year 1, they want us to compute. That is the issue. Okay. No, what you have to understand, in the year 2, year 1 initial year 2 means at the end of year 1, you need to understand. Clear? Yes, year 2, what you need to understand at the end of year 1. After the first year, interest rate changes. Initially, you invested at some rate, okay. Then, at the end of the year 2, other year 2, here you need to understand it's the beginning of year 2. Okay, logically understood. See, first year, initially year 0, you invest in bond. Okay, in the next year, it changes. What will happen? You will receive coupon at the end of the first year. The idea is to indicate that your reinvestment income will be dropping. That is the idea. Understood? First year and you will receive the coupon. You will need to reinvest the coupon. The point is you cannot reinvest at 12.6. The market interest rate dropped to 10%. Only at 10% you can invest. That is the thought process of the question. Okay, that is why this question is being asked. Shall we go to the solution? See, observe carefully what is happening for both these bonds and then we will decide which bond is superior. Year 1 cash flow is 126. The cash flows will remain same for year 1, 2, 3. Why? Only coupon is getting received, correct? But since the interest rate has dropped to 10%, you can only reinvest at 10%. Earlier, remember, we had 1.12 raised to the power 3. Remember, correct? Now you only can reinvest at 10%. Agreed? Up 1.1 raised to the power 3, 1.1 raised to the power 2, and 1.1 raised to the power 1. This is over. Now last year, yes, this is getting redeemed by company, 1126 you will get. But there is a problem in the case of second bond B. In case of bond B, what is happening? Coupon you will receive as 126. Agreed? But plus you will need to sell this bond in the open market. Correct? At what price you will sell? At the prevailing market price. Correct? You will sell at the prevailing market price. The price which is prevailing at the end of year 4 is what we need to find out. What is the price at the end of year 4? We need to find. Correct? It is nothing but cash flow phi, present value of the future cash flow is discounted at current yield, correct? Prevailing yield. Appo future cash flows, 5th year cash flow, you need to discount using what? Prevailing yield, which is 1.1 and not 1.126. 12.6 yield has gone. Now the yield is 10%. From year 1, from year 2 beginning, it has changed to 10%. Drop to 10% market interest rate. If interest rate drops, tell me, price will increase or decrease? Price will increase. Are you listening? What will happen? Okay, if interest rate from the original 12.6 market interest rate, YTM has dropped to 10%. If YTM drops now, what will happen to bond price? Market price, what will happen to market price of the bond? Bond price will increase. In that case, cash flow 5, fifth year cash flow will remain same. Correct? What is that? 1126, because 126 coupon still you will receive from the fifth year, coupon you will receive, plus 1000 rupees redemption value you will receive from the company. That is the future cash flows of the bond. And then for the fifth year, that you will discount using prevailing interest rate at the end of year 4, which is 10%, 1.1. How much you will get? 1126 divided by 1.1, which is 1023.6. I can round it off to 1024. Correct? This 1024 plus 126, because fourth year end you will also receive coupon from directly from the company. Are you listening? So coupon and the P4. What is this? This is coupon. This is P4. Are you listening? What is the total of this? 1150. This is what I have put it. 1150. Are you all getting this? 1150. Okay, which you cannot of course reinvest. The value will be same. Okay, 1150, and the total, if you see, bond A's total will be 1584, bond B's total will be 1608.77. If you carefully observe, even though the interest rate changed, okay, here this 1607.51, ideally 1 rupees, give it to beggar, yeah, that is not an issue. Okay, ideally it rounding off issue, but both needs to be same. Correct? This 1067, the bond value is same as this maturity value of the bond B is still the same. But maturity value of bond A from 1607.51, it has dropped to 1584.74, which means the yield has dropped. See, if your maturity value has dropped, initially you invested some amount, maturity value has dropped, which means yield has dropped, and it is not 12.6%. Are you listening? If the market interest rate dropped, your realized YTM also dropped. Correct? But your realized YTM is not getting affected due to market interest rate if you invest in bond B. In case of bond A, your yield is getting compromised. In case of bond B, your yield is not getting compromised and you are still healthy and immunized. Are you all understanding? Very, very detailedly I have discussed. Okay, very, very important concept. Deep discussions I have made. Please go through 1 or 2 times if you're not comfortable with the concept, but this is the way you should understand this concept. Are you listening? When the general interest rate drops, the realized YTM of bond A goes below 12.6 due to the drop in reinvestment income. But it is not the case with bond B, where its realized YTM is still 12.6. Thus, bond B is immunized from interest rate changes. Are you all understanding? This is the thing. Okay. And so the one line summary of the entire discussion, even if you don't understand anything, just tell me what you should do. One line summary of the entire discussion. Okay, if you want to protect your yield, see, YTM is 12.6 today, but I told you due to the market interest rate changes, you are exposed to price risk and reinvestment risk, due to which ultimately the realized YTM, what you realize, may be something different from today's YTM. Okay, in order to protect your YTM, in order to protect your today's YTM or yield, what you should do? You should invest in bond in such a manner that the the bond duration exactly matches your investment horizon. Are you listening? You should invest only till the bond duration and not the bond till, you should hold the bond till only the duration period and not till the maturity period. Hold the bond till duration, not its maturity. This is why, okay, if you remember, I will show you again. Okay, if you remember, I already discussed this. Why I wanted you to understand this, I'll show you. The bond immunization concept, I told you one thing. Okay, see here. Remember, this I want to clarify. If you carefully observe, it is the point B you see. Listen, read this point B. It is the optimum bond holding period to protect the YTM from interest rate changes discussed during immunization. This discussion, now which we did, correct? This is to make you understand. At that time, you will not have absolute clarity, correct? Now you will understand why I told you this is the optimum bond holding period. Okay, immunization strategy, you will understand. Now you understood clearly what is the point. It actually protects the YTM. Okay, so that ultimately what you realize is exactly the YTM. Your yield is protected. Understood? Okay. Now let us do some question in this regard quickly. Okay, 1 or 2 questions I will do. And where is this question? Yes, question number 13. Take question number 13. We'll quickly discuss this question and proceed. See. An insurance company has an obligation to pay rupees 2,50,900 after 10 years. The market interest rate is 8%, so the present value of the obligation is 1 lakh. The insurance company's manager wants to fund the obligation with a mix of 6-year zero coupon bonds and perpetuities paying annual coupons. In what proportion he should buy these debt instruments? This is a question that is asked. See, I understood because of the immunization concept that you should only invest till the duration period, correct? Now, my investment horizon first I need to decide, correct? When I need the money, I have an obligation to pay how much rupees? 2,15,900. After what? How many years? 10 years, correct? After 10 years, I have an obligation of rupees 2,15,900, which means I need to find out, I need to deposit. My investment horizon is 10 years. I need to invest for 10 years in such a manner that my maturity value will be 2,15,900, correct? At the end of year 10, I need to have 2,15,900 is the as my cash in hand, correct? In that case, I will invest present value of this 2,15,900. That is correct. But okay, yield has to be protected, na? If you want to, the current market interest rate is 8%. How much you will invest? Present value at 8% for 10 years if you do, okay, you will get some number. You need to put the amount in bond. But the problem is your investment time horizon is 10 years. You go to the bond market and see that you have a zero coupon bond available in the market, correct? And that is for 6 years. Can you see this? Mix of 6-year zero coupon bond, which means 6-year zero coupon bond, zero coupon bonds maturity period is 6 years. You tell me duration of zero coupon bond is what? Same as its maturity, which means duration of the zero coupon bond is 6 years. Now, my investment horizon is 10 years. Can I invest in this bond on a standalone basis? No. I go to see another security. I see another security which is a perpetual bond. Okay, perpetual bond. You tell me what is the duration of the perpetual bond? Very simple, yeah. 1 plus y by y is the duration of the perpetual bond. I discussed, remember? Okay, now first step we need to compute duration. See, duration of the perpetual bond 1 plus y divided by y, 1.08 divided by 0.08, which is 13.5 years, correct? So I go to the market and see that, okay, my investment horizon is 10 years. So I keep in mind my investment time period, 10 years. I go to the bond and see whether there is an instrument which is having a duration of 10 years, which is exactly matching my requirement. I go and see. I see that one is zero coupon bond, which is having 6-year duration period. Maturity period is same as duration, so 6-year period. Then I reject it. Then I go to another security, which I see is that perpetual bond is trading in the market, which is having a duration of 13.5 years, correct? Because current yield is 8%. So 13.5 years is the duration of the perpetuity bond. Now you see both are not matching my investment horizon of 10 years. What to do? Now I will construct a portfolio of bonds. This concept I told you, na? Okay, individually when I see that no bond is having exact duration which is matching my investment horizon, I go to create a portfolio, okay, such a way that the weighted duration of the portfolio at least can match my investment horizon. See that, as we see that neither of the two instruments available in the market are having the duration which matches the investment horizon of the insurance company. So we need to create a portfolio consisting of two bonds where weighted duration of the portfolio matches the investment horizon. How to do that? Very simple. Bond is there, zero coupon bond, proportion is P, correct? Duration is 6, correct? Individually, the zero coupon bonds duration is 6y, maturity period is say. So weighted duration is 6 into P. Assume pa ZCPK, if the weight is P, perpetual bond will be 1 minus P, because your portfolio only consists of two securities, two bonds. One bond is having a proportion of P, and second bond will be taken as 1 minus P. Are you listening? So 1 minus P you will take as perpetual bonds proportion. Duration is 13.5, we already calculated in the previous segment, and you will get 13.5 into 1 minus P. Total 8, you will get this equation. Solve the equation and equate it to 10, correct? 6P plus 13.5 into 1 minus P is equal to 10. Why 10? Our investment horizon. You need to meet the liability after 10 years, na? Are you listening? So you need to invest, you can only invest for a period of 10 years. Your investment horizon is 10 years. Next. So proportion, by solving the equation, I don't want to go into solving and all. You see, by solving the equation, you will get 46.61% proportion of ZCB. Okay, proportion of perpetual bond you will get as 53.66, which means out of 1 lakh rupees, 46,600 should be invested here and 53,333 should be invested there. Okay. How you got 1 lakh, na? Present value of the 2,15,900, correct? That you can do 1 divided by 1.08 raised to the power 10. If you do that, okay, into 2,15,900, if you do that, you will get this 1 lakh. Present value of the obligation, prevailing interest rate, you will get the obligation. Are you all understanding this question? One more question I'll do, one last question, okay. And the institute question is one more, the 3 bond question, 3 bond portfolio question, which is also simple and straightforward, because now you have understood the immunization concept as a whole. Now you know, you don't need to actually see. I believe in conceptual clarity rather than doing n number of sums in this regard. Okay, all sums are mostly repetitive, or if you are conceptually strong, you can easily go through these questions. I don't need to discuss all the questions, correct? It will increase the time. So revision time increases, right? It will be like fast track batch or regular batch. Are you understanding? So I want to discuss more of concepts in a limited time rather than doing a lot of questions. I believe in that. Okay, even if you do 1 or 2 good quality question in one concept, okay, of each concept, that is enough. Okay, if you are practicing that 1 or 2 questions alone is more than enough, is what I believe. If you are not comfortable, you can also go and solve that question. Yes, you need to have practice, but I can't keep on doing everything here itself. Okay, you can go through these questions. Right. Next, Mr. A need 1 lakh rupees after 2 years, for which he wants to make one-time necessary investment now. He has a choice of 2 types of bonds. See, bond X, bond Y. You see, face value is 1,000 and coupon 7% payable annually and 8% payable annually. Okay, and then years to maturity is 1 year and 4 year. Current price is given, current yield is also given. Why yield is same? Yeah, see, very simple. Bond is trading at par. The yield must be same, na? Are you listening? What is happening? Okay. Okay. The current yield is 10%, 10%. Current yield is 10%. Okay. Advise Mr. A whether he should invest all his money in one type of bond or he should buy both bonds. If so, in which quantity? Okay. If so, in which quantity? Are you all understanding? This you need to understand. Assume that there will not be any call risk or default risk. This is the question that is being asked. See, very simple. Our investment horizon is 2 years. Agreed? Now, whether you see this has matured. First, you need to see this question. Years to maturity they have given. This is the maturity period. Life of the bond. We need to compute duration of the bond or not. Yes. How to compute? Very simple. See, duration of bond. 1 year bond duration is very simple. It will be 1 year only. Okay. 4 year bond you need to compute duration. It is coupon paying bond which will be less than 4 years, which I already computed 3.563. You can go through 3.563. Now I have 2 bonds. One bond is having a duration of 1 year. The second bond is having a duration of 3.563. But none of this bond is having a duration of my investment horizon, which is 2 years. So what I need to do? I need to create a portfolio of these bonds in such a way that the weighted duration of this portfolio matches my 2 years investment horizon. Are you understanding? Same process, nothing different. What do you do? He cannot invest. See here, he cannot invest all his money in one single bond because in investment duration is 2 years. Neither of these bonds has Macaulay's duration is 2 years exactly. Therefore, he needs to create a portfolio consist of these 2 bonds, same proportion, in some proportion, that the weighted duration of the portfolio becomes 2 years, which is his investment time period. I have given us separately as note. Let P be the investment and 1 minus P be the investment in bond Y. Okay, again I form the equation and I solve it. I get P is equal to 0.61, 61%. Are you understanding? And proportion of bond Y is nothing but 39%. 100 minus 61%. Only 2 bond portfolio, so we are equating like that. Understood? 3 bond portfolio, you need to find it in some other way. Total should be 100. A minus B minus C, A plus B plus C should be 100. 3 bonds now in that case, right? That there is one question, institute question is there, you can go through, right? Accordingly, the proportion of investment shall be 61 and 39%. Bond X, what I need to do is that present value of 1 lakh. 1 lakh I need, but on the given future date. So I need to discount it and bring it to present value terms. Of course, which is 82,600 or so, into 61% I will invest, which is 50,000, and then 39% which I will invest, which is 32,214. Okay, for that, how many bonds you need to purchase? 50,386. Current market price is given. Why they have given at current price? This is the amount to be invested, 50,386. This is the price of each bond. Up how many bonds you will get? Approximately 52 bonds. Here, approximately 34 bonds. That's a question that has been asked. Okay. Now let us discuss the concept of convertible bonds. See, what are convertible bonds? As the name suggests, convertible bonds are bonds but which can be converted into equity shares later. See, there are 3 types of instruments. There are pure bonds, okay, non-convertible bonds. Then there is equity instrument, okay. Then there is convertibles. See, what is the advantage of bond? You need to understand. What is the nature of bond instrument? The cash flows will be fixed in nature, correct? In that case, there will be no uncertainty in the cash flows. No risk will be undertaken by the investor, correct? In case of equity, see, even though the cash flow is uncertain, when the company prospers, okay, equity is nothing but the ownership rights in a company. When the company does exceedingly well, okay, when company grows multifold, then what happened? Having ownership rights is more beneficial, correct? The wealth will be compounded over a period of time, correct? In that case, okay, you cannot participate, you cannot enjoy the right of ownership and participate in the growth of the company, prosperity of the company, okay, in case if you are holding only bonds. In case of equity instrument, you can enjoy that benefit, correct? This is the benefit of equity instrument, which is not there for bonds. Why? Because in case of bonds, the company has to pay some predetermined fixed interest, correct? In that case, the return for the investor, bondholders, will only be the coupon and redemption, and the cash flows will be fixed, and there will be no profit sharing and all. Are you listening? But in case of convertibles, convertible bonds are instruments which tries to combine the advantage of both the bonds and equity. What is happening really? You see, who issues convertible bonds? Generally, I'll tell you. Okay, the company which are into
okay, newly formed company, or which the company wants to grow, but there is uncertainty, there is market available, but there is uncertainty. Okay, in that case, company will prosper or not, people don't know. In that case, what you will do? Okay, they will issue, what they will do is that they will issue convertible bonds. What is the nature of convertible bonds? Typically will have a lower interest rate. Okay, will have lower interest rate than the general bonds. Suppose in the market, if bonds are giving an interest rate of yield of 12%, convertible bonds will only give yield of 8% or so. Are you listening? Why there is lower yield? Na? You need to understand, convertible bonds have the option to convert into equity share, which means they are giving an option that if company tomorrow prospers exceedingly well, you can convert into equity, correct? You can enjoy the ownership rights also, correct? So in that case, what happens? Generally, bonds are trading at 12%, means this will be issued at discount. Okay, and the second benefit is that if company doesn't do well, okay, tomorrow company doesn't do well, in that case, what happens? The investor, convertible bond holder, can easily, okay, can die as a bond holder. Okay, doesn't need to, there is no obligation for him to convert into equity shares. Are you listening? Understanding? This is the benefit of the convertible bond. For this benefit only, okay, it will be issued at a discounted price. Are you listening? So let's see what is this. As the name implies, convertible bonds or converts give the holder the option to exchange the bond for a predetermined number of shares. See, how many shares will be allotted for a given bond, convertible bond. For each bond, everything will be written on the bond indenture. Okay, in the bond, okay, prospectus, it will be written in the issuing company. When first issued, they act just like a regular corporate bonds, albeit with a slightly lower interest rate. Why this? Why they are issued at lower interest rate? Because convertibles can be changed into stock and thus benefit from a rise in the price of the underlying stock. Okay, and the company offers lower yields on lower yields on convertibles. If the stock performs poorly, there is no conversion and an investor is stuck with the bond subpar return. Of course, this will happen. See, they will give the option, but assume company doesn't do well. In that case, what will happen? Whether they will raise interest rate or no. Okay, you have to adjust with the lower interest rate. No other option. Why? Because there should be some risk return trade-off. Correct? There is a risk. Yes, the company might not do well. There is a risk. Okay, you are getting lower interest rate forever. You are stuck with lower interest rate for that capital forever. Yes, but there is advantage also. If company prospers well, you can suddenly jump and then have ownership rights. That is a benefit. So you have to take that risk for getting that benefit. Are you understanding? Okay. As always, there is a trade-off between risk and return. Then there is conversion ratio. What do you mean by? There are few terminologies associated with convertible bonds, which we'll understand through the example rather than independently explaining all this. Okay, one question we will take and then understand the concepts to the numbers. See, the data given below relates to a convertible bond. Face value rupees 250, coupon rate is 12%, number of shares per bond is 20 rupees, market price of share is 12, straight value of bond is 235, and market price of the convertible bond is 265. What they've asked us to calculate is the stock value of bond, percentage of downside risk, conversion premium, and conversion parity price of the stock. Before getting into this, I'll explain you briefly here. One thing is to be observed. See, the face value is 250, that is different, leave it. Okay, one data is given here, straight value of the bond. What it means, a plain bond is there, okay, the straight value of bond without option, without having option. See, convertible bonds are nothing but bonds which is having option to convert. That option, if you remove it, is called the straight value of bond, which means plain bond, if I buy, I can buy it at 235. It is trading at 235, correct? Now, one more thing is that this is, see, straight value of bond, SVB na straight value of bond. Now, there is one more thing. See here, market price of share is 12 rupees and the number of shares per bond is 20 rupees, which means today, if I convert this bond into equity shares, for this one bond, how many shares will be given for me? 20 shares, correct? And each share cost market price, current market price of the share is how much? 12 rupees, which means 12 into 20, 240. This is called a stock value of bond. Okay, if I convert this into stock as of today, what is the value of it? 240 rupees. Are you all understanding? Stock value per bond is 240. Now, convertible bond value is there. CBB na convertible bonds value. See this. This is the actual convertible bonds value. How much is that? Rupees 265. In this case, you tell me which is having a highest price? Convertible bonds. Are you all listening? This is the first observation I make from this question, because straight value of the bond means bond without having any conversion option, plain bond, correct? And stock value of bond means if I convert today itself, what is the value of the equity shares? That is stock value of bond, which is 240 rupees. Then what is the convertible bonds value as of today? 265 rupees, which means Okay, the convertible, if you observe, the convertible value of the bond is so superior. Adavadhu the value is more. Which is most valuable na? Okay, 265 rupees na convertible bond value. Why? Because you have to pay premium in order to get the conversion option. This bond is having an option to convert na. The balance, see, over and above 235 you are paying some premium, and 240 stock value of bond katlu you are paying some premium, correct? Why this premium is paid? Yeah, are you listening? For conversion option, the inherent option available in the instrument. Okay, this is something you should understand. This is the first observation. Then come to question. First, stock value of the bond. Very simple. Yeah, today if I convert, what is the value of the instrument? This is called as stock value of bond, which means if I take what is that? Yes. Today, what is the number of shares per bond? 20. They have given directly number of shares per bond, which means 20 shares I will get if I convert this bond into equity shares into 12 rupees is equal to 240. This is nothing but stock value of bond. Are you listening? Already we computed. Next, the percentage of downside risk. See here what happens. What do you mean by downside risk? I'll explain. See, today you bought the bond which is having conversion option. Now tomorrow, if the company doesn't perform well, correct? If the company, see here, if the company doesn't perform well, what will happen? You tell me, what will happen, pa? If the company doesn't perform well, which means your option will be useless. Yeah, are you listening? In the options chapter, we are going to study in derivatives, wherein below the exercise price, the future spot price, if it is below the exercise price, you would let it lapse, na? The premium paid will be gone. No use, but the premium will be paid, will be worthless, correct? The option will be worthless. Are you listening? Now, same way here also, the 265 rupees you paid, in that, okay, if the bond become worthless, it will be as good as plain value of bond. It is as good as plain bond without option. Are you listening? If the company tomorrow doesn't prosper, correct? No, you will convert. You will not exercise your conversion rate. You will not exercise. Yeah, the share price became zero. Tomorrow, company developed. Okay, it went bankrupt. Okay, and the share price came crashing to zero. And what you will do? Okay, you will convert it to equity share, which is having zero worth. Yeah. So what you will do? You will better, okay, die as a bond holder. In that case, the value will be 235 rupees, correct? It will drop to 235. So what is the downside risk now? Maximum loss I will incur. See, I will anyway be a bond holder, that is for sure. So my value will not reduce below 235, which means originally today my value is 265, na? Correct? My value of convertible bond is 265, and what happens if the company doesn't perform well, or if it is bankrupt, na, what will happen? The option will be worthless, the conversion option will be worthless, and the value will drop to how much? 235, correct? In that case, how many rupees you are having loss, downside risk? In rupee term, how much is the downside risk? 265 minus 235, which is 30 rupees, correct? Are you listening? And here one note is to be, one thing is to be observed. See here, here 30 rupees is the downside risk, divided by the denominator. You should always take as, conceptually you should take it as, downside risk from where it is falling. That number only you should take. Up to 265 only should be denominator. Factually 265 only should be denominator, because how much percentage loss from 265, how much it is falling? In percentage term, 30 by 265, how much it is coming? 30 divided by 265, it is coming to 11.32%, correct? Agreed? Are you listening? Okay. And but what happened? Institute has given some one question. In one of the question they have given 265. In another question they have given 235. Okay. That is conceptually wrong. But then if MCQ asks, you calculate both the percentages and then see whether which option is given. Okay. In case both the option given, I also can't help. Okay, you have to take an informed decision. You have to take a call, right? You have to take a guess call. See here, in this question, ICAI taken denominator as 235, whereas the downside has to be calculated from the starting point of the fall, that is 265. They have taken 265 in some questions too. So whenever this question is asked in exam, it's better to show both the calculations. If not in MCQ, if they ask in descriptive, show both the calculations and write a note that both have been done in the ICAI material. Okay. If asked in MCQs, verify which answer matches the following. Okay, this is about downside risk. Now come to conversion premium. Now come to conversion premium. See here, conversion premium very simple. Convertible bonds are really is to be understood as equity shares, which means what is the stock value of bond? 240 rupees is the stock value of bond, share value of bond. If I convert the bond today itself, okay, what is the value of my investment? Is 240 rupees, correct? In that case, okay, what is the premium? Conversion premium refers to price paid over and above the stock value of the bond. Are you listening? Okay, this is carefully you should understand what I am saying. Conversion value, okay, see here, market price of convertible bonds, I will say 265. You paid 265 for the convertible bond, but stock value of the bond is only 240 rupees. Up to 25 rupees you are paying over and above the
stock value of the bond. This is called as conversion premium. Are you all understanding? Okay, how much in percentage terms the premium should be computed now? So 240 over and above 240 you are paying 25 rupees. Upon 25 rupees extra from where you are calculating now. That base you should take as denominator. Upon 25 is the extra premium you are paying. Upon amount in rupee terms, what is the premium? 25 rupees. In percentage terms, if you are asked to compute the conversion premium in percentage terms, now how to compute? 25 divided by 240. This is the starting point. Now, inge correct eduthirukka. Institute has solved this correctly. Okay, there mistake is there, no issues. How much is that? 10.42. Inge there is one point here I need to clarify. You should not get confused with, see, there are two things here. 265 you are paying na, which is over and above 235, which means the plain value of bond is 235 and 30 rupees extra premium over and above the plain value of bond you are paying. That is different. The conversion premium means over and above the price you are paying from the stock value of bond, which means stock value of bond is 240. Now, how much you are paying? 265. 25 rupees over and above the stock value of the bond. This is called as conversion premium. And the next question we are going to see, okay, they may also ask, what is the premium over and above the straight value of bond? What is the premium paid or premium in percentage terms paid over and above the plain value of bond? In that case, the computation will be different. Are you listening? Okay, this you need to remember. Conversion, if they ask conversion premium, you should only consider, okay, the premium over and above the stock value of bond and not the plain value of bond. I have observed here that many students get confused. That's why I clarified. Okay, next question, you will get absolute clarity. Next, conversion parity price. See, very simple. What is conversion parity price? Bond price, the conversion bond price, the convertible bond price is 265. Are you listening? Okay, in this bond price, how many number of shares are issued for conversion? How many shares have been given for conversion? In this question, 20 shares per bond. So what you will do? Okay, you will divide it by bond price, the convertible bond price, you divide it by number of shares on conversion. What you will get is that 13.35 rupees. This is nothing but, see here, it indicates that if the price of the share rises to 13.25 from 12, the investor will neither gain or lose on buying both the bond or exercising it, which means it is, see, the 13.25 is like, if you convert this value of the convertible bond into market price of the equity share. In that case, 13.25, see here, in the question, we saw that 12 rupees is the market price of equity shares. Are you all observing? Yeah, correct. 12 rupees is the market price of equity share. In that case, now if you buy, okay, as equity share, which means if you buy the bond, assuming it to be equity share, like equity share, what you will get is the price of bond is 13.25 per share. Correct? So which means, ideally, the premium, 12 rupees was the stock price. You are paying premium plus 1.25 you are paying as premium. If you do 1.25 divided by, okay, effectively how much? The base, yeah. How much is the base? See, very simple. 12 rupees. Over and above this only you are paying. If you do 1.25 divided by 12, you will get the same 10.42%. Are you listening? This is something per share basis. This is computing premium. That's only the thing. Conversion parity price. Okay. It is per share base, calculating on the per share basis how much premium you are paying, premium amount you are paying per share. Are you listening? Here, what is the premium amount per share? 12 rupees was the equity shares market price. And if you assume, if you are converting this bond into equity with the given ratio, you will get 13.25 as the price, which means 1.25 per share extra you are paying. Understood? For each equity share. Okay. Because basically convertible bonds is actually equity share only, it is hidden equity share. Okay, if you remove it, you will see that you are paying 1.25 rupees as premium over and above the stock price. Are you listening? This is what is conversion parity price. Okay, in the problem number 15, the convertible bond has three values, namely straight value of bond, 235 stock value of bond, okay, and convertible bond. All this I have discussed. When an investor purchases convertible bond, he really purchases an equity share. Had he purchased the share directly, he would have paid 240. Correct? But when he purchases through convertible bond route, he pays 265. The conversion premium is paid to cover the downside risk associated with the shares. Correct? Directly, if you bought the share, you will buy a 240 today. Correct? But he did not buy the share directly. Instead, he bought the convertible bond. Okay, but if it is worthless, he will again change. If the company does well, he will change it to equity share. So he has to pay that extra premium. Okay, to avoid that, cover the downside risk. Correct? Maximum downside risk associated is nothing but convertible bond minus straight value of bond. Because if they, in the event of companies, bankruptcy or some negative event, what will happen? It will come back. The bond value will come back to the straight value. Correct? So that is the maximum downside risk. Even if the equity share becomes worthless, it still retains its straight value of. straight bond value. Next, question number 16 we will discuss, and for this also notes I have given here, you can go through simple explanation. See, I have given here, if you notice, what is conversion ratio, number of shares to be issued, conversion price, all this I have detailedly given. Okay, conversion value, stock value of the bond, okay, and conversion premium, conversion parity price, everything through the numbers we have already discussed. Next question, we have something new to discuss. That is why I am doing one more question in this regard for absolute clarity. See, take question number 16. The following data is related to 8.5% fully convertible debentures issued by JSE Limited at 1000. Market price of the debenture is 900, which means convertible debentures is having a market price of 900, and the conversion ratio is 30. Straight value of bond is 700. Market price of equity share on the date of conversion is 25. Expected dividend per share is 1 rupee. What is the use of it? I'll explain it to you later. See here, first conversion value from known to unknown we will discuss. First, already we know conversion value of debenture. What is the conversion value of debenture? Very simple. Yeah, stock value of debenture. You will take and find conversion value. See, conversion na stock value of debenture na 25 rupees the market price per stock. How many shares you will get for converting this? Conversion ratio is how much? 30 rupees, which means for each bond you will be given 30 equity shares. And what is the stock value of this? See, conversion value na nothing but stock value pa. This is nothing but stock value, which means 30 shares will be given, and price per share is 25. 30 into 25, how much is that? That is the conversion value. It is 750. Are you all understanding? Next, market conversion price. Market conversion price is what? Very simple. Yeah, market conversion price na market price of the convertible bond 900. They have given in the question, divided by conversion ratio. How much is that? 30 rupees. What it actually denotes? Conversion. We already discussed na. Market conversion price is nothing but conversion parity price. Yeah. Are you listening? Okay, that is same here. Simply given in different name, but it is same. Market conversion price is same. Next, conversion premium per share. This also we already discussed. Premium per share na 750. See, conversion premium. Again, this is conversion premium. Very carefully observe. What is the stock value of this bond? Stock value of bond is 750, and the market value of this convertible bond is 900, which means 150 is the premium paid over and above the stock value of the bond. Up a premium in percentage na 150 divided by 750. In this case, I think Institute has correctly done. I'll check it. Yes, they have taken conversion premium per share. They have calculated. See, you are getting 150 na 750 900 minus 750. That is the total premium in rupees. Number of shares issued 50 by how much shares have been issued per bond? 30. Conversion ratio is 30 na. So 150 by 30. How much you will get? You will get 5. Agreed. This is per share basis. If you compute, you can also compute premium in per share basis. And ratio of conversion premium. This is also they have computed 20%. How is that? How they have arrived at 5 rupees is the per share conversion premium divided by what is the market price per share? 25. And how much you are paying premium over and above the market price of equity share, which is 20%. Okay, ratio of conversion premium is nothing but the amount paid as premium paid over and above the market price of the share to get the convertible. See, this also you can write it like this, or see, 150 was the premium, correct? 150 divided by 750. Please tell me, 150 divided by 750 is how much? 20%. Are you all seeing? Now in the denominator they have taken 750. Yeah, it is assumed to be taken as 750. Listening, in the previous question they have taken 900. In this question they have taken 750. The answer solution I have taken from ICAI source only. Are you listening? Okay, so they are doing both the methods. You should understand logically, but I think this is correct. This is correct. Logically, this method is only correct. Okay, next, premium over straight value of debenture. Now see, till now we studied conversion premium, correct? But I discussed that they can also ask a premium over and over the straight value of the bond. In the previous question, straight value of the bond was 235 rupees, correct? And the premium comes to 30 rupees. 265 was the conversion bond price, convertible bond price. Then 30 rupees became the premium over and above the straight value. Here in this question, what happened? See, conversion price is how much? See, 900 is the convertible bond price. Then 750 is the stock value of the bond. Then 700 is the plain value of the bond. That is straight value of the bond given here. Can you see this? Straight value of the bond is 700. Now, three different numbers are given. Now, premium over and above the stock value of bond is 150 rupees or 5 rupees per share or 20%. Now, premium over and above the, what do you say? Straight value of bond is 200 rupees. Up 200 by 700 you need to do. How much is the percentage terms? 200 divided by 700. In percentage terms, it comes to 28.57, which is rounded off to 28.6. Are you all seeing this answer? Understanding? 900 by 700 minus 1, which is 200. You can also write it 200 by 900 minus 700, which is 200 by 700, which is 28.6%. Are you all understanding? Note. Okay, I have also given you note. This should not be confused with conversion premium. Conversion premium is a premium paid over and above the share value of the bond, which is 750. In this case, in this question, share value of the bond is 750. Correct? Whereas the premium over straight value of the bond is only 700. Okay. paid and over and above the straight value of bond is how much? 200 rupees. This is the difference. Are you understanding? You need to carefully observe the wordings and write the solution accordingly. Next, favorable income differential per share. Very simple. What is the favorable income differential per share? Now, see, coupon from the convertible debenture. This question, what is the coupon rate given for the convertible debenture? The coupon is the income. Annual income from this convertible bond is what? The coupon, yeah. If you carefully observe, they have given that 8.5% is the coupon rate. You apply it to 1000 rupees. Are you understanding? So yearly, every year you will get how much coupon? 8.5% into 1000, which is 85 rupees. Are you understanding? This 85 rupees is the income you get from the convertible bond. Point number 1. Listen here. Next, they have given the dividend per share. If it was taken a share, now the dividend per share is 1 rupee, which means how many shares you will get for this convertible bond? For each bond, 30 shares will be allotted. Conversion ratio is 30. For each bond, conversion ratio is 30. 30 shares will be allotted. In that case, one bond is equivalent to 30 shares. Okay, if you hold the shares now, you will, how much income you will get? Dividend is the income which you will get from holding equity shares, and the interest coupon which you will earn if you hold the convertible bond. Correct? Now, dividend from the income from the shares is how much? 30 into 1 rupee, that is 30 rupees. Correct? Total income. Now, if you hold the convertible bond, how much income you will gain? 85 rupees. What is the differential? What is the extra income you are earning because of holding this convertible instead of equity? Are you listening? This is what is known as, okay, this is what is called as favorable income differential per share. So per share basis, they have asked us to compute total favorable income is how much? You see here, total favorable income is 85 rupees minus 30 rupees, that is 55 rupees. Are you understanding? If you calculate on a per share basis, conversion ratio is 30 upon 55 by 30. How much is that? 1.833 on a per share basis. This is the income, yearly income, which I gain over and above the income arising out of holding equity share. This is the benefit of the conversion. This is just a calculation. This is a calculation oriented. If you hold a convertible bond, you will get 85 as coupon. If you hold only equity shares, the income we earn from is dividend. Favorable income differential shows how much more income you will earn by holding a convertible over and above the equity dividend, that is 55 rupees. And the per share basis, it comes to 1.833. Now, last, premium payback period. Very simple. You have paid some premium. Now, again, the question is not asking any, it's not specific about the premium. I told you there are two types of premium here. You are paying something over and above the straight value, as well as you are paying over and above the conversion value. Correct? In this case also, if they ask this, you just write it. Premium, you just understand that this premium means conversion premium. Mainly premium means conversion premium, unless specifically they tell that this premium is premium over and above the straight value. Then only you should apply that formula. Are you understanding? So this is premium payback period. How to compute that? Very simple. You first, in the numerator, you have to understand how much premium you paid. Premium over and above the conversion premium only you will take. Per share basis you can compute, or on total basis also you can compute. The years will be same. The time period will be same. See, payback period we already studied now, the intermediate and all, discounted payback period will be, which means you have invested some amount, correct? Your capital will be recovered in how many years? That is what is payback period, correct? Here, what is to be paid back? Now, premium payback back. You paid some extra premium now. This extra premium or incremental premium will be recovered in how many years or how many days, whatever it is, okay, which will be recovered, how much time, more time it will take to recoup my extra premium paid for buying this convertible. So it is, see, 5 rupees premium you paid per share basis, I am telling. Total premium is conversion premium 750, 900 minus 750, 150. Okay, I am putting, this is per share basis, this is total basis. Are you understanding? Per share basis income differentials, you computed a 1.833, correct? This is the benefit, extra income you are earning every year. You are earning some extra year now. Are you listening? Every year you are earning 1.833 on a per share basis extra income by holding convertible bonds instead of holding equity shares. Listening, and if you are and 150 is, if you take total basis, if you take the numerator as 150, total premium paid, denominator also you should take total. In that case, what you will take? 55 rupees. Listening, what is that? 55 rupees. How you got 55? Very simple. 85 rupees is the total income earned by holding debentures, minus 30 rupees is the dividend you earn. So extra income in total basis, in rupee terms, how much you are earning? In 55. That you divide by 150, you will get the same 2.73 years. What is the interpretation? Very simple. It will take 2.73 years for you to recoup the extra premium you paid. Are you understanding? This ignores time value of money. We are not concerned with time value of money. This is something similar to normal payback. Okay, time value of money is ignored. But this is to be understood. 2.73 years. This is all about convertible bonds. Next, quickly we will move on to bond refunding decision. Now, what is bond refunding decision? Listen to me carefully. See, today when I assume that 5 years back I issued a bond, okay, which was issued at 14% interest. Assume 14% interest, I issued the bond. 10 years bond I issued. Okay, what happened? Suddenly recession came and market interest rate fell down. So today what happened? Interest rate is only 8%. Are you listening? Or 10%, some percentage. Okay, substantially lower than what I issued initially. Apo, when I issue the bond, okay, I have this issue now. After 5 years, now I have to pay extra 4 or 6%, whatever is the difference. Suppose today market interest rate become 8%, yeah. But still, as a bank, I lent money at 14%, 14%, na? Understood? Now I borrowed money at 14%, na? Correct? Now I need to pay that money, na? Understood? Now I need to, whatever happens in the market, still I need to pay. My obligation is fixed, yeah. Still I need to pay today also 14% interest. Correct? In that case, I'm losing money. Correct? This case, what I will do is that I can refund the bond. I can issue a callable bond. That's why, okay, company issues callable bond when it feels that the general market interest rate is so high. Are you listening? When the market interest rate is at peak, generally companies tend to issue callable bonds. Callable bonds, what it will do, what is the benefit of this callable bond? Okay, you have an option, the company, the issuer has an option to, sort of convert this bond and replace it with new bond. Okay, it can call back, it can refund back the old bond, or it can call back the old bond and issue a fresh new bond. Are you listening? Now what we will do is that, okay, see, interest, in that case, what we should do now, we should compute the cost benefit analysis, which means you are refunding the old bond, correct? And issuing a new bond. In this case, the new bond will be issued at current market interest rate, which means every year you will only have to pay 8% interest, market interest rate, instead of 14% earlier which you are paying. Therefore, there will be some savings from the interest, annual savings will be there, but you have to incur some additional cost in the initial year to, sort of call the bond, because investor will not agree, there will be some premium attached to it. So you need to pay some call premium. It is something similar to option chapter, yeah. You pay some premium to get the option, Same way, the issuer has an option, so it has to pay some premium. The callable bond can be called back only by paying some premium. Understood? That is, and there are a few costs associated with it. So while calling the bond, you will have to incur some cost, but the benefit is every year, annual year, you will get some incremental, you will save some interest. Instead of paying 14% interest, you will only pay 8% interest or whatever is the lower market interest available, correct? Now in this case, what we have to do in this segment is, we have to analyze cost benefit. We have to simply do cost benefit analysis. Okay, we see total project, total cost, okay, total cash cost, and then what is the total benefit? If benefit is greater than the cost, it is better to go for bond refunding. If cost is greater than the benefit, you don't refund the bond. Are you listening? See here, interest paid on bonds or debentures are cost to the issuing company. When interest rates are cut by the central banks, the issuing companies still have to pay the interest at a higher rate than the current market interest rate. For example, if assume interest rate are 14% at the time of bond issue, and now it has become 14 to 12%, then the company still has to pay extra 2% interest till the outstanding period of the bond or debenture. Assume it has issued 10 years bond and only 2 years elapsed and interest rate drops. You have still 8 years to go now. In this case, therefore, when interest rates are high in the market, company issues callable bonds, which means the old bonds can be called back, and instead of this new bond which carries current market interest rate can be issued. This new bond will be issued at current market interest rate, correct? But it is not always beneficial to company to replace or call back old bonds and issue new bonds. Instead, it has to do a cost benefit analysis and decide whether to refund or call back. Okay, how to do cost benefit analysis? I have given these steps. Okay, but instead of just theoretically discussing this, what we'll do is that we'll solve a question. Through this question, we'll understand this deeply. See here, takes this question number 17. Mr. Trans India Limited is contemplating calling rupees 3 crores of 10 years, 1000 bond, rupees 1000 bond issued 5 years ago with a coupon interest rate of 14%. The bonds have a call price of 1015. Call price means at this price only you can call back. See, issue at the time of issue it was 1000 rupees, now face value, correct? Now, you have to pay some premium, 15 rupees per bond, you have to pay premium. That is the understanding. Are you listening? 1000 rupees pay bond, you can only call it back by paying 1015, which means 15 rupees per bond you have to pay over and above the price, correct? And had initially collected proceeds of 2.91 crores due to a discount of rupees 30 per bond. Listening? See here, initially collected, which means 5 years back, it collected 2.91 crores due to discount of rupees 30 per bond. The initial floating cost was 3,60,000. The company intends to sell rupees 3 crores of 12% coupon rate 5 years bond to raise the fund for retiring the old bond. It proposes to sell the new bonds at their value of rupees 1,000. The estimated flotation cost is 2 lakhs. The company is paying 40% tax. Okay, the new bond shall be issued 2 months before retiring old bonds to avoid any market risk, and using the proceeds from new issue to retire the old bond. What is the feasibility of refunding bonds? Which means we have to decide whether to go for bond refunding or just continue with the old bond. Okay, see, I can summarize this fact here. We'll solve it here. See, this bond Okay, old bond. I'm talking about old bond. Yeah, it was issued year 0. It was issued 5 years back for a period of 10 years. Assume this is 10 years. Correct? Now 5 years elapsed. We are in middle of it. So 5 years gone. Okay, now we are sitting at this point. Correct? Now we are sitting at this point. Now see, 5 years back we issued there initially at what interest rate we have issued this bond for this period? 14% interest if I am right. I'll check it once again. Yes, 14% interest rate. Correct? And yes, 3 crores was the value and initially collected proceeds of 2.91 crores instead of 3 crores. Upon 9 lakhs is the discount, 30 per bond. See, first number of bonds you need to calculate. Now, how to compute number of bonds issued? 3 crores divided by 1 lakh. Correct? See, number of bonds is how much? 3 crores, which is 300 lakhs. Okay, 300 lakh or 3 crores divided by how much? 1000 rupees. It was issued for 1000 now. How much is you are getting? 300 lakhs divided by 1000 is nothing but 30,000. So, number of bonds issued is 30,000. Are you all understanding? First, next, see here, and there is 9 lakh rupees is the discount. Initially, when you issued at 30 rupees discount. Understood? Up bond price 1000 rupees na, you issued this at how much? 970. Understood? So 970 into 30,000. 30,000 into 970. That is what you got. 291 lakhs. 2.91 crores they have written na. That is the initial amount you received. Correct? The company received. After 9 lakhs is the discount. After the discount. Discount is how much? 9 lakhs. How you got discount? 9 lakh. 30 into number of bonds. How much is that? 30,000. Correct? 30,000 into 39 lakhs. 30,000 into 30. Correct? 9 lakhs. Okay. This is all about old bond. And yes, one more thing is the flotation cost of the old bond was given na. So old bonds flotation cost was 3,60,000. This flotation cost would have been incurred in the first year 0. Listening? Before 5 years. Now I am contemplating to issue a new bond which is having a life of, see the black line writing, I am trying to issue a new bond which is having a life of only this 5 years. Are you listening? Here we are after 5 years. Now balance 5 years period na. I am trying to issue a fresh 5 years bond. Are you listening? I am trying to issue a fresh 5 years bond. Now what is the details given in the fresh bond, fresh issue we will see. See, I am again intend to sell 3 crores, 12% interest rate, which means earlier it was 14%. I understand that interest rate in the market dropped, so I am issuing 12% interest rate. Correct? 5 years bond to raise funds for retiring old bond. Of course, I will raise funds initially, then I will pay back the old bond. Are you listening? This is how it happens. In practical scenario, what happens is, okay, you make a fresh issue, you raise funds, then using that funds you pay back the old bonds. Right? It proposes to sell the new bond at par value only. There is no discount or premium. Okay, par value only it is sold, so there is no discount involved in this case. New bonds, no discount is there. And estimated flotation cost is 2 lakh rupees. The company is paying 40% tax. Okay, 2 months is the parallelly you have to pay 2 months. What is this adjustment? Very important adjustment. The new bond shall be issued 2 months before retiring old bonds, which means what happens? See, you will have overlapping interest, which means you will have both the interest here. See, that is what happens. You when you are retiring the old bonds, you cannot retire it instantly. Correct? All these things will happen. You have to make fresh issue. You need to realize proceeds. Then you will. There are a lot of process now. So 2 months is the lag period. Okay, this 2 months. What will happen? Old bond will also be in operation, and new bond will also. You have to for new bond also you have to pay interest. In this case, 2 interest will be there. Overlapping interest will be there. You have to pay also the 14% interest and 12% interest. Are you listening? This will be there. In this case, what will happen? We will see. Okay, adjustment is there. From issue, what is the feasibility of the bond? Quickly we will compute. See here, very simple. NPV, I will come back to the NPV later. First, initial cash flow I will compute. I will calculate all the initial cash flow associated with this bond. Listen here. See here. First, call premium is there. When you issue a new bond or refund a new bond, you refund the old bond and issue a new bond. To refund the old bond, you need to pay some premium. You cannot just refund it as such. Correct? In this case, 15 rupees is the premium. 1015 minus 1000, 15 rupees. And the premium, total premium, how number of bonds fine. The 30,000 is what? Number of debentures. Okay, number of debentures 30,000 issued earlier. So 30,000 you need to refund it back. 15 rupees premium per bond. How much is the total premium? 4,50,000. See, 4,50,000 is the additional premium you need to pay. But since you are paying this additional premium in the P&L account, you will have the debit na. So you will have tax benefit for the corresponding tax benefit. Are you listening? We are cash flow. We are computing cash flow. Correct? NPV computation. Only cash flow should be taken, not accounting data. In that case, 4,50,000. Yes, I have debited in the P&L, but subsequently I will receive the tax benefit of 40%. Na. So after tax amount only you should take. In the capital budgeting chapter, you will take after tax na, cash flow after tax. Cash flow means cash flow after tax. Why? There will be corresponding tax benefits, correct? That also you should consider to compute NPV, to see the cost benefit analysis you should consider. Upper tax benefit will be there. This is 4,50,000. When you debit in the P&L, when you have the expense, okay, subsequently you will have the 40% benefit for tax benefit. So what will happen? Deductible expense. So you will get only net 2,70,000 as expense, 4,50,000, but 2,70,000 as expense. This is the outflow. Outflow number 1 initially. Next, there is second outflow, which is flotation cost of the new bond. This is new bond. Okay, you have some flotation cost of 2 lakh rupees. Can you see this? Okay, see here. Estimated flotation cost of 2 lakh rupees for the new bonds is there. That also we need to consider. See, you may ask, is the 2 lakh rupees will be amortized over a period of next to 5 years? Correct. But the benefit you will get, tax benefit you will get after the amortization benefit, subsequently you will get the tax benefit over a period of time. But initially cash flow, flotation cost, when you are incurring, can you tell, okay, exchanges, can you tell after 5 years I will give bits and pieces, okay, I will give you in installments, can you say no? Entire 2 lakh, see, even though accounting you will amortize over a period of time, over a period of the bond life. What is that? 5 years, correct? But cash flow you will be incurring entire 2 lakh rupees as cash outflow. Yeah, remember, understood. So that entire 2 lakh will be your cash outflow. Next, overlapping interest. This is also what is happening now. See, before tax interest you have to pay 14% interest for 2 months. Correct? You have to pay 14% interest annual for 2 months period. 2 by 12 into what is the value? 3 crore. In the 3 crore capital, you have to pay 14% interest for a period of 2 months. Because even though you make a fresh issue and try to repay the old bonds with the proceeds of the fresh issue, but still you have to pay the interest because you cannot instantly do it. 2 months is the lag period. For that 2 months you have to pay this, overlapping interest. How much is that? 14% incremental interest. Whatever is the interest I have to pay, that I will consider. 14% into 2 by 12 into 3 crores, that is 7 lakh rupees total interest for 2 months. Adila, okay, I will also enjoy a tax benefit. Okay, interest has tax shield obviously. So 4 lakh rupees, 4,20,000 is the net net interest outflow for a overlapping period, that is 2 months period. Understood? This we will consider. Now there is 2 more things. Okay, what is that? Tax saving on unamortized discount. This you should reduce from the, see, till now all these items were outflows, correct? The call premium, net call premium, after tax call premium of 2,70,000, after flotation cost of 2 lakh, and after tax cost of overlapping interest of 4,20,000. All these were outflows, correct? Now to this outflow you have some, today itself you have something, some inflows also, that you have to consider. Net outflow only you have to take, correct? So in this case, what is the inflow? Tax saving on unamortized discount on old bond. See what happens, old bond you issued 5 years back, the total discount was how much? 9 lakh rupees. We already saw that this 9 lakh was the total discount. Agreed? This discount total will be amortized over a period of the life of bond 10 years, correct? Which means 90,000, 9 lakh divided by 10 is 90,000. This 90,000 would be the yearly amortization, correct? But when you are refunding the bond back, when you are calling back the old bonds, you will have to instantly, you cannot say that I am refunding the bond, but I will keep on amortizing the balance amount. Can you say, see, 5 years 45k will be there listening, the 5 years period, 50% of the 45,000. Can you say this 45,000 I'll keep on amortizing over a period of 5 years? Can you say? No, are you listening? I cannot do that. When I am refunding the old bond, I have to expense everything corresponding to that bond today itself. You have to debit the entire balance unamortized portion in the P&L today itself, which means in this case, what happened? 9 lakh into 5 by 10. What is the balance unamortized portion? 9 lakhs into 5 by 10, which is of course 4,50,000. 4,50,000. You have to debit it to P&L today itself. Agreed? You have no choice. Now in that 4,50,000, what you will do is that you will save tax. Are you listening? There will be a tax saving of unamortized discount. Why? Because you are debiting the entire amount to P&L. So corresponding tax savings will be there. Understood? Understood? This you understood? That we will consider today itself. It will not happen over a period of time because you are debiting the entire thing. The tax saving will also come together. Are you listening? So entire 1,80,000 will be the benefit. I write it in negative term. Don't think outflow. Okay, negative means I am reducing. I am only calculating outflow. If you see, I am calculating only initial cash flow, cash outflow. Are you listening? In that, negative means I am savings. It is income. So I am reducing 1,80,000. That is a tax savings from unamortized discount. Then there is unamortized flotation cost. Initially I incurred 3,60,000 at flotation cost for a period of 10 years. 5 years elapsed. Balance 1,80,000. When I call back the bond, I need to discount the debit the entire amount of 1,80,000 balance, I cannot keep on amortizing the balance period, na? So I need to debit it instantly 1,80,000, correct? From that also I will receive some tax savings. I will have some tax savings, which is of course 40%, 0.4 na, you see here 0.4 na, don't think it is just 40% is the tax rate. That is why I am considering 40%, which means 1,80,000 into 40%, 72,000. The total, if you deduct, see, take your calculator, okay, 2,70,000 plus 2 lakh, the flotation cost, plus 4,20,000 plus 4,20,000 minus 1,80,000 is the savings, correct? Minus 72,000. How much is that? 6,38,000. This is the net cash outflow. Remember, this is cash outflow. Net cash outflow, which is calculated today. Are you listening? Okay, 6,38,000. Now, working note number 2. What is the annual cash flow savings? This is something like capital budgeting. Yeah, NPV, how you compute? Initially, you will have year 0, you will have big cash outlay, and then it will be followed by series of cash inflows. Are you listening? Now, same way, now we need to consider, you have issued a new bond at lesser interest rate, na? So what is the benefit of doing this? You will have every year save some interest cost, na? That benefit, annual benefit, we will now calculate. See, what is the annual benefit? This is one-time cash outflow, total amount. Okay, now we will compute annual benefit of this. How much is the annual benefit? And then bring it to present value terms and find the net benefit, NPV, correct? To make a decision. Now see, annual benefit, old bond, first you consider old bond. What is the annual benefit from the old bond? See, interest cost from the old bond is 14% for 3 crores. Now 42 lakhs is the annual interest cost. Always remember, this I am discussing annual pa, don't get confused, okay? This is annual cash flow savings, understood? Interest every year you need to pay, na? So this year if you take interest, now 14% interest at what base? 3 crores is the capital, so 42 lakhs will be the interest. When interest will have some tax savings, 40%, yes. Upper net cash outflow is how much? Interest outflow, net interest outflow is how much? 2520 from the old bond. Upper old bond, every year for the old bond you need to incur 25 lakhs 20,000 as the cost, interest cost. After tax, interest cost. Next, tax savings from the amortization of discount. What you are doing is that, see, if you did not call the old bond, correct? You call the old bond now, but if you continue to have the old bond, you have to amortize the discount. Na? Initially you gave discount of 9 lakhs, na? It was issued at discount. Okay, 9 lakh was the discount amount. Balance unamortized portion will be there. Na? 9 lakhs divided by how much is 5? How much is that? 9 lakhs divided by 5 if you do 1,80,000. Yes, sorry. See here. Tax savings from unamortized discount, na? Yes, balance 9 lakh divided by 1,80,000. 1,80,000 into 40%. How much is that? 1,80,000 into 40%. Okay, see here. Inge, what I am trying to discuss is that, yes, 9 lakhs is the amount of discount, total amount of discount for 10 years, correct? 5 years period is gone. 5 years period is gone. Appo, what is the balance? 4,50,000 is the unamortized portion. Yeah, 4,50,000 is the balance unamortized portion which is to be amortized. See, if you let the old bonds run, you have to amortize this 4,50,000, correct? What you will do is that if you, because you call back the old bonds, you instantly debit it to P&L, correct? This 4,50,000 you can instantly debit to P&L. Because of it, you will have some tax savings. Otherwise, okay, you will not enjoy this tax savings today itself, correct? How much is the tax saving? Amortization of discount, see, very simple. 9 lakh divided by 10, 90,000 is the total discount, yearly discount, correct? And you will save 5-year discount, na? So tax savings is 90,000 into 40%, that is 36,000. Are you all getting this? Next, tax savings from amortization of flotation cost. Old bond flotation cost was 3,60,000. Every year flotation cost was 36,000. In that 36,000, for the balance 5 years period, every year you can save 40%, na? Because tax savings you are having, understood? So 40% you can save because you instantly debit. So it is preponed. Are you listening? So 40% you will every year save. In that case, what is happening? 14,400. Okay, you will have the savings. This is savings, but that is why I put it in negative. Are you listening? This is savings, that is why negative. First one is cost. Are you listening? 2520 is the cost, and in that savings you net it off from tax savings from the flotation and amount discount. You will get net, okay, cost, net interest cost from old bond. Okay, please be patient. This is just a net interest cost of old bond. Now come to new bond. New bond has some issues, adjustments. You need to compare. What you will do is that, okay, annual after tax payment under old bond, that is this much, new bond. Annual after tax payment under new bond. What is happening? Interest is 12% interest rate, correct? Every year annually 36 lakhs will be your interest. After tax interest will be 21 lakhs 60,000. Then tax savings from amortization of flotation cost, 2 lakhs is the new flotation cost which is to be amortized over the next 5 years period. Okay, which will come to 40,000 per year. Yes, 40,000 per year. In that you will save tax of 40%, which comes to 16,000, and net 21 lakhs 60,000 minus 16,000 will give you net interest cost for new bond, which is 2144. Now what you will do? Annual cash flow savings, old bond. Had you continued the old bond, you will have to pay how much? You will have to pay 24,069. Can you see this? This would have been the net interest cost if you decide to continue. Listening, okay. This is the annual. This is the annual interest cost for the old bond. Now, what is the annual interest cost for the new bond? New bond is how much? 2144. Are you listening? This is the annual interest cost for the new bond. That was annual interest cost, net annual interest cost for the old bond. Are you understanding? So what you will do? What is the net savings? Net cost is nothing but 20. Earlier you had incurred 20. You have to incur 24,69,600, but now only 21,44, which means you are saving every year 3,25,600. 3,25,600 you are saving every year. Are you listening? This is annual savings, but this will happen over a period of 5 years. Again, this every year you save from 5th year. From today, which we are at 5th year. From today, we will be saving every year 3,25,600, which means year 6, 7, 8, 9, 10, you will be saving each year 3,25,600. You have to discount and bring it to today's terms, correct? That is the PV of net inflow. This is the inflow, or this is the benefit for each year. But you cannot simply add 3,25,600 into fine. You cannot do. You have to discount present value of this cash flow. You need to find. What you will take is that annuity cash flow 3,25,600 into present value annuity factor at 5% interest. What is the 7.2%? Okay, yes. After tax interest. See, this 3,25,600 is there. This is after tax cash flow. Always remember, okay, after tax cash flow should be discounted using after tax cost of debt. Okay, before tax cash flow should be discounted using before tax cost rate, where you will learn the capital budgeting chapter, okay, base case NPV and adjusted NPV. There I will discuss this in detail, where you will use after tax cost, other places and all you will use only after KD. If you remember cost of capital, the KD, always KD after tax only, cost of debt is after tax. But okay, for valuation and all you will consider only after tax cost of debt. But only in one case where you need to find adjusted NPV, where we compute in the capital budgeting chapter, there we need to take before tax, correct? So here we have taken 7.2%. How you compute 7.2%? Very simple. 12% is the current interest rate, correct? You need to discount it. 12% and 40% is the tax rate. Up 1 minus 0.4. 12% into 60%. How much is that? 12% into 12 into 60%. 7.2%, correct? 12 into 60%. Yes, 7.2%. Which is the discount rate should be used. Present value annuity factor. Every year the cash flow is saving. We studied in time value of money. Remember, annuity cash flow, how will you discount? Annuity factor you need to take and discount it. Are you listening? So 7.2%, 5 years, annuity factor is nothing but 4.0783. You multiply 3,25,600, you will get 13,27,894, which is the present value of the total cash savings over a period of 5 years. Today's value comes to 13,27,894. What you will do? You will reduce from the first value, which is of course 6,38,000. 6,38,000. The initial outlay, that is here, initial investment I have roughly put it, but the point is here 6,38,000. Are you all getting this? 6,38,000 only I am considering here as outflow. Okay, this is nothing but see, NPV is discounted cash inflow, disky minus disco discounted cash outflow. This is nothing but discounted cash inflow, and this is present value discounted cash outflow. How much you are getting? This is the net NPV 6,89,894, which means if I refund the bond and issue a new bond, okay, I will have the net benefit of 6,89,894. Since NPV is positive, okay, it is better to go for bond refunding, right? We understood through this question all the terminologies I have given here. Okay, this steps I have given. You can simply go through the steps. See, this is just steps made from this. Actually, you don't need any step. Logically you can solve this question. Okay, right? I don't need to clarify that. Notes is given. You can go through the notes for more clarification if required, right? Next, we are moving to clean value versus dirty value of the bond. A small discussion, 10 minutes, 15 minutes. With that, we will close this chapter of fixed income securities, right? Last discussion, please cooperate. 10 or 15 minutes it will take. See, clean value versus dirty value. What do you mean by clean value? What do you mean by dirty value? First, you need to understand how the bonds are issued. See, there are two ways in which I can purchase a bond. First is I can go directly to the issuing company, correct, and purchase a bond. Assume I'm buying a bond from company comes with initial offer, initial public offering. It will come for IPO, correct? Bond IPOs will be there. Initially it comes to public offering, correct? I can either subscribe to that IPO and buy the bond from the company directly itself. That is one choice. Or assume that the bond bond was issued say 3 years back. Bond was issued 3 years back. Today you want to buy the same 3 years back. It was issued for 10-year bond was issued 3 years back. But today, after 3 years, suddenly you want to buy the bond, correct? Now it is a listed bond, so you can also go to the secondary market, which is the stock market. Bond market, it will be listed. These bonds will be listed. I can also buy the bond from the open market, correct? So there are two choices available for me. One, I can go directly to the company and buy the bond, purchase the bond, correct? But that only you can do initially. After that, if I want in between period, like if I want to buy the same bond. If at all the bond is listed bond, I can buy it from open market. There are two choices, correct? When you are buying the bond from the company and it is getting redeemed by the company itself, and you are holding the bond till maturity, there is no need to compute clean value, dirty value and all. There is no relevance. Are you understanding? Where the question arises, in between period, assume you are a bond is having a 10-year period, you are buying after 3 years, you are buying in between. So balance 7 years maturity period is there, correct? In this case, you assume there is a 10 years bond, year 0 and this is 10. You are buying the bond after 3 years, correct? Now you have balance 7 years period of the bond remaining, correct? In this case, what is happening? If this, assume this bond is coupon paying bond, half yearly coupon paying bond, or yearly also you can take, half yearly coupon payment to make you more, to make you understand. I'm trying this example. Half yearly bond, if you consider, what is happening? Coupon will be paid every 6 months. Assume any date, last June, 30th June it will be paid, and 31st December assume it will be paid, correct? In this case, what is happening? You have this annual half yearly coupon paying bond, correct? Now you want to buy this bond, you can buy the bond only on the 1st July or say 1st January or in between date also you can go and buy, correct? I am buying, assume the February month or in the March month I am buying. What is happening? You are buying in between the coupon paying period, you are buying the bond. What is happening? The interest which is paid by the company, they will only pay interest at the reset date, on the given date. Half yearly, the date will be given, the interest will be paid exactly on whatever date given, 30th June or 31st December or any given date, they will pay interest. Are you listening? This you understood what I am trying to say. Now, if you are buying in between, you tell me, say if you are buying fourth year, this is 4th year, now you are buying in the March month of say 4th year. Now you tell me, June they will pay interest, you tell me they will pay entire 6 months interest to you or just 4 months interest to you if you are buying, assume March. 4 month interest they will pay, 6 months interest they will pay 6 months interest. This you need to understand. Are you listening? So 6 months interest only will be paid by the company. Company is paying interest. On that date, company will see who is the bond holder and will pay interest. Company will not see each and every person who is transacting, who is buying and selling in the market. That they don't care. Are you listening? They will pay interest on that date. Whoever is holding, they will pay entire interest. They will not keep on segregating how many months this person is holding, how much interest is to be paid to this person, A, B, C and all. They will not see. They will pay 6 months interest on given date. Whoever is holding, they will pay 6 months interest. This is the situation. Are we clear with this? Shall I proceed? Now, what is happening? See, in this case, what is the value of the bond? You need to understand. Value of the bond is present value of the future cash flows discounted at YTM, current yield, correct? This we already studied. Now the problem is when you are considering the bond cash flows, and when you are valuing in the March given date, future cash flows, future interest is there, the entire 6 months interest will be considered in valuing bond, correct? Are you listening? But the portion of interest, 2 months portion, assume you bought it March, and the interest is paid from January to March, 6 months, January to June. Correct? In this case, the 2 months interest doesn't belong to you. Only 4 months interest belongs to you. Correct? But while valuing, you have considered the entire 6 months interest because future cash flows. 6 months interest will also become cash flow. Listening? So in that case, what we will do is that we will remove the value of a bond, which is having accrued interest portion in that. In that accrued interest portion will be removed, and that will be called as clean value of the bond, and the value which is arrived after considering the accruing interest will be considered as dirty value of the bond. Are you listening? How to segregate the value is the subject matter of discussion. Shall I proceed? See here, quickly we will go through the notes and see a very good question. Through that question, everything will be solved. See, value of a bond is present value of the future cash flows discounted at required rate of return of the bond investors. When the bondholders buy the bond from the company and hold till maturity, then there is no issue of dissecting this. Okay, these bonds can be bought at open market, bought and sold at open market also, and therefore it is possible for the investors to buy on any given date and not on the coupon payment date itself. Correct? If a bond pays coupon annually and we invest in between the year, then that portion of the interest which we receive for the period for which we were not the owners of the bonds needs to be segregated from the bond price. Correct? And the price which includes PV of interest which doesn't belong to us is called as dirty price, and the price which we arrived at after removing the present value of the interest portion which does not belong to us, okay, which is accrued interest portion, is called as clean price of the bond. Okay, we can understand this with the help of this question. Take question number 18 for discussion. See, classic question to make you understand entire thing. One more thing is there I wanted to clarify. The value dissection which you are learning is some, see, in the money market instrument, there is a concept called as money market instrument which I will not cover in the bond segment. I will cover it in the separate video. Okay, there I will discuss money market instruments. Here I am not considered about money market instrument, a short-term security. Yeah? They will be T-bill, okay, the certificate of deposit, all these are commercial papers are there. Na? These things are issued for a period less than 1 year. Understand? Yeah. This I will discuss it separately. Now I am concerned only about the bonds which are for long term. Are you listening? Yeah. And for that also you will have, you know, dirty value and clean value. That you will understand later. Okay. See. Here we are considering about bond. Don't get confused. That I wanted to clarify. Said MP Limited issued a new series of bonds on January 1, 2000. The bonds were sold at par value 1000, having a coupon rate of 10% per annum, and the mature on 31st December 2015. Very simple, yeah. This bond is issued January 1, 2000, and it continues in 2015. A 15 years bond by the 0 to 15. 15 years bond is being issued. Correct? And the coupon rate is 10% and trading at par. Okay, this is the given detail. Coupon payments are made semi-annually, right? To make you understand, this is very good example. Semi-annually and on June 30th and December 31st. Assume that you purchased an outstanding bond on 1st March 2008 from the open market. Understood? And the going interest rate, market interest rate is 12%. At that time of purchase, the market interest rate is 12%. Are you listening? Now, what is the YTM of the, what is the question they are asking now? What is the YTM of the MP Limited as on January? First date, opening date, what is the YTM they are asking? Very simple, opening date, if you are all alive, awake, you tell me, coupon rate of 10% per annum. Coupon rate is 10% and the bond is trading at par, which means the yield is same as coupon. Are you listening? Only when the, if the bond is trading at par and the coupon, and what is the yield? If the bond is trading at par, the yield will be always the coupon rate. If coupon rate is given in the question, okay, close your eyes and tell that yield will also be same. 10% is the yield. So YTM is on issue date, the YTM. Okay, YTM as on issue date. As on issue date is how much? 10%. No doubt about it. That is clear. Coupon rate. Because it is trading in the market at par they have given. So it is, yield is simply 10%. Now, this is the main question. What amount you should pay to complete the transaction? Yes, of course. I'll find as of today. See, today I am buying. Up March 1st 2008, I will value the bond. That is what I need to pay. That is what I need to pay to complete the transaction, which means present value of the future cash flows I will compute. Of that amount, I need to segregate how much would represent the bond basic value and how much should be accrued interest value. Are you listening? Okay. With accrued interest, it is known as dirty price. Okay. Excluding the accrued interest, it will be called as clean price of the bond. Shall we compute? Very simple. First case, YTM already done. Bond value as on 1st July 2008. Why I'll do this? You will understand why I'm doing this. See here. First, even though I am buying 1st March, when I am buying 1st March, 1/3/2008 I am buying, but I am valuing, first I will value at 1/7/2008, then I will discount 3 months, understand, to bring it to present value terms, 1st March, but first I will value 1/7/2008. Why? It is a coupon paying date, so it will be easier to value. There is an objective. Are you listening? See, I will convert this, see, this semi-annual interest rate. Now, wherever the question gives you semi-annual interest rate, you have to convert the data into periods. I told you, yearly data you will convert into period and solve the question. Remember, in the first value discussion itself, I told you. So, period, here assume 1st July, what is happening? 1st July 2008, you will have, 31st December till the 31st December 2015, correct? The bond's maturity period is maturity date is 31st December 2015. In that case, if I'm trying to value the bond at 1st July 2008, how many years are remaining? 7.5 years is remaining. Listening, 6 months of this year, 2008. Then from 2009 to 2015, there is another 7 years, correct? 9, 10, 11, 12, 13, 14, 15. 7 more years. So 7.5 years I need to value. Upper 7.5 years can be represented 15 periods into 2 na, semi-annually coupon paying. So 15 into 2 I will consider. And there are 3 things I told you. You have to change the years. 7.5 years we convert into 15. Then present value factor was 12% per annum yield, correct? When you are valuing the bond. See, one more adjustment is there. In this question, they have given that the going interest rate is 12%. Even though the going interest rate is 12%, and as on 1st March is 12%. But we are valuing on 1st July, assuming the same 12% is there for 1st July. It need not be. Every 2 months, the RBI comes with monetary policy meeting wherein they change the interest rate is possible. Practically it is possible, but theoretically we assume that the same interest rate prevailing on the date of March, 1st March 2008, okay, is also prevailing on the 1st July 2008. Listening, so prevailing rate is 12%, na? That is 12% per annum. Understood? So 12%, if we convert semi-annual period, now if I convert, how much it will be? Okay, it will be 6% per period. And interest coupon is also there, na? We have bought 10% interest paying, coupon is 12%. Pa. Coupon is 10%. The coupon is 10%. Now, what will be the interest? Every year interest will be 100. But semi-annually, na, interest, that also we need to bring it to half, correct? So 50, 100 divided by 2, which is 50. So every period you will receive 50, every 6 months period, you will receive 50 rupees as coupon. Okay, this coupon and along with 1000 redemption after the 15 periods, you discount using 6-year present value factor 6%. Why 6%? Semi-annual 12%. Okay? You will get the value of the bond as on 1st July 2008. Listening, this you understood. First step is to compute the value of the bond as on 1st July 2008. Now what is the next step? Now very simple. Value of the 36/2008 you need to consider. See, 1st July na 36/8 company will pay interest. Present value of the future, when you value the bond at 1st July 2008, present value of the future cash flows, na, you will not consider the interest as on received as on 30th/6/2008. Understood? The future cash flows, na, by that you will consider only the December end cash flow, December interest from 50 rupees you will consider, na. From December interest only you will consider. That is why given 15, na, not this interest, 50 rupees interest. But how to find the value from 36/2008, na, this only one day difference. So as on 36, what will be the value? See, I know as on 1/7, 1st July, the value is 902.91. One day before 36/2008, what is the value? Very simple, 50 rupees you added. Because 50 rupees is present value, na? Present value happening today, na? So that is the cash flow happening today, which means that present value factor will be 1. 50 rupees is as good as 50 rupees received today. Okay, there is no time value of money adjustment required. So which means 30th/6/2008, what is the value? 902.91 plus 50. I simply add 50, not the present value of 50. I don't need to discount it. Why? Because it is happening today. 50 rupees you receive on 36/2008. So present value of 50 is 50 only. So what is the total? 952.91. This you are getting value as on 36/2008. But I want value at the end of 36/2008. I want value as on 36/2008 as at 1/3/2008. 1/3/2008. What I will do is that from 1/3/2008, see, I have 4 months discounting, na? So a total 6 months. Out of that, 2 months, January, February elapsed. Baki, how many months are there? 4 months. So if I discount using 4 months, okay, then 4 months interest of 4 months, what I will do, I will get the cash flow, I will get the value as on 1st March 2008. Are you listening? So 952.91 into 1 divided by 1.04. Why 1 divided by 1.4? 12% is the market interest rate. If I convert this into 4-month interest, na, okay, it will be divided by 3. Are you listening? Every year there are 4 months, 4 months period, na. In that case, 12 by 3. How much is that? 4%. That is what I did. Okay, 1 divided by 1.04. Na. This is discounting factor for 4 months period. I discount using this 952.91 into 1 by 1.4 or simply 952.91 divided by 1.04. I get it as 916.26. Are you all understanding? This is the value of the bond as on 1st March 2008. Is this clear? Now I will make you understand how to segregate this value. See here, very simple. Interest, you have 50 rupees interest. Na. In total, you have 50 rupees interest. Na. First, to segregate the interest alone. I am not considering the present time value of money now. Just to segregate the interest, without considering time value, just to segregate interest. How much? For January, February, 2 months interest is 16.67. 50 into 2 by 6, correct? Because already this is 6 months interest. You don't need to do 2 by 12. Because this 50 is 6 months interest. Yeah, listening. Yeah. Then March to June, we have 4 months interest. How to do 50 into 4 by 6, which is 33.33. Are you listening? So now you will find present value of the 16.67 comes to how much? See, you should discount using 4%. Na? Again, 2 months period, you discount using 4 months. What you will do is that you will get 16.03, and here you will, if you discount using 4 months period, now you will get it as 32.05. Listening, yeah. So you got the present value of this 50 rupees. First, what you did, you segregated the interest. Then you computed the present value of the interest for 2 months period, present value of the interest for 4 months period. Are you listening? Present value of the interest period, 2 months interest period is also included in your value. Why? In the 916, we computed now in the 916.26. Are you all seeing this number? In the 916.26, inside this 916.26, you consider entire 50 rupees is due to be received on the first 30th June 2008. Interest 50 rupees you need to receive. By valuing, you consider 50 rupees. You consider plus 50. You consider the entire 50. But out of this 50, 2 months interest doesn't belong to you. Agreed? That you need to segregate to find the clean value of the bond. Understood? So what you will do is that first you segregate the 2 months interest, then you find the present value of the 2 months interest, and you found out the present value of the 4 months interest. Agreed? The 2 months interest present value portion is there, na? Okay, that you will remove from the present value of the bond. Bond value, it is present value, correct? From that value, you will remove the 2 months interest portion out of it, and how much you will get? 916, see here, 916, bond dirty value, total value, which is 916.26. This is the dirty value. Out of this 916.26, you will remove 16.03, 900.23 will be the clean value. This is called as clean value of the bond, and the balance, come interest portion of 16.03. This is come interest portion, come interest, accrued interest portion, present value of the accrued interest. This basic bond value is also referred to as clean value of the bond, and the bond price inclusive of come interest portion is called as dirty value of the bond. Okay, with this we are through with this comprehensive revision of this fixed income securities. Okay, I think it came around to some 6 hours or so. You need to revise it properly. Okay, sorry. Right, thank you. We will continue with equity discussion in the next segment. Thank you.